All right, welcome everybody to day 2 of the 2025 TraderLion conference. Super excited for today's lineup, and a huge thank you, first of all, to the presenters yesterday. You guys were amazing, and a huge thank you as well to everybody who tuned in, and looking forward to another great day today. Again, we're powered by NinjaTrader, NinjaTrader Live, and more on them in just a minute. First things first, again, this 6-day conference has a fantastic lineup of speakers. You heard many of them yesterday. We've got 6 more fantastic presenters today, and we'll go through the lineups in just a minute. But just a huge thank you to our presenters, and this is what really makes this conference special, is being able to learn from these market wizards, top traders, and top educators as well. So hopefully you guys are enjoying it, and make sure you guys have your notebooks ready for every single presentation of the conference. Here's the lineup for today. Kicking things off at 9:30 a.m. Eastern is Morgan Housel discussing the psychology of money. He's going to go through some amazing case studies and stories. That will be fantastic. And next up at 11, we've got Victor Sperandeo discussing what makes money in the markets. This is more of a fireside chat style presentation. That will be fantastic. Really looking forward to learning from another market wizard and one of the top rated traders in the entire world. He's traded for George Soros, has traded every single instrument possible, options, futures, equities, all of that. And that should just be amazing. Really looking forward to that one. Next up at 12:30, we've got Stamatoudis discussing mastering your trading foundation, thinking like an engineer. That will be great, especially for traders out there who are still kind of figuring out their system, what kind of trader they want to be. That should be extremely helpful. Then at 2 p.m., we've got Brett Steenbarger discussing the best practices of professional traders, sharing his expertise, working with the best traders in the world, and discussing also positive trading psychology. Then at 3:30 p.m., we've got Scotland discussing pivot points, his process for interpreting price action, and diving deep into many different examples of how he interprets on both a short-term and longer-term basis, resistance and support, really sharing his expertise that he's developed over the years. That will be fantastic, especially for the swing and momentum style traders out there. And then last but not least, we've got the Lifecycle trade team, Eve Bobuck, Kathy Donnelly, Kurt Dale, and Eric Kroll, with another fireside chat style discussing the potential of IPOs, how to trade IPO bases, and going through a lot of recent case studies with CoreWeave, Circle, and much, much more. So that will be a fantastic way to wrap things up. And I'm excited for every single one of these presentations today, but let us know in the chat right now, which of these are you most looking forward to? And yeah, all of them should be great, but yeah, let us know who you're most looking forward to hearing from and why as well. All right, let's keep diving in here. And while I move to the next slide, before I cover this, I also want to mention, again, welcome to everybody. And in the chat right now, let us know where you're tuning in from. It was so cool to see yesterday where everybody was coming from all over the world. Every country seemed to be represented. So again, let us know in the chat where you're tuning in from today to the conference. Always so cool to see who's the furthest, and we'll have a little friendly competition there. Also, again, we work very hard to keep this event free. And in exchange, what we ask from you is to please help share the event. If you've got a trader buddy that you think would enjoy it, that doesn't really watch much of our videos before, invite them to come, share it on Twitter as well. You can scan this QR code right here, and it'll post this message right here. And basically just help us, share this resource that we're building. Again, we've worked hard to create and curate an amazing lineup of market wizards, top traders, and educators, and we want to help out as many traders as possible and help them, access this resource. So go ahead and share the word, spread the word, and a huge thank you in advance. In addition to that, I do want to give a huge thank you to NinjaTrader Live for helping power this conference. This is a fantastic resource, especially for your future traders out there. They're live 6 days a week, featuring educators discussing real-time analysis, setups, all of that. Is a fantastic resource again. And to learn more, you can go ahead and scan this QR code. The link is also in the description of this video. There's a great way to help support the conference as well. Go ahead and check them out, and you won't regret it. There's a lot of great educators that I know here on the platform, and a lot of great lessons learned over on their channel. So you can tune into NinjaTrader Live for daily futures trading, real-time market coverage, and actionable strategies. And again, a huge thank you to Ninja Trader Live for helping make this conference possible. With that said, I also want to mention that for the first time ever, we're offering a free trial of Deepvue. Deepvue is our go-to screening and pretty much everything tool when it comes to analyzing stocks. You can create your own custom dashboard. You can run custom screens. We've got basically, probably well over 100 preset screens as well, based on different top trader methodologies. We also have fantastic custom indicators. Relative measured volatility is my personal favorite. That's the one I developed to help analyze price contractions and expansions, and basically find those breakouts in advance. So check us out if you haven't yet. This again is a 100% free, no credit card required free trial, but it ends July 27th. So make sure to go ahead and reserve yours today. And all you have to do is visit deepvue.com and follow a few instructions there. So again, deepvue.com for your free 30-day trial. Also, I do want to mention, because I know this question is going to come up at least a few times today, is this conference recorded? Yes, all the sessions are recorded. You can actually scroll back at any time on this stream and revisit any of the presentations that have already happened. So this URL is where you'd want to go to watch any of the replays. We'll add the timestamps to the presentations as well after it's done, so you'll be able to jump to the presentation that you'd like to access. But yes, all the sessions are recorded. And taking it one step further, we're actually combining all the different presentations as well as bonus resources, notes, and also the slides if you want access to those, over on TraderLion.com with the free VIP pass. Again, this is 100% free. And not only do you get access to this year's conference, but also you get access to all the prior conferences as well. This is the 5th one that we're doing. So to access all of that, what you want to do is scan the QR code right here, or click the link in the description, and basically you get free access right away. So definitely go ahead and do this. This is the way to get the most out of the TraderLion conference experience. And not only do you get access to all those resources, but you also are automatically entered for a free giveaway of a TraderLion Masterclass or annual Deepvue membership every single day of the conference. So you don't want to miss that. And we'll announce those winners via email each day. So with that, definitely go ahead and scan that QR code and basically get your free VIP pass. All right, moving on. I also want to mention that we just published the Trader's Handbook. This is more than a year in the making. Here's a copy right now. So cool to finally be holding that, and even cooler to see the responses and feedback that you guys have given us as readers. We've got over 13,000 readers in just over a month. That's amazing. It's also rated 4.9 stars on Amazon with over 400 reviews. Again, great to see that amazing feedback, and so cool to see that so many of you guys are finding value in the book that we put tremendous work into. Not only do you get access to the book when you pick it up, but you also get access to the free Trader's Handbook educational course, which has a webinar with each chapter basically diving deeper into the concepts, providing additional examples. And some people learn best by reading. Some people, learn best by watching videos and webinars. That's how I personally love to learn. So if you want that added depth, again, that comes free with the book. And there's also bonus webinars on trading breakouts, pullbacks, additional setups, and there's also bonus resources and articles in there. So this is the Trader's Handbook. Highly recommend you pick it up. You can scan this QR code to grab yours. And here's a quick review from Mark Minervini, 2-time U.S. investing champion and author of Think and Trade Like a Champion and Trade Like a Stock Market Wizard. He says the Trader's Handbook is a comprehensive encyclopedia for investors interested in learning the ins and outs about technical analysis and the stock trading in general, packed with explanations, practical insights, and real-world examples. It also features a model book section showcasing historical stock market winners, highlighting their breakout points, key patterns, and notable price behavior. A great addition to any trader's library. So fantastic to hear that from Mark. And again, with the Trader's Handbook, the last chapter is a full model book of the biggest winners over the past 10 years. And in addition to that, in the educational course that you get free with the book, we have 5 additional model books covering pullbacks, covering IPOs, breakouts, and just fantastic additional resources. So definitely go ahead and check it out. And as a special surprise, we're doing a giveaway today to one watcher, viewer of the conference right now. So basically the rules are you're going to have to answer a question, and the first person to put the answer in the chat will win this copy of the Trader's Handbook. I'll sign it as well. And basically the question is, who was the third speaker of day one of the 2025 conference. So put your answer in the chat below, and we'll be in contact to let you know who wins and basically go ahead and send you your handbook. So again, who was the third speaker of yesterday's conference presentation? All right, with that said, let's keep on moving here. In addition to the book, some other highly recommended resources that are 100% free are the free course library, Ultimate Trading Guide, the podcast educational articles that are housed on TraderLion.com. You can visit, of course, our website to access those. We've got some amazing resources there that can really help you develop your process. Whether you're a swing trader or a position trader, we've got something great for you. And in addition to that, if you want to dive even deeper, you can go ahead and sign up to one of our TraderLion Masterclasses. These are fantastic. We spend an immense amount of time and energy making these the best learning experiences possible. We've got classes covering trading psychology, historical analysis, going deep into what creates a blueprint of a market winner. We've got contrarian futures trading. We've got Stan Weinstein himself teaching stage analysis. Oliver Kell, the U.S. investing champion record holder, teaching his swing trading system. So these are amazing. Highly recommend checking these out. And right now, during this conference and during this conference only, these are 30% off. So all of these masterclasses are 30% off. You can visit TraderLion.com/university to access those sales. And again, everything is 30% off. And if you're looking for your first one, you haven't taken any classes before, I recommend the Oliver Kell Swing Trade Masterclass. Helping create that definitely sped up my learning curve, and it was amazing getting to learn with Oliver every single day. And he spent an immense amount of time preparing the material. And basically all the webinars, we pretty much go 4 hours sharing an immense amount of detail, the nuances of how he developed and executes his trading system. So definitely check out that one if you're, just looking around and not quite sure which one to start with. I think this one is a great one, whether you're a swing or position trader. So with that said, let's keep on moving here. One more thing, again, we're making this conference 100% free. And as a thank you, if you're finding it helpful, if you've gotten at least one great takeaway from yesterday, and will get at least one great takeaway from today, which I know you will, please help pay it forward. And the way to do that is to basically go ahead and donate at least $1 to St. Jude. We'll be matching today again. The number of likes will be the number that we contribute, but we want you to do your part as well. So if you're finding value in the conference, go ahead and donate. You can find the place to do that below the stream or potentially to the right. And it's very easy to do. Even $1 is great. Again, if you're finding any value in this, please go ahead and do that as a thank you. And it's to a great cause. We take no cut of these donations. YouTube doesn't take a cut either. This is all going right to St. Jude to help cure childhood cancer and other maladies. So please go ahead and do that. Again, it's a great way to, support a great cause while you're learning here at the TraderLion Conference. So again, that's located down below or to the right of the streams. And a huge thank you in advance to everybody who donates. All right. In addition to that, we work really hard on this channel, not only to do this conference, but also to do the TraderLion podcast, feature webinars with market wizards. We've got educational tutorials. We did a full webinar series that goes along with this book, covering each of those chapters in depth. So if you're interested in learning more about trading, improving your skills, definitely go ahead and leave a like and subscribe. Basically, we're shooting for 200,000 subscribers this year. So you can help us achieve that milestone by clicking that button. It's 100% free, and you'll get access to amazing resources as they come out as we produce them. So thanks in advance. And yeah, definitely go ahead and click subscribe down below. All right. And with all that said, looking forward to a fantastic day 2. We've got a great lineup to present today. And hopefully you guys are enjoying this. Make sure you get your notebooks ready, and we'll be right back with the next presenter. Stay tuned. All right, welcome back, everybody. It's my honor to introduce the next speaker of the TraderLion conference, Morgan Housel. Morgan is a partner at the Collaborative Fund and the New York Times bestselling author of The Psychology of Money. As you know, many of the speakers at our conference are growth stock focused traders and investors. However, I strongly believe that the cornerstone of any successful participant in the markets is a proper foundation in financial literacy. As such, this is a presentation that I've been extremely excited for and one I believe can have a large impact on how we think about designing our investing and trading systems. Morgan, thank you so much for taking the time. Really looking forward to this and welcome.
Thank you so much for having me. It's an honor to be here. What I want to talk to you about in this presentation is the psychology of money. And I'll tell you what that means. It means I'm not going to lecture you about where I think the stock market's going to go next, or what the best trading strategies are, or what's going on in the economy. That's never been my strong suit. But I've always been very interested in what is going on inside people's heads when they're making decisions with money. Risk and greed and fear. And I'll tell you a little bit about where I started becoming interested in this topic. I started as a financial writer in 2008. It was an interesting time to be writing about the financial world because that was, of course, the great financial crisis. The world was melting down. And I spent my early years as a financial writer, as an investing writer, just trying to answer the question, what happened in 2008? What happened during the crash? What happened during the bubble that preceded it? How do you explain what went on in financial markets? That's all I wanted to explain. A very simple question. And I realized as the years went on, that if you're trying to explain that very simple question and answer that question of what happened in 2008, you could not answer it through the lens of a finance textbook or an economics textbook. There was just really nothing in traditional finance and economics that could have explained why 2008 happened. It's really not in there. But if you were looking at 2008 through the lens of psychology, like greed and fear, or keeping up with the Joneses, which is like sociology, or the politics that played a role in all the rules and regulations, those could explain what was happening. Like there were all these answers where there was a blind spot in finance and economics and all these other fields that had nothing to do with investing, had nothing to do with trading, nothing to do with the economy, could explain where finance and economics left a hole. And so that to me just kind of opened up this idea that doing well with money and doing well in investing is not the study of finance. Investing is really the study of how people behave with money. It's about behavior. And behavior is so much broader than finance and economics. And there's so much that we can learn from all these other fields that have nothing to do with investing, have nothing to do with trading, nothing to do with economics. They have to do with behavior. And when you realize how important behavior is to investing and managing money, you realize how much you can learn from fields that have nothing to do with money. And so what I want to do with you now is share with you 3 stories, none of which have anything to do with investing, none of which have anything to do with money or business or economics. They all have to do with behavior. And as I hope you'll see, they have a very strong takeaway about how we can make better decisions with our money, with our investments, once we learn these lessons. So the first story that I want to talk to you about today is what I call the most valuable financial asset is not needing to impress anybody. And like I said, this story has nothing to do with investing or economics. This is a story about a boat race that took place in London in the 1960s. And the story begins back in 1968 when the Sunday Times newspaper in London wanted to drum up a little bit of attention for itself, wanted to get a little bit of publicity. And so it hosted this round-the-world boat race. And the race was the first person who can sail around the world solo and nonstop will win 5,000 pounds. And they called this a race, but that was kind of a misnomer because nobody in human history had ever sailed around the world solo nonstop. And so the first person to merely finish this race is literally going to be crowned the greatest sailor of all time. 12 sailors signed up for this race. Only one of them finished. It took them 390 days to sail around the world. But it was a story of 2 of the sailors who did not finish, who failed to finish, who had by far the most interesting stories in this race. The first one is this guy right here. His name is Donald Crowhurst. Donald Crowhurst was a 38-year-old British sailor during this race. And 2 very important things to know about Donald Crowhurst during this race. One was that he had kind of been a failure at everything he had attempted in his adult professional life. He was kicked out of the Army for insubordination. He then joined the Air Force, where he was very quickly kicked out for insubordination. He then started his own sailing business, which very quickly went bankrupt. And he kind of viewed this race as like his last shot at redemption, his last shot to show the world that he was worthy of their attention. A very important point for this race. The second important thing to know about Donald Crowhurst in this race was that he was a terrible sailor. He had really no idea what he was doing here. He was at best like a weekend warrior sailor. He actually built his own sailboat for this race, as you see here. And if you're wondering whether he was an expert shipbuilder to build a ship that can sail around the world, no, he was not that either. But he tried his hardest. And to his credit, after he set sail in October of 1968, he made it pretty far. After 6 months at sea, he made it about halfway down the coast of Africa, which is pretty darn good for a guy who doesn't know what he's doing. And then at this point, his boat springs a leak. His homemade boat that he literally slapped together in his backyard springs a leak. It's not that bad of a leak. He can bail it out with a bucket. But he knows that if he keeps sailing down into the southern Atlantic, where the waves get very rough that time of year, his damaged boat's not going to make it. And so now he's contemplating his options in his diary. Kept a very extensive diary during this voyage. And he realizes that he has two options. He can turn around and go home and face shame and humiliation for failing at yet another activity, or he can keep sailing, in which his boat's probably not going to make it. And then after pondering these two options in his diary, he realizes that there's actually a third option available to him here, which was outright fraud and deceit. After 6 months at sea, he turned his boat around and he basically sailed smack dab into the middle of the Atlantic Ocean, where it was nice and calm and placid, and he sat here drifting aimlessly in circles by himself for 6 months. All the while he was doing this, he was sending fake radio coordinates back to England to make it seem like he was still sailing around the world. So he would radio home to England and say, oh, I'm passing the Horn of Africa. I'm passing around Fiji and New Zealand, to make it seem like he was still sailing. It was all a lie. He was drifting aimlessly in the middle of the Atlantic. What he wanted to do was to kill enough time aimlessly drifting around in circles here to make it seem like he could have plausibly sailed around the world. And then he was going to sail back to England with his dignity intact. That was his plan. And after sitting here for 6 months, again, alone by himself, how torturous that would be, he starts heading back to England to go home. And he realizes that he has made a critical little error in this scheme of his, which is that all of the other sailors were taking so long to finish the race that Donald Crowhurst was going to come home to America as the winner of this race. And you might think that would be great. That's amazing. But he realizes this is a catastrophe because everybody back in England was already skeptical that this supposed amateur was making so much progress and about to win the race. And he knows he's going to get so much attention from the press and the sailing community that they're going to dig through his logbooks. They're going to uncover this little scheme, and it's all going to be over for him. So now he knows the gig is up. This plan he's been hashing for 6 months doesn't work. And he realizes that it's over for him. He writes in his diary that, quote, I have no need to prolong the game. It has been a good game that must be ended. It is the end of my game. The truth has been revealed. He later writes in his diary, this is the actual diary entry. He writes, quote, it is finished. It is finished. It is the mercy. Now, just after he wrote this diary entry, he sent his last fake radio coordinates back to England, and he shut his radio off. 10 days later, a group of commercial fishermen found Donald Crowhurst's boat adrift in the Atlantic, and they went up to investigate. Like, what's this boat just drifting around doing here? And when they got up to his boat, they realized that there was no sign of any damage, there was no sign of any accident, and there was no sign of Donald Crowhurst. And he was never seen ever again. And nobody will know what his last moments were like, but the accepted version, almost certainly what happened here, was that realizing that this gig of his was up, he threw himself into the sea and took his own life. And that was the end of Donald Crowhurst. And now at the very moment this was happening, another sailor in the race, a French sailor named Bernard Moitessier, was sailing around the world. And unlike Donald Crowhurst, he truly was one of the greatest sailors in the world. This guy had been on a boat basically his entire life. And after about 9 months at sea, he had actually sailed around the world by himself, and he was making a beeline back for England, and he was going to win the race. And you too might think that would be amazing. This is every guy's dream, is about to be crowned the greatest sailor in the world. But something really started to bother Bernard Moitessier when he contemplated getting back to England. And that is that Bernard Moitessier was just a sailor. He loved being at sea, alone, by himself, with the breeze in his face, and he hated the commercialization of his sport. He hated the idea that, particularly at this moment, he felt like he was a prop of the sponsors and the press, and that he was performing for other people rather than just being at sea alone, which is what he liked to do. And so he also kept a very extensive diary. And when he was contemplating getting back to Europe, he wrote, quote, "I really feel sick at the thought of getting back to Europe, back to the snake pit. I am fed up with the false gods always lying in wait, spider-like, eating our liver, sucking our marrow. The modern world is the monster trampling the soul of men." So not a lot of nuance in how this guy felt at this point. He's just fed up with it. He also wrote in his diary, quote, make money. To do what? To change your car when it is still going well? To dress decently? To pay an exorbitant rent? Pushed, forced, ordered about by the false gods?" That's the life he thought was awaiting him back in Europe, and he wanted nothing to do with it. And so at this moment, he made a decision that was almost equally as incredible as what Donald Crowhurst did. Bernard Moitessier saw another boat out in the distance, and he shot up a flare from his flare gun, which is the sign of like, hey, I need your help. Come help me. That boat sailed right up next to him, and Bernard Moitessier handed him a letter and told the other boat to please take the letter back to England. And that letter was addressed to the newspaper editor who was hosting the race. And that letter said, quote, "Dear Robert, today is March 18th. I am continuing nonstop towards the Pacific Islands because I am happy at sea and perhaps to save my soul." He then quit the race that he was just about to win, turned his boat around and set sail for Tahiti, where he landed about 3 months later. And I swear this is true. You can look it up. Built his own house on the beach, married a local woman, had 3 kids, and lived happily ever after. It's like one of the most amazing stories that I know of somebody who thought they had everything, all the success that they wanted in front of them. But once they realized they were just performing for other people, they stopped and said, well, what am I doing this for? I just want to do what makes me happy. He just wanted to live the life that he wanted to live. He could not care what anyone else thought of him. And so this is where you might be wondering what any of this has to do with money. And I actually think the answer is a lot, that this is a very telling story to explain something fundamental with money. And it's this. Donald Crowhurst wanted nothing more than other people's attention in life. That's all he wanted, was for people, even strangers, to look at him and say, you're great, you're amazing, you're so successful, you're so talented. All he wanted. Bernard Moitessier could not have been more polar opposite. He was disgusted at the idea of living a life for the attention and the applause and the appearance of other people. All he wanted to do was do what made him happy, which was being alone on a sailboat by himself. Maybe that's what not makes you or I happy, but that's what made him happy. And I think what's important is that every decision that we have when we're spending money, every single dollar that we spend, is always one of those two things, the internal versus the external benchmark. Are you spending money, and is your aspiration for more money because you want to impress other people, or because you want to use it as a tool to actually make yourself happier? It's always one of those two things. And I would summarize it like this. There are two ways to use money. One is as a tool to live a better life. The other is as a yardstick of status to measure yourself against others. Bernard Moitessier was using his skill, his sailing, as a tool to live a better life. Donald Crowhurst just wanted it as a yardstick of status. And I think the irony with money these days is that most of us aspire to live a life that is closer to Bernard Moitessier. Like most of us aspire to live a life where we're like, hey, I'm just doing things because they make me happy. Not for the applause or for the attention, but because I like doing them. But so much of the modern economy is geared towards a life that resembles something much closer to Donald Crowhurst. Attention, applause. And maybe there's not much wrong with that. Like, I'm sure there's things that I do. You know, I desperately want the admiration and attention of my wife and my kids and my parents and some of my friends. But when you frame every purchase as internal versus external benchmark, so many of the hardest financial problems that we face with, including even our aspiration for more money, come into a clearer light. It's always one of these two things. And I would challenge you, whenever you're spending money or thinking about what your financial goals are, to always take a step back and ask, are you doing this for the attention of other people? Or are you going to use this money as a tool to actually make your life better? All right, that's the first story I got for you. Second story, moving right along here. This is what I call the fastest way to get rich is to go slow. And this too has absolutely nothing to do with money or investing or economics. It's a story about trees. Now, most trees in nature begin their life like this, as a tiny little sapling beneath the shade of other bigger trees, their mother tree that dropped the seed. And the fact that they're covered by shade is very important here. This is how nature is supposed to work, because when a young tree is covered by shade, it doesn't get a lot of sunlight. And when it doesn't get a lot of sunlight, it grows very slow. And that's important because a tree that's growing slowly has a chance to grow a very thick and established core and thick and dense root structure because it's growing slow. It has the chance to grow strong. But what happens if you plant a seed out in the middle of a field like this? Almost always, this is like a farm when a seed just finds its way to the middle of an open field. This young tree can gorge on as much sunlight as it wants. And because of that, it grows very, very quickly. A tree in this situation can literally grow 10 times as fast as a tree that's covered by shade and other trees. And you might think that would be great. And if you're a farmer, something like this is really great. It's growing so fast. But a tree that grows this quickly never has a chance to grow thick and dense and a strong root structure. And so the arborists who I stole this idea from, they summed it up so well. They wrote, quote, "A tree that grows quickly rots quickly and therefore never has a chance to grow old." And this is actually something that you see very often in nature, is that when you speed up the growth of something, it's fun, it's exciting, it's cool to watch, and it always comes at the expense of durability. One other area that you see this in nature is with fish and basically anything that is growing. Several years ago, a group of researchers did a study on a group of goldfish. And what they did is they took two groups of identical goldfish. They took one group and they put it in a bucket of abnormally cold water that slows down its metabolism and it grows very slow. The other group they put in warm water, speeds up their metabolism, they grow very quickly. And then they just watched and saw what happened to these fish. And it was just like the trees. The fish that grew slowly went on to have abnormally long lives. The fish that grew very fast, faster than normal, died faster than normal. And these biologists, they also summed it up very well too. They said, quote, "You might expect a machine built in haste to fail quicker than one put together carefully and methodically. And our studies suggest this might be true for bodies too." Anywhere you look in nature, when you speed up the growth of something, it's fun, it's exciting, it comes at the expense of durability. And I'm telling you, that also happens as strongly as it does in nature with investors. And I'll show you what I mean. If I show you this guy's picture, I don't even need to ask you. Everybody knows who this is. Warren Buffett, greatest investor of all time. Don't even need to go through any more details. You know who he is. If I show you a picture of this gentleman, I'm willing to bet that virtually nobody on this call knows who this gentleman is. And even if I say his name, Rick Guerin, I'm willing to bet that most of you active, educated, experienced investors have never heard of Rick Guerin. And that is what is so interesting about Rick Guerin, because there is an alternative history in which Rick Guerin could have been and should have been one of the greatest, richest investors of all time. And the fact that he's not is, I think, an incredible story. And that story begins back in Omaha, Nebraska in the 1960s, when there were three investors who were inseparable best friends who made all of their investments together. They bought all their stocks together, did all of their research together. Those investors were Warren Buffett, Charlie Munger, and Rick Guerin. Rick was just as much a part of the early days of Berkshire Hathaway as Warren and Charlie were. In fact, some of Berkshire Hathaway's most famous investments, like See's Candy, that was all Rick. Like, he found the company, he diligenced it, he interviewed the CEO. He was a big part of Berkshire Hathaway in the early days. And then unless you were like a hardcore value investor, you pretty much never heard of Rick ever again. He kind of fell off the map. And so about 10 years ago, a hedge fund manager was having dinner with Warren Buffett, and he said, "Hey, what the heck happened to Rick? His fingerprints are all over the early days of Berkshire Hathaway, and then he disappears. What happened to the guy?" And Warren told the story of what happened to Rick Guerin, which is that Warren Charlie and Rick made all of their investments together. They always bought the same stocks. They were a trio. They were business partners. Rick did one thing differently, which is he invested very heavily on margin. And in the 1974 bear market, he got wiped out. As I'm sure you know, when you get a margin call, you have two options. You can put up more collateral, more cash, or your broker liquidates you. That's what happened to Rick. He got liquidated of virtually all of the Berkshire Hathaway stock that he owned. And here's the interesting part that I think you'll appreciate. The buyer of that stock in this liquidation was Warren Buffett, who accumulated the stock that Rick Guerin was getting liquidated on. And Warren had this incredible quote to summarize what happened here that I thought was so amazing. He said, quote, "Charlie Munger and I always knew that we would become incredibly wealthy. We were not in a hurry to get wealthy. We knew it would happen. Rick was just as smart as us, but he was in a hurry." And look, folks, I think of all the well-worn Warren Buffett quotes that get repeated ad nauseum that we all know, that last one that is not very well known, I think is the most important thing he's ever said. Rick was just as smart as us, but he was in a hurry. He was just as talented. He had the same skills, the same analytical ability, same pattern recognition, but he was in a hurry. I don't think it's an exaggeration to say that someone like Warren Buffett has intentionally gone through his life at 70% of his potential on purpose, because he didn't want to speed up growth, because he knew that just like the trees and the goldfish, when you speed up the growth of something, it comes at the expense of durability. And durability is the only thing that matters in investing over time. Not how much you earn this quarter or this month or this year, but can you keep it going for the next 10, 20, 30 years? That's how you actually make wealth in this business, of course. I think the most important investing question is not, what are the highest returns that I can earn? The knee-jerk reaction is that that's the question that you want to answer, that everybody's trying to answer. But I don't think that's the most important question. I think by far the more important question is, what are the best returns that I can sustain for the longest period of time? What can I keep going for? What is not going to come at the expense of my endurance and durability over time? That's what's so important in this in this industry. It's so simple when you frame it like that. This seems like a kindergarten thing to point out, but it is so easy to ignore, even by some of the greatest traders of all time. One other way that I framed that before is, look, average returns for an above average period of time can lead to magic. And look, I'm not an indexing zealot and saying that everybody should. I don't believe that at all. And so, of course, the other side of this equation is above average returns for an above average period of time leads to like magic squared or whatever. The important thing to know is that in the equation of how well you're going to do in your investing career, the metric that matters more than anything else is how long can you do it for? And earning lower returns for a longer period of time is going to generate more wealth for you than earning higher returns for a shorter period of time. So basic, so obvious. And I know there's more to investing and there's more to the time value of money than that, but it's so easy to ignore how important it is to focus on endurance and longevity when you are investing. No matter how you're investing, whether it is trading or long-term investing or passive investing, doesn't matter. This always applies to everybody. All right, moving on. Last story here for you. This is what I call is the most important financial skill is to get the goalpost to stop moving. And this too, like I said, like all the others, has nothing to do with business or investing. It's a story about this guy right here. And you'll probably recognize this guy too. This is Stephen Hawking, one of the smartest people to walk this planet over the last century. I don't think that's hyperbole. He was just an absolute genius savant at understanding the universe and astrophysics, and he could explain it to lay people in a way that was so easy to understand. And a quirk of Stephen Hawking, of course, is that he had a motor neuron disease and he was paralyzed head to toe. He had absolutely no control over his body, of course. He spoke through a computer. And he was not born like this. He was born a perfectly healthy, able-bodied child. He was actually an athlete in college. He was on the crew team at Cambridge. And he became afflicted with this disease at age 21. And he kind of lost control over his body shortly after that. And several years before he died, he did an interview with the New York Times. And in the interview, he was talking about how happy he was and how amazing his life was and how he just loved waking up every morning and getting able to do the research. Kind of an interesting mindset from a guy whose life ended up like this. Like if there's any of us who have the right to complain about their life, it's somebody who ended up completely paralyzed head to toe and in a wheelchair. But it was the opposite. he was like one of the happiest guys they had ever interviewed. And so the New York Times asked him, they said, seriously, what is your secret to happiness? And I loved his answer to that question. He said, quote, my expectations were reduced to 0 when I was 21. Everything else since then has been a bonus. And that idea that however much benefit you get out of anything in life, it's not your circumstances that generate happiness. It's the gap between your circumstances and your expectations that make the biggest difference. That's a pretty important idea that I think applies to a lot of areas in life, but especially, maybe more than anything, how we think about money. And I'll show you what I mean. If you ask most Americans, when was the greatest decade economically in the history of this country? Overwhelmingly, people point to one decade as the peak of middle-class Americana prosperity, and that was the 1950s. This is what we remember today as like the peak of economic middle-class prosperity. And what's interesting is that not only do we remember it today, but we knew it at the time that the 1950s were like this extraordinary period of growth and prosperity. Life magazine, where I stole this picture from, they wrote in 1953 that the present and immediate future seem astonishingly good. The country has just lived through what was economically the greatest year in its history. Nobody talks like that anymore. Nobody would ever say something like that about today's economy. You would be laughed out of the room if you said something like that. But that's what people felt back then. And it was obvious to people back then that that was true. And what's amazing to me about the nostalgia that we have today for this period, the 1950s, is how easy it is to show with data that things were not that great back then. That actually most Americans, not everybody, but most Americans are actually not only better off, but way better off today than they were back then during the supposed golden era. I'll show you what I mean. If you go back to the 1950s, in 1955, the median household adjusted for inflation, real median household income was about $29,000 per year. That's adjusted for inflation. By 1965, that was about $42,000 per year. And in more recent years, it's approaching $70,000 per year. Again, because so many people push back on it, that is adjusted for inflation. Now, some of what is going on here is that there are more workers per household today because of the rise in the female participation rate. But that's only a small part of what's going on in this chart. If you look at average hourly wages adjusted for inflation, they are roughly double today what they were back in the supposed golden era. And if you keep going on down the list of what it was like back then, I think you'll see something very similar. The average new house in the 1950s was almost 40% smaller than the average new house is today. The average new house in the 1950s had one bathroom for 4 people. Today we have an average of 3 bathrooms for 2 people. Maybe that's what our progress looks like these days. Food took up an average of about a third of the average household's budget compared to the less than 13% today. Workplace desks were 3 times higher in the 50s than there are today. And back in the 1950s, more than half of men over age 65 were still working, compared with well less than a quarter today. Most people in the 1950s worked until you died. That was the expectation. That was the reality. The idea that you would have a dignified retirement where you could not work for years or even decades would have sounded preposterous to most people in the 1950s. It just wasn't on people's minds. And so I think if you keep going down the list of what it was like back then, you get something like this. Virtually any way you spin it, not only are most people, not everybody, but most people better off, but much better off today than they were back then. And then you have to ask the question, why the nostalgia? Why do we remember it as such a great period if statistically it wasn't? And there could be a lot of answers to that question. This is not a black and white thing. You could write volumes of books about this topic. One of the obvious was the 2 decades that preceded the 1950s were the Great Depression and World War II. And so any amount of peace and stability and prosperity felt amazing just by comparison. That's a big part of what's going on. But there's also something that I think is really important psychologically, and it's this. The 1950s and the first half of the 1960s were a very unique period in Western history because for a short period of time, more than any period before or since, there was very little wealth inequality. Just the gap between rich and poor got very narrow for a couple of years. Part of that was just an echo of World War II, of how companies were managed and how compensation was managed. And the top marginal tax rate was 91% in the 1950s. And so for better or worse, I'm not saying that was a better way to run the economy, but for better or worse, it did something to people's psychology. And that is this. There is no such thing as an objective measure of wealth. Everything is just relative to what is what you have relative to other people. And in the 1950s, when there were no CEOs making $100 million a year, there were no billionaire hedge fund managers, there were no athletes with $100 million contracts. Most people, most Americans, when they were measuring themselves relative to other people, when they were looking around town at their neighbors and their coworkers, looked at other people and said, I'm doing pretty well compared to that family. Relative to them, I have about as much as they do. I'm doing pretty well. And so the smaller paychecks felt fine because everybody else was earning a smaller paycheck. And their smaller houses felt fine because everybody else was living in a smaller house. Going camping for your annual vacation felt cool because that's what everybody else did. And so for better or worse, it was an era where it was easy to keep your expectations in check. And I think to grossly generalize what's happened over the last 80 years, yes, our incomes have doubled, as I just showed you. Our houses have gotten bigger, but our expectations have grown by even more. Because now we're anchoring our expectations to a very small sliver of society who's doing extremely well financially. And social media just takes this like to the next level where now you're not comparing yourself to your neighbors and your coworkers. You're comparing yourself to a curated highlight reel of everyone's supposed wealth and happiness and glitz and glamour. And so it's harder than ever to keep your expectations in check. And so the takeaway from this that I think is so important is that if your expectations grow faster than your income, you will never be happy with your money. This is like an iron rule of finance that has to be obeyed no matter how much money you make. There is no upper limit on how much money you can make, and this doesn't apply to you. That all wealth is a two-part equation. Yes, you need to grow your wealth, grow your net worth. That's important. But then you have to, with as much emphasis, keep your expectations in check if you want to have any value or joy out of that money. This is so important. And I'll tell you a little story about what happens when you don't do this. Every one of you, of course, recognize this schmuck here, Bernie Madoff, biggest financial fraudster of all time. You know his story. One of the most incredible parts of the Madoff saga that was almost completely unreported when he was caught in 2008 is that if you go back to the early 1980s, before Madoff started his Ponzi scheme, he was earning, by some accounts, $20 million a year from the legitimate side of his business. Not from his Ponzi scheme, from his real life as a market maker on Wall Street. He was one of the most talented market makers on Wall Street. He was earning, by some accounts, $20 million per year. Honestly, one of the most successful businessmen in America, and it was not a fraud. It was legitimate. What is so astounding to me about that success and that wealth that he had back then was that despite that success, he wanted more money so badly that he was willing to start this fraud that ruined everything for him. And look, if you are broke and you have a hungry child and you rob a grocery store, I can wrap my head around why somebody would do that. I can wrap my head around that crime. But when you have more money than you could ever spend, and you still reach for more so greatly that you do something like he did, I think that's astounding. And here's what's incredible. Of course, he is the most extreme example of this, and he was a sociopath. But all of us have a little bit of this in us. And the innocent way that this plays out is hopefully not that you start a Ponzi scheme, of course. The innocent way that this happens to so many good law-abiding people when they don't feel like they have enough money and they want more so badly is that they take more risk until it blows up in their face. Or in their career, they have more ambition. They work longer hours until they realize their children don't even know who they are. There are so many like innocent versions of this, of people who can't keep their expectations in check and they keep reaching for more and more and more until it backfires. One little last quick detail on this. Many years ago, two famous authors, Kurt Vonnegut and Joseph Heller, were having lunch at the house of a hedge fund manager in the Hamptons. And Kurt Vonnegut said, "Joe, do you know that the hedge fund manager who owns this house will make more money this month than you have ever earned in your entire life?" And Joseph Heller said, "That might be true, but I have something that the hedge fund manager will never have, and that is enough money." This word, enough, I think might be the most important word that exists in finance. Like the most important word that exists in finance is not risk, it's not leverage, it's not return, it's enough. And I think the reason why is because, well, first let me say, having enough does not mean that you have no aspirations for more. I want more money. Of course, you do. Everybody does. It just means that if you don't manage your expectations with as much emphasis as you do managing your circumstances, it's never going to feel like it's enough. And if it's never going to feel like it's enough, it's eventually going to catch up with you, and you're going to learn about it the hard way. And so look, to wrap this up, I think if there's a common denominator of these stories in behavioral finance, it's that when investors think about risk, they usually think about what's going to happen to them. What's the stock market going to do to me? What's the economy going to do to me? A much better way to think about risk, I think, is what we do to ourselves. It's our own biases, our own impatience, our own misconceptions of the world that do the most damage to investors by far. And that's actually a very optimistic realization, because you have no control over what the stock market is going to do next. You have no control over what the economy is going to do next. The only thing that you can control as an investor are your own behaviors. And when you realize how important behavior is to your success as an investor, that's actually very optimistic. I'm going to end this presentation here, but thank you so much for listening to me. And I think we have some time for some questions now.
Excellent. Well, Morgan, thank you so much for running through that. Definitely some food for thought there. I want to start with a few questions about the first story about the boat race, which I thought was fantastic. Funny enough, my first takeaway from that is that people were such better writers back then, so dramatic in their journal writing and all that. Both those folks. But I think it's so true, and it shows the contrast between valuing what people think about you, making moves towards that regard, and also, intrinsic motivation as well. I think that's perfect. And what struck me is that both of those sailors made those realizations after long times away from other people, where they're doing obviously a lot of reflection. They're by themselves. I wanted to ask you if you have any frameworks or exercises you do to stay on the right track. Maybe you do something yearly to think about, what are my motivations? What are my goals? Why do I want this goal? Why do I want to achieve this? So any things you'd like to do to basically help reflect and help guide that reflection as well?
It's a very imperfect exercise, but the one that I think about the most is asking the question, if nobody could see me, what kind of life would I want to live? Or I've often framed it as if I lived on a deserted island with maybe my wife and kids, but no one else could see me, and I had unlimited money. I could live any lifestyle that I wanted, but nobody could see it. What lifestyle would I want to live? And the truth is, if nobody could see what kind of car you drove, you probably wouldn't want a Lamborghini. You would probably want a pickup truck. If nobody could see your house, you probably would not want it to be 25,000 square feet. That's just a burden that no one can live in that big. If nobody could see your clothes, you would want comfort. You would want and utility. You would not want style. In that situation, you would automatically lean towards utility over status. And look, that's an imperfect exercise, because some people are watching you, your coworkers and whatnot. But I think everybody, me, you, everybody, we all overestimate how much other people are paying attention. The truth almost is always that nobody is thinking about you as much as you are. And the reason is that they're too busy thinking about themselves. So nobody cares what kind of car you're driving, because they're too busy worried about their own car. Nobody cares what clothes you're wearing. They're busy worrying whether about you like their clothes are paying attention. Like everyone, even the most humble people, I think, get very kind of egocentric in their thoughts. And there's so much natural thought. It makes sense that people have these thoughts, because in many ways, life is a competition for resources. We're competing against each other for opportunities and friends and jobs and whatnot. But the truth is that most people are too busy worrying about themselves to even care what you're doing. I think that is a very relieving thought to come to terms with, because then it pushes you naturally towards utility, what actually makes me happy. And the truth, like for me, for my own life, I think it's different for everybody, but I think this is close to universal. What I want out of money is not a bigger house or a faster car or shinier jewelry. I want independence. I want to wake up every morning and say, I can do whatever the hell I want today. I can do whatever I want for as long as I want with whom I want. And that's what I'm going to use all my money for. And that's always the goal. And I don't care what kind of car I'm driving, because you're not even paying attention to it. You're not looking at it. And so I think that that's a very imperfect framework, but it's one that I think about a lot. If nobody was watching, what kind of life would I live? Because the truth is, almost nobody is watching.
Do you think that's more important to think about for really big purchases versus smaller ones day to day? Obviously, the small ones can add up and all that, but yeah, just your perspective on, is that more important when thinking about buying a car or especially, a house, the major purchases versus, buying lunch out at work versus, bringing something from home?
Yeah, it's interesting. It's probably the bigger purchases, and there's a couple that I've thought about in the last couple of weeks that these are not criticisms at all, because I would have done this at this age too. But you see it very often when a high school senior gets their college admission letter. One of the biggest moments of your life. It's amazing. You worked so hard. You deserve that success. But one of the very first things that they all do is post on social media. Again, not a criticism, because I would do the same thing and they should be proud of their success. But it is interesting that in that situation, one of the first things that you want to do is tell other people and get their applause and get their approval for it. I'll tell you, here's my own confession. When I got engaged, I'll date myself. This was 2010 when I proposed to my now wife. One of the first things that I did was updated my Facebook status, your relationship status, which is a thing you did back then. I wanted other people to know immediately. And so I think it's a very natural thing to do. But even these things that should be very intrinsic, they should be like, I'm doing this for me, for my own education, for my own enlightenment, for my own future job opportunities. We can't wait to show other people. And I think it's true for the house that you buy, the car that you drive. And it's big. Most of those, I think most smaller purchases tend to actually be things that you enjoy. If you go to Chipotle and get a burrito with guacamole, that's not to show off. That's because it tastes good. Tastes good. Yeah. It's the bigger things that you're trying to do for a social aspiration status reason.
Perfect. Getting to the second story, the analogy about the tree, I think that's so true. And one of the key takeaways and great concepts that you share in your book, The Psychology of Money, is designing an investing process, whatever it is, whether you're a trader, whether you're an investor, whatever it is, and a focus on it being reasonable and realistic versus mathematically the most optimized, highest return, whatever. Do you mind sharing a little bit more about that concept? And you have some good examples in your book about, why that's the most important thing to think about as you're, building a process over time.
Yeah. The example that I use in Psychology of Money is when you get sick and you get a fever, technically speaking, rationally speaking, that's a good thing. A fever is your body's, it helps your body fight infection. You should welcome a fever. That's a good thing. Nobody welcomes a fever, even doctors. And even if you are at a hospital surrounded by doctors, they will immediately give you Tylenol or Advil to get rid of your fever. And the reason, even if a fever is good and it's helping your body, the reason they do that is because fevers hurt. They're no fun. They're uncomfortable. And if there's a pill that I can take to get rid of this discomfort, please give me that pill, even if it's helping my body. Fevers are rational. They're not reasonable. Most people just want to be comfortable. And I think that that's an analogy for a lot of things in life, because there are lots of things that we do with our money that are rational, but they're not really reasonable. And we should stop pretending that we are all just rational spreadsheets, because we're not. We just like a sick patient, we want to be comfortable. We want to do things that are not perfectly rational, but they help us sleep at night. They fit our unique personalities, whatever it might be. I'll tell you a really common one in investing. There's a very well-known documented bias all over the world called the home bias, which very roughly says that U.S. investors only own U.S. stocks. German investors only own German stocks. Japanese investors only own Japanese stocks. It's not rational at all that the stocks that you own are the ones that are located closest to your house.
Right.
Like that doesn't make any sense whatsoever. But it's actually very reasonable to want to own stocks that are located close to your house, because if taking the leap of faith of owning these stocks, particularly if you're a long-term investor, that you're familiar with them, the products that you use, your friends work at these companies, that's actually very reasonable, even if it's not rational at all. And so there's lots of things I wrote in my book. I don't know if I regret sharing this, but we paid off our mortgage when we had a 3%, maybe it was 3.5%, 30-year fixed rate mortgage. That is not rational. I knew back then it wasn't rational. In hindsight, it really wasn't rational. But on a spreadsheet, I can't defend it at all. It was a dumb thing to do. But it was one of the best, it was the worst financial decision I've ever made, but one of the best money decisions that I've ever made, because it helped me sleep at night. We had a newborn child, and I love the security of knowing this house is ours now. It doesn't belong to the bank. And even when I tell that story, there are some people who are like, well, no. Like try to explain to me like why you like on a spreadsheet how you did. I'm like, no, it doesn't make any sense. I can't explain it at all. And I have absolutely no regrets whatsoever because I'm not a rational machine. I'm a imperfect, emotional, hormonal human, and so are you.
Yep.
And so that's I think a good goal with money is to aim to be reasonable, not unreasonable, but don't pretend that you can always be rational.
Yeah, and I think another example you shared in your book that stood out to me is I forget if it was like a Stanford or MIT study where they basically said mathematically it would produce the best retirement returns if when you opened a Roth IRA, you invested on 2x leverage, and when it went to zero, you just started over. And mathematically, it ends up being the best, but nobody can stomach the drop on, because of leverage. A normal drop, a normal bear market would wipe you out, and having to start completely from zero. So I think it's really important to think about what fits your life, what fits your goals, what fits your risk tolerance, what can you handle during a market correction. So because like you've said multiple times, whether you're trading or investing, it's a strategy that you can stick to and experience all the bull markets, all the upside of the US markets over the long term, over decades. That's going to be the best strategy over time. And if you can't stick with it, you're going to be pushed out of the game. So I think that's another good example that you shared.
Absolutely. Thank you.
Yeah. Also, one thing that was really cool from someone who I've worked with, John Boyk, he went back and studied a lot of the greatest investors and traders going back to the early 1900s, Bernard Baruch, Richard Wyckoff, William O'Neill, all the way up to more present folks. And he did this study basically and talked about how they developed their process. And there's a lot of failure going through all of them. But it took time. It took on average, I think 6 to 7 years before they finally broke even and started actually performing. So I think it's worth remembering as well as people are developing their process, whether it's investing or trading, that it's going to take time. And I think this goes back to the social media aspect that you're talking about. We live in an age of, if you're not performing, if you're not making money your first year, better forget it and never experience it again, or you should, go in on GME, GameStop, all of that. And I think how social media has impacted things is given this false impression about what success means in the markets, how quickly it takes. And everybody should remember that, especially when you're struggling in the beginning, because struggle is normal and what you're going to experience as you grow over time. Going to the third story that you talked about, I think that's excellent. And I think, I've heard this a few different places. Obviously Stephen Hawking's example about your baseline happiness, comparing people who won the lottery versus experienced, a crippling injury, losing a limb, something like that. And your baseline happiness 3 months later is right where it was, regardless of, the change in your physical capability or the change in your wealth based on, lottery winnings. So it's amazing to think about that. And I think the quote that you shared from Stephen Hawking was really excellent. And what I wanted to ask you, do you ever think about designing your perfect day and seeking to, get to that spot as much as possible and relive that over time? It's something I've been thinking about recently, how to pair what I love to do, my intrinsic motivations with obviously what I have to do with my job, my work, all of that. So I wanted to ask if you've thought about that at all, and what processes you've implemented to try to get closer to that, if you have.
One thing that I think is important with behavioral finance is that most of the evidence that we have is that money will make you happier. Having more money will make you happier if you're already a happy person.
Yeah.
If you start out as a sad, angry, miserable person, it will not. And if you already have a disposition towards depression or anger or whatever it might be, doubling your net worth is probably not going to do anything for you. It actually might backfire, because when you gain more money and your net worth goes up and you're still unhappy, you still have the same problems, then you start to lose hope. Like if you can have hope that money is going to make you happier, that can actually be a great feeling. But once you have more money and you're still sad, then you start to lose your hope. So in terms of what I do, it's interesting because we're recording this on a Monday, and I told my wife last night, Sunday night, I said that was one of the best weekends I've had in years. It was just a great weekend. We had family, friends, good weather, good food. Everyone was happy, and it was not planned at all. It just kind of happened. And there are so many times when people leave a vacation disappointed because they planned so heavily. Like their expectations of like they're going to Hawaii and their expectations are so high. And it probably was a good trip, but their expectations were so high that it just barely got met. I think part of what made my weekend so great, because we didn't do anything special. Just hung out with my kids. Like I didn't do anything special. But I think my expectations were low enough that on Sunday night, I was like, that was great. That was amazing. I love that weekend. I think that is a structure that I see a lot in my own life and other people's lives. It's like the harder they try, the more disappointed they're going to be. I've used this example several times of my late grandmother-in-law, my wife's grandmother. She lived for 30 years on nothing but $1,700 a month in Social Security. She had no other savings, no pension, $1,700 a month for 30 years. It's all she had. She lived the most humble, simple life you can possibly imagine. She was happier than any billionaire I've ever met. She woke up smiling. She was the most joyful, genuinely happy person because she lived this incredibly Spartan life, but that's all she wanted. I truly think that she made $1,700 a month. She did not desire $1,701. She did not want that. And because she had no gap between, or no, she had a wide gap between expectations and circumstances, it was great. And I know, I'm sure you know, people who make, lots and lots of money per month, whatever it might be, but they want a little bit more. And those people are always going to be less happy than my late grandmother-in-law. I should say that I'm glad that those ambitious people exist because the root of all technological progress is the fact that successful people wake up in the morning and say, it's not enough. I need more. We have to get better. We have to make better products. That's why we have progress. So in general, it's a great thing. But at the individual level, it's such a stark example. And Elon Musk gave an interview, I think it was 2 or 3 years ago now, where he was like, you might think you want to be me, as in the richest man in the world, but he's like, you don't. And he pointed to his head and he's like, it's a storm up here. It's a battle up here.
I'm sure.
And I think that is true for a lot of those people. That I think if you were to actually look at who is the happiest, it's a middle-class person with a great family and good health, and they sleep 8 hours a night, and they go for walks, and they exercise, and they have their friends over for a barbecue. And if you actually wanted to detail some of the most unhappy people, a lot would be at the very bottom, people who have food insecurity and homelessness and whatnot. A lot of them, though, you would see are people who are actually near the top. And that's always been fascinating to me.
Yeah. And one thing that I remember from your book that stood out is I think you talked about how back maybe in the golden age, the 1950s, a lot of the jobs had to do, you could leave your job at the workplace because maybe it was something you did more with your hands or whatever. But nowadays, a lot of it is obviously much more white collar, and the tool you're using is your mind, and you can't turn off your mind. So you're always thinking about the marketing campaign that you have to plan or all of this. How do you think the career we have impacts our happiness, and what can people do to, try to get that separation to just be a little bit happier and recognize that can impact things, and just to get a little bit better, I guess, with creating that separation?
I mean, it's very generic advice, but everyone knows the follow your passion. I think follow your passion is generally poor advice because I think it was Scott Galloway who pointed out, like, anyone who says follow your passion already made their money in iron ore, steel smelting or something. Like they've already made their money in something that was not their passion. So now they say, go follow your passion. So I think in general, it's bad advice, but I think it tends to be true that a lot of the jobs that we have these days, more so than previous eras, are unfulfilling. That back when someone was building a ship, building a house, building a highway, that you got more of a tangible view that you were making a difference in the world than if you are a first-year analyst moving papers around.
Updating a spreadsheet.
There's a very good book. It started out as a very good essay, and both the book and the essay are titled Bullshit Jobs. And they document kind of the rise in a lot of the white-collar jobs that are probably unnecessary, are not fulfilling. Like, you clock in and you get a salary and benefits, but you're not really doing a difference. I guess the point that I'm trying to make is that I think people are very willing to suffer and put in hard work and even put in pain if they know that it's worth it, if it's for a cause that they believe in. But if they know that it's a quote unquote bullshit job, their tolerance for pain and annoyance and hard work is very, very low. And I think that's where a lot of it comes from these days. I would actually be optimistic that a lot of that will start to reverse in the coming years or decades, that we'll look back at like the first 25 years of the century as the period of that kind of work where we really hadn't figured out white collar work yet. A lot of it is going to be, of course, AI is just going to take a lot of those jobs and just take them away. And those jobs just won't exist anymore. And I've seen it in my own hometown. I just attended a high school graduation a week or two ago, and I forget the percent. I don't even want to guess, but a sizable percentage of the high school graduates in our town are going into trade programs. Carpenters, electricians, plumbers, and a smaller percentage than I would have guessed are going to four-year universities. And when I heard that, I was like, great. I think that's the world that we need to go in. And society needs to value those people more than they did too. I think that was one of the problems of the last 25 years, is that so many people who went to college looked down upon the carpenter and the electrician and the plumber as lesser, as not willing to make it. And if you've ever done a remodel of your house and seen a skilled carpenter at work, you know how ridiculous that is. Yeah. And so hopefully we're moving past that to jobs that are actually more fulfilling.
Yeah, great. I'm in my 20s. A lot of my friends also are in their 20s. A big chunk of our audience on this channel is actually in their 20s, and maybe just starting to get out of college and get their first job, their first paycheck. Do you have any advice for folks when they start, having to pay rent and pay bills and support themselves? Anything to think about, balancing obviously that stuff with, everybody I know pretty much in the early 20s has some debt coming out of college if they went that route. Any thoughts on that side of things in terms of, balancing the additional responsibilities with, just becoming better at handling their money and their finances?
I guess two things. I mean, it's different for everybody, but when I look back at my 20s, if I could tell myself anything, it would have been to worry a little bit less. And the interesting thing is that's not because it was all great since then. I had plenty of very hard moments personally and professionally, but most of them worked out. Most of the, even ones that didn't work out, I eventually got over them. So if I had to look back at myself when I was 23 or 25, I would say, man, I wish you just enjoyed it a little bit more, because it's going to work out. Even the things that didn't work out the way you wanted them to, life eventually works itself out. That was one that I think was big. The other thing is, I think nothing in life gets you going and makes you feel productive and feel good about yourself than responsibility. You've heard it from so many first-time parents. It was definitely true for me that when my first child was born, I think virtually every new parent would tell you this. It was like a light switched instantly from I don't matter anymore. That baby's the only thing that matters. And that instant surge of responsibility is a great feeling. And so yes, bills, job, that can be an overwhelming amount of responsibility. I think you will look back at loving that amount of responsibility. I think people are very good at taking responsibility and saying, this is real. This is important. I can't screw this up, and I'm going to make this work. That's actually a great motivator for a great life.
Excellent. I wanted to ask you, everybody, I'm sure always asks you, what are some books that you recommend? But I'd love to hear specifically on the fiction end of things, or, pleasure reading. If you've had any recent reads that you've really enjoyed and think other people might enjoy as well.
I've never been big on fiction. And usually my excuse is that the real world is crazy enough. I don't need people to make up stories. There's enough crazy real stories. But I've pushed myself to get more into fiction. And I read a book recently by Michael Crichton. The title is November 22nd, 1963, which is the day that JFK was assassinated. I'll give you the very quick plot. The book is like 1,000 pages, but I'll try to give you the very quick plot. This guy stumbles across a time machine that will take him back to the late 1950s. And he basically goes back and tries to prevent JFK from being assassinated. And it goes in a million different twists and turns. But I'll tell you, one of the things that I think is so interesting and like philosophical to think about was that before he tries to save JFK, he tries to save all these other people in the town who were like murdered. Because like in the present day, he's like, oh, that person was murdered. I'm going to go back in time and save them. And when he does that, it sets off a chain of events in history that changes like everything in the future. So I'll give you one little quick example. He goes back and saves this kid who was murdered in, I think, 1959. And then he goes back to the present day and he's like, I want to see like that kid that I saved. Let's see who he became later in life. And when he comes back to the present day and he researches what happened to that kid that I saved, it turned out he was killed in Vietnam in that era. So it's like he saved him in this era and then he eventually died like a more gruesome death even later. Yeah. And there's so many twists and turns when he has a time machine and he's trying to make the world better and he actually makes it worse. And I think like philosophically from a fiction level, that's actually pretty different. The takeaway from that, I think, is that the world is so fragile. There's so much chaos theory, like butterfly flapping its wings effects, that if you change one little thing in history, it spirals into a much bigger event in the future. I thought it was a great book.
Excellent. What was the title again? It was JFK's.
Yeah, it was November 22nd, 1963 is the title of the book.
I'll pick it up. Thank you very much. Perfect. Morgan, thank you so much for your time today. Really appreciate it. Obviously, definitely recommend The Psychology of Money for everybody out there. Excellent read. I understand you're writing another book that's coming out later this year. Is that right?
I have another book coming out in October 7th. It's called The Art of Spending Money.
Perfect. Well, we'll stay on the lookout for that. Anywhere else that people that we should point people if they'd like to learn more about you or just get in contact?
Books I have everywhere, and then Twitter is where I spend most of my time. My handle is Morgan Housel, my first and last name.
Excellent. Well, Morgan, thank you again. To everybody watching, hope you guys enjoyed immensely. Definitely check out the resources in the description, and we'll be right back. Thank you. All right, welcome everybody. It's my honor to introduce the next presenter of the TraderLion conference, Victor Sperandeo, also known as Trader Vic. Victor was featured in New Market Wizards by Jack Schwager as ranked among the top 10 traders of all time for both performance and career longevity. He's the author of Trader Vic, Methods of a Wall Street Master. I've got my copy gifted to me by Dr. Wish right here, as traded for legends like George Soros and Leon Cooperman, and built on over 50 years of experience. Victor's process combines his insight into macro trends as well as both technical and fundamental analysis. Victor, first of all, it's an honor to speak with you. Thank you so much for taking the time, and great to have you.
Pleasure. Thank you.
Yeah. We're going to dive into a lot of great concepts today, including your process, of course, how it applies to current markets. But first, I always like to hear, especially from someone who's had the career you've had, if looking back in history, were there any trades that really stood out to you and taught you important lessons? And this could be big losses, this could be great winners, but trades that have impacted you so substantially that still influences how you trade today.
Okay. Well, I have many because, again, now this is my 60th year. But I mean, the one that that probably I remember the most was in 1974, October and December. It was December, I believe, the 4th or 5th. And Dow, I followed Dow theory a great deal, and I had at that time as well. And it gave me a Dow theory buy signal, and I went long because I had been profitable short for the 2 previous years. So I had a lot of money that I made, and I went aggressively long options out of the money because my background is options. And I bought, roughly 1 month. And that was a huge mistake because, to give you an example, I still remember it. I was buying these in the hundreds, 500 Kodak calls. And on expiration day in January of 75, Kodak was the same strike that I had bought, which was above the market. But they lapsed, and many of these calls lapsed. And a week later, they were in the money by $10. I mean, the difference was $25 million if I had bought 2-month options instead of 1 month. So I only say that, these days, the Fed is very instigative of markets and much different than in the 70s. But it's best to buy a little longer than shorter, because that was a night and day difference. I was dead right, caught the bottom, the low, the day of the low, and I made very little money because of buying short-term options. Anyway, that's the one trade. I'll stick with that because I don't want to take up all your time on the past.
Yeah, no worries. And speaking of the Fed, I wanted to ask you, over your career, what have been some of the big changes with regards to the macro picture? I know you've talked about in the past how quantitative easing really changed things in, starting 2008 timeframe. But what have been the big shifts that you've experienced, and how have the markets kind of changed over your career from your perspective?
Well, that's easy, and it is important. 2008, when Obama was elected, the Fed changed its stripes and basically said, we're not going to allow any more recessions. If you Google Janet Yellen at that time, she basically said there won't be another recession in my lifetime. So the Fed will not allow recession. That's why you've been in a bull market really since 2009 June, from an academic economist level, but since March of 2009 on a technical level. And basically the Fed is not allowing recessions. So even though the S&P has been down from 2009, 2 years, 22 and 18 fractionally, and even 22 was, marginal, 20% ish. You really haven't had a bear market as the way they used to be. So there's this great influence by the monetary authorities to prohibit recessions, and this pays their donors, in my opinion. Now, this started with Yellen and Obama, and it's continued till recently to today to Powell. Now, he's just as a prelude, he's trying to cause a slowdown in the economy because he's opposed to Trump. So there's a bit of an anomaly there from what I just said. But other than this recent example where he refuses to lower rates where he really should, he's not doing it. So that basically is what I'll say on that.
Yeah, and to take a step back here, could you talk a little bit about the importance for traders and investors as well to incorporate their thoughts on the macro trends? Because obviously, I know you're using technical analysis, you're looking at the intermediate trends as well. But in terms of big picture, how important is that for traders to really learn that skill? And was this something that you learned going back and talking with George Soros? He's obviously the foremost expert on incorporating the economics into his process. But yeah, could you touch on that aspect just a little bit?
Yeah, well, really, the traders should and investors should incorporate both fundamental and technical analysis. Now, I'm a macro trader as well, so if you ask me what housing was going to do, I mean, I have a feel, but I'm not an expert in housing. So the key here is to integrate, and that's a key word that I hope your listeners, let's say, write down, to integrate the fundamentals with the technicals.
Mm-hmm.
If they don't match, your size of position should be much lower. The sizing of positions is what made Soros one of the greatest in the world in trading, because he made so much money when he was right, because he took outrageous sized positions. He was basically a fundamentalist, so he was macro, if you call it that, but he also knew a great deal about technical analysis. He's not known for that, but he surprised me when I worked with him that he knew things that I wouldn't have imagined he knew. So he really integrated as well and was very used both, but he's not known for using both. He's really a currency expert, which is basically an economist.
Right.
So yes, you should integrate both. And the key is when one doesn't match, your position should be much lower.
How did you first meet George? Could you walk us through, how you first got in touch with him?
I I was a extremely good bear trader I started in Wall Street in 66. From 66 to 74, the Dow, at the time the S&P wasn't prominent, was down 5 years and only up 4. So if you weren't a short trader, you didn't exist. I basically did extremely well on the short side. So I was well known for this. I mean, I got around and people knew me, and I worked through brokerage firms, and they knew my expertise. So somebody, and I can't remember the name of the firm, I'm sure they're gone now, but they recommended me to George because he had a very bad year in 81. He lost money. I think he lost 33%. So what he did with his fund was he basically became a fund of funds. He gave out money to longs and shorts, and the way he did that was he paid them the incentive fee, which was 15%, and he kept the management fee, which is 1%. That's what he charged. So he basically hired me to be the short side of the quantum fund, which I was the only short, and he had 12 longs. So he gave out this money. He's a brilliant guy, by the way, aside from his politics, which we never discussed his politics, but he's a brilliant general, a Patton, to be like General Patton if you associate him to a general. And his ability, if you took 10 of the highest IQs in Congress they wouldn't compare to what George knew. So there's no, I mean, these House reps and senators have no clue about what they're doing relative to a George Soros. And so he basically, although his politics went extremely left, the key here is he knew what he was doing, and very successful guy. So I spoke to him every day, literally for 7 months, because he called me Saturdays, Sundays, didn't matter. I mean, he always wanted to know what I was doing. I ran like I was the hedge that he needed for the quantum fund.
From those calls, or maybe just from other discussions with him, was there, a single thing he said that really stood out to you, or a key lesson that, you take and still use today?
Well, not really, except for the sizing of his positions,
Right.
Which he's known for, and Drunken Miller. He taught Drunken Miller that as well. The key here is he basically asked questions and he listened. So it made him even smarter. So he didn't. I ran the fund on the short side. He gave me certain parameters. And I had to be short 100% of my allocation at all times, or I had to be flat, but I couldn't be in between. So because he wanted to hedge, which is what I gave him. If I lost 5%, by the way, I was fired. He told me that. I mean, I never lost 5%.
Pretty strict.
It was very strict, and you had to be really on top of your game to survive that. But I was fortunate that I did make the right calls. And I got bullish in July of 82. And when I got bullish, I gave him back the money, and he wouldn't give me 1 penny for the long side because he had too many longs. And I pleaded with him, give me give me 1/10 of what I'm using on the short side. He wouldn't do it. But because he had a strategy, again, in general. So the point was that I got bullish in July, I gave him back the money. He gave me a check. Because I had made some money. Didn't make a huge amount of money because the market didn't really drop all that much from January or December when I got the money till the end of June and going into July. But he asked questions and he listened, and he didn't offer advice.
And how much were you managing to the short side for George?
Well, it was a huge percentage of the quantum fund on a hedge basis, but I had to really sign a little agreement. I wouldn't mention that. So
no worries.
But it was sizable.
No worries. And I know from reading your book and listening to a few interviews, you kind of set something up during your career that was similar to what Richard Dennis did with the turtle traders. But I know you've talked about how it wasn't quite as successful as what he did. What were some of the key lessons there? And just if you could talk about that experience a little bit, and what you learned about teaching people to trade, and how not everybody's quite built to really be extremely successful.
Correct. Richard Dennis was far more successful than me, but he screened who he gave money to. I didn't. I believed I could teach everybody, and I did. But the problem is, it isn't in the knowledge, it's in the emotions. And some people are just not emotionally set up to be a trader. Their fear clouds their judgments. So I hired 39 people. I gave them money, various amounts based on their experience. And I can tell you that 30 of the 39, 35 blew out because I had a limit. If you blew out this limit, you're fired. And I had 4 successes, and the 4 made more than the 35. But it wasn't much. It wasn't a business. Richard Dennis did much better. The people that he hired, he screened for certain abilities,
right?
And his method was far superior to mine.
It's interesting because a lot of the best traders who I've gotten a chance to talk to and interview, a lot of them have athletic backgrounds, competitive sports backgrounds, a few poker players similar to yourself. And I don't know if that background helps you develop that emotional discipline, or it's more just a self-selection process of people who are successful in those arenas also, translates well over to trading. But it does, I really like what you said. Emotional disciplines is more important than the knowledge itself when it comes to being
I
successful.
taught everybody the same way, the same principles, the
Right.
same tactics. I caught the 87 crash.
Yep.
I was short, and I went even shorter on the day of the crash. But the key here is I had all these traders who worked for me. They had the same information I did because I was feeding them. They would ask me, and many of them, I can't remember exactly, lost money. I mean, it was incredible to see because the knowledge is there, but it was that people either are biased to the long side, which is probably the case, but they also couldn't sell what was a loser.
So
Even though I taught them how to do that, and that was 50% of what I taught was how you limit your losses. And unfortunately, the makeup of personalities is just not conducive to certain people. So what I took away from that is you can't train everybody to be a trader.
So you taught them to set stops and all of that, but they just simply wouldn't set them or would disobey them, and
right. That's exactly right.
Yeah. No, it's interesting because risk management, if you read the Market Wizards books, you can see it behind me on this side. Every single one of them just emphasizes how risk management, whether you're a futures trader, an options trader, that's the key to really achieving success and figuring things out, and it keeps you in the game. For you, do you have a certain amount of your portfolio that you're willing to risk on any one trade? As you mentioned from George Soros, you got one a bit big when you've got the edges lining up and the fundamentals, the macros all coming together. But how do you keep your risk in check?
The way you do this is you determine in advance where you are wrong. So let's say you buy, make it simple, a stock at 50, and let's say the last previous low was 47. So, and I'm just keeping this simple as an example. So you would buy the stock, and if it traded 46 and 7/8 or 46.99, you sell. It's that automatic. And in doing that, you will succeed because your winners will be bigger than your losers by definition if you follow that. So it's really a 2-and-2 formula. Now, when I technically trade, that's the formula I used. I always knew in advance, not watching what's going on. I'm right. If things are doing, they're either going up or they're going down. You think they're going up, you buy. If you think they're going down, you sell. But let's say in this example, I think IBM is going up, I buy it. I'm using a bad price here at 50, but you can buy it at 50.
A simple price. Yeah.
If it trades at 47.9 in this example, or what did I say, 47, 46.9, you sell. Now, there are other trades. For example, if I'm trading as a fundamentalist right off the bat,
right.
I did this with gold. I've been an investor in gold since 94, believe it or not. And I've never sold any of my gold from 94. So I bought a big position then, at that time. And I've let it run ever since. And, it's up 8.5 times, 9 times, something like that. It wasn't a leveraged position. This is the spot. I actually bought the physical. And that was an investment. And I didn't care what gold did because I had a fundamental view that gold was going to go up because the system, being a fiat currency system, and with House reps and senators basically getting elected by giving away money to their donors, it can only go up. There's no other way. In other words, the dollar goes down, the purchasing power goes down. So gold for 5,000 years has gone up against right. inflation. So it will go up. And basically I was right about that. But I had no stops at that on gold. I mean, that was a fundamental call.
Thesis core.
Okay. So that if you, I don't have many of those, by the way, because I usually am mostly technical and macro oriented and basically understand economics far better than anybody you hear on TV today, by the way. That be very careful listening to people tell you about economics because they're all schooled in Keynesianism, and it's extremely wrong, not a little wrong. It's very wrong. I mean, using Powell as an example, he doesn't follow money supply. Well, money supply has been proven by many economists, Milton Friedman being the heavy favorite there. If you don't follow the money supply, you're never going to know what the economy is going to do. You're just not going to know. Now, liquidity, which is money supply, can be defined in many different ways, and money has grown, and other central banks have taken upon them to be part of the total liquidity. A guy named Michael Howell is really superior in this area, and he's the man. He came from Sali in my day, so I've known the guy for a long time. I mean, known of him. I never met him personally, but he's right on. His methods work. And so, but he focuses on liquidity, which is the same as money supply. But when Powell says we don't focus on money supply, there's no correlation. This is either pure ignorance or this is political bias. But you shouldn't listen to what the Fed says because Mark Farber says if you listen to what a Fed chairman says, you're stupid. And I concur with Mark Farber on that.
Yeah. How do you interpret what's going on right now with the tariff situation, and of course what the Fed is currently doing as well? I'd love to hear kind of your thoughts on kind of the current situation in the markets.
Okay, well, look, tariffs are deflationary. They're not inflationary. And you can go back to the 29 Smoot-Hawley Act if you want to see how deflationary they can be. But basically is you're raising taxes. When you raise taxes and then other nations raise taxes on you, the economy can't grow. Now, what he's doing, Powell, is associating some price increases, which will occur, is inflationary. It isn't, because let me be clear here, because this is a betois of mine. If you let's take the European Union, French wines, they're let's call it $100 a bottle. They put tariffs. Let's assume they match our tariffs, what we're saying on them, which is already there. But just for the example, they raise tariffs $20 on a bottle of $100 bottle of wine. Well, you go to Napa Valley, you buy the $100 bottle of wine, or you go to Argentina, you buy other products that don't have the tariffs. And most people, when there is a big market, like there is in this example, wines, it's not like a car company, which is more an oligopoly. You're dealing with free markets. Prices can't go up. They have to go down. So the tariff coming to us from France, it means nothing. You're not going to buy French wines anymore. So the bottom line is people are generally either wrong, ignorant, or politically biased when they tell you that tariffs have meaning. They have a deflationary meaning. Earnings drop when there are tariffs. They don't go up. So it's a completely 180-degree wrong perspective. Now, for the Fed not to know this, it's unbelievable to me. They got 400 PhDs working for economists. Somebody is going to know what I just espoused to you. It's there. You just have to look it up. I mean, Keynes, who is the greatest if you want to call him from the left, economist. He was a brilliant guy as such, and Keynes. You can go look this up. I mean, he's quoted that tariffs have no meaning. The insignificant was his quote, his exact words. because people will switch. In other words, you raise my tariff, I will buy a different product. That's why
Right.
he said that. But he's the greatest economist from the left's point of view. Keynesianism has been distorted greatly. I mean, he would roll over in his grave if he, be associated with what's called Keynesianism today. It isn't. I mean, he would roll over. But the key here is he said it. Now, how can a Powell, who's a lawyer, who ran an environmental fund, so he has no idea what he's doing. Now, I know he's getting feedback by some of his people, but what he's doing is political. It has nothing to do with economics. So I only say that you really shouldn't listen to Powell's words or go the opposite. But there are other great economists that still exist. Lacey Hunt is my favorite, even though he's been wrong to a certain degree. And David Rosenberg is also another great economist, and they've been wrong. And the reason they were wrong, and this is my nature, is they didn't read the bills that were put forth by Biden. And those bills spread out the spending of the money. That's the key thing. Why there was no recession was because in the bill, if they passed a $500 million bill for something, they said, okay, you spend 150 million this year, 150 million next year. So they spread it out. So the spending came in and offset the negatives to the economic calls that should have, when you're raising rates, usually the economy slows down. The big mistake there was not understanding the fiscal policies and how they were written. Now, I didn't read those 2,000-page, if you will, fiscal crazy things they put out. But after the markets didn't go down, I got bullish because I said these markets should be going down. They didn't go down. So if something is supposed to happen and doesn't happen, that should make your antenna go up as soon as possible. And that's one of my rules. I don't think I put it in the book. Maybe I did in one of my books. But the key is if something is supposed to be and it isn't, then the reverse will occur.
And that was actually what I was going to ask you just next. Is it really the price reaction when it breaks expectations? Is that's what really significant, especially as a trader, to really focus on when the Fed does something and it's supposed to be negative and the markets rally? That's a sign that a new intermediate trend could really be getting going pretty soon.
Yes, I mean everything. There are variables, and there are more than just interest rates, which really it's mainly money supply, but interest rates guide most people these days. So it has to do with a lot of variables: taxes, the what Biden was doing, restricting people's ability to start new businesses, all the regulations. That has an effect as well on the macro level. But the key is if some information is bearish and the market is not going down, it's either been discounted or it's not going down because you're missing something.
And going back to how what you talked about with gold, how do you interpret what's happened with crypto today? Are they even in the same vein in terms of, they're trying to do the same thing, in essence, be kind of a hedge against a declining dollar. But how do you interpret what's going on with, Bitcoin specifically?
Okay, let me give you my perspective there, but I will put this into context. I missed Bitcoin completely. Now, I did because I analyzed it on a fundamental level. I mean, what they offer is scarcity. Scarcity
Right.
because there's only 21 million Bitcoins. So that was the key thing. But there are so many of these, there's 20,000 of these type things. Now, Bitcoin was the best. And I completely, fundamentally, not technically, missed it
Right.
because there's nothing behind it. Now, by the way, gold is different. It isn't the same. Gold just to make my point, Bitcoin can go to zero. It is possible. Gold can't. If gold starts to drop, what will happen is production will cease. And the ceasing production, where people still want gold, will create a floor.
Right.
So at some point, I don't know what that floor is. Maybe it's 1,500 at this point. But there is a fundamental difference between Bitcoin and gold. But here's the critical difference: where anybody now, it's been fabulous. It's a great money maker. That's why people buy it, to get rich, and it has done that. 45% compounded return. It's got 127% standard deviation, which
Pretty
counts.
volatile. Yeah.
But the fact that what people miss in it is that in a depression or a decline in the money supply that's material, then what are you buying Bitcoin for? You're buying it because you think it's money, and there's a limited amount of it, and you're assuming that the system worldwide is inflation, which it is. But if you look at, say, I'll use examples, commercial real estate as an example, that isn't written off. They don't market to market. They extend and pretend, as the saying goes. If you ever get a depressionary scenario where money supply, where people start to write off these losses, or the losses occur, see, money supply will drop. Now, if money supply is dropping, why do you own Bitcoin? Gold is different, by the way. Gold is not only an inflation hedge, it's a chaos hedge. It makes most of its gains in wars, by the way. But the key here is that, like I said, there's a floor on gold. Production will slow down because the price is dropping. So the marginal producers will stop, and it'll come to a floor, but it won't go below that floor. It can go down, but it can't go to zero. But Bitcoin, if you go into a depression like the 30s, where money supply dropped over 33%, you will see, the people who own this will now start to calculate, well, I bought this as an inflation hedge, but Bitcoin sellers will come out of the woodwork, and they should. Even the way they think, that it's fundamental. So I only say that you have to be careful. Now, under these conditions, Bitcoin is fine because everybody still believes it's an inflationary environment. Certainly this big, beautiful bill, ridiculous name, was passed, and it's an inflationary bill. So right now, what I said doesn't apply. It may apply someday, depending on what happens.
How do you think equities will be impacted by the passing of this bill and just the overall macro environment that's going on right now? We have been in a pretty strong intermediate trend since the sharp correction we had, but what are your thoughts there?
Well, people who ask me that today, I always say, well, I got to know what the rules are, and Trump has not given you those rules with the tariffs yet. So we don't know. In other words, in order to make a prediction, you got to know what the name of the game is.
Yeah.
There is no name of the game. The thesis is that tariffs are okay. Tax increases are okay. I say to a degree that may be true, but it depends on the levels. So I don't have an answer on the current rally and where it's going, because again, if tariffs go extremely high for the European Union, for Japan, he just said 25% on Japan. Japan can't operate on a 25% tariff, by the way. Neither can South Korea. So that's going to change. The 40% or 30% on China, that's going to change. So you have to really, to make an intelligent prognosis, you have to know what the rules are. He's got to come out and tell you all these things, which will happen. He keeps delaying them because he really, he's got the name Taco, Trump always chickens out because he keeps changing if the markets punch him in the face, as Mike Tyson said.
Yeah.
Everybody's got a plan to get punched in the face. He had punched in the face, the market went down 19% in S&P terms, and all of a sudden, well, we're postponing these tariffs. We're not going to put them into that. So he's just like anybody, any other politician at this point. As a matter of fact, he's really what I would call an establishment politician because he's for the establishment. And he has to be because he has to get the Senate votes, and they're all establishment because they get money from their donors, and that's why they think the way they do.
Right.
The bottom line is we don't know, but it's a precarious position at this point. It's very precarious. Until you know what these rules are, you can trade, and this goes day to day, and you can get little rallies, minor rallies, and even minor sell-offs. But until we know what the conclusion is, it's very hard to make an intelligent long-term prediction.
For you, and this is more speaking to a technical level, what would the ending of an intermediate uptrend look like in the start of a correction? What are some kind of the warning signs that you always look for that signals, all right, this is now a more corrective, certainly choppy period, that it's much better if you're more on the long side to be flat, just go to cash and just wait for a new intermediate uptrend to start?
Well, in my books, I outline the changes of trend. So I would follow those because those still hold true. But it is my opinion, if the bell rings, if something, comes out that is obviously a horror kind of fundamental scenario, you'll see a huge drop in the markets at once because everybody's being educated. In my day, by the way, and this is not untrue, in the early 70s, 71, for example, I went to the best traders I knew at the time, and I asked what the Fed funds rate was. Not 1 in 10 knew what it was. And they didn't care, they didn't know. And now the whole world listens to Powell on TV waiting for what he's going to decide to do on Fed funds. You see, so the world is becoming far more educated. The markets are more knowledgeable, and they act on that. And there are very sophisticated people, besides, the obvious people that you might interview, people like me. There are more very sophisticated people, some people that follow, strictly high frequency trading algorithms, that basically define what the trend is in their world. And it's going to be, the markets will act more like they did at the 87 crash when the markets were ready to go down, even though that was a comment by James Baker that caused that crash about devaluing the dollar in an unlimited fashion. But the key here is that you will see the beginnings of this by the typical patterns that show up by most technical standards, certain diversification, non-confirmation rules, 2Bs, which work very, very well. If you follow that, you can make a living. If you've got the wide enough scope to follow many things, and all these things that I put in my book that tell you what the change or trend is. So, but now you should integrate fundamentals. I mean, right now, the only thing that keeps the markets going is that the spending from Congress that was just passed and passed by previous administration is pouring into the system, and that's acting as the buffer to keep things going. If that changes, you'll get a change in stocks. But stocks are incredibly overvalued historically on standard terms. I mean, Walmart is trading at 42 or 43 times earnings. Now, that's absurd, even though it's a great company. But high valuation be 16. You have to wait 44 years to get your money back if you buy a share of Walmart. See, that's absurd. It ain't going to happen. It's going to go down well before that. But the key is right now, this is intelligent from people putting money in the market because you can't buy bonds. Bonds are 2% from their all-time lows.
Right.
And I'm talking about the TLT as an example, which is 20 and 30-year bonds. So either in 5 years or T-bills, or you're in stocks. But real, and of course gold, but I mean most institutions don't think of gold that way. But gold is still in an uptrend, although it is in such a strong uptrend that it's due for a correction. I mean, I think there's been 5% corrections in going on 2 years. I mean, that's really unusual. It's been very strong. And I'm only suggesting a correction is like 20%, 15%, things like that. 5% is minor. It has no meaning. It's noise. So the key here is that stocks and bonds, you're not going to buy bonds because the government has nothing but supply to give you. And meanwhile, what do you put your money in? It's got to go somewhere. So you go into stocks, which is better than bonds. It just makes them very overvalued.
And going back to what you said, a minute or two ago, is it a difference that you've seen that because of the algorithmic trading and everybody, the information spread is just a little bit faster, that the declines are sharper nowadays, or they happen a little bit more quickly than when you were first starting trading, or is that true?
Without a doubt, because machines are programmed, computers are programmed. For example, if Powell ever says anything about quote unquote raising rates,
Yeah.
in your computer programs by people who do this, they will program increased rates or rates rising, and they automatically sell.
That
Okay,
phraseology,
so
just looking for that and then immediately
it's
sell. Yeah.
a word can make the markets go up and down because they're already pre-programmed, and you've got these computers ready to roll on words. So you're never, as a trader, you're never going to beat the precise moment. But the key is you don't nearly need to make money. This is for people like Citadel and people like that they're market makers, and they basically they're in a different place, as well as many of the high frequency traders that use these programs based on words that will jump the gun.
And it seems like reading your book and listening to stuff, you've been a part of every type of trading imaginable. You're part of the ETFs, of course, futures, options, all of that, and of course, as we just mentioned, systematic trading. You were doing that in the early 2000s, I believe, if I'm correct. What was kind of your experience with that, and what made you go into that? And I know you stopped in a little bit later. What was your reasoning for moving away from that edge?
Well, day trading is a young man's game because most people, when they get into their early 60s, what happens is they lose the ability to focus for 8 hours a day watching a machine.
Mm-hmm.
So I switched to algorithmic trading.
Mm-hmm.
I create programs that basically use rules-based strategies to set up portfolios, and that's been very successful in my world. And that comes from experience. Plus, I'm a researcher, so I go back 100 years. When I do something, I test it back as far back as I can. I mean, I've got one program that goes back 64 years plus 6 months of this year, and it's had like three annual losses under 5%. So, I mean, this is more research and how assets integrate and if you will, correlate or non-correlate to one another. And there's little tricks. I don't want to get into this in detail here. I'm only saying that you can do it if you so seek it. In my case, because I got older, I don't want to be in front of a machine, but I still, put together strategies that make money.
Yeah. How do you incorporate risk management processes into these programs? What are some key things that you always focus on to make sure, it's keeping those annual losses or even monthly drawdowns, within good risk
Right.
parameters?
Yeah, I'll mention that this one program uses 100 million.
Hmm.
Its worst drawdown was 743 gross without fees in 64 and a half years. I mean, that's much better than the Bloomberg ag. If you look at that, which is really the stable thing that people buy. But the key there is, and it's a subtlety, it's not easy to see, is what's called, this is not my concept, volatility balancing,
Hmm.
where your portfolio structure is set up to where the risk based on standard deviation is equal to the parts. I have this one method uses 7 different strategies,
Hmm.
and they're all volatility balanced, but not precisely. They don't.
Right.
I mean, I don't change them around daily, but they are generally the same. For example, you could have 45% 5-year T notes would equal 14% S&P. Okay, the volatilities are the same.
Right.
So if you wanted to have a portfolio of 45% 5-year T notes and you had long S&P 14%, the risk is the same. And usually when bonds go down, stocks go up and vice versa. Now, the subtlety that is further is that when somebody sells something, it goes down less as a percentage than if they buy something. So percentages tend to work on the upside. So now the key there is if you're having this portfolio maneuver itself, you basically the risk control is in the way you set it up.
Mm.
I I don't interfere in any of these. These are completely rules based, but
Yeah.
they work because of that in part that nature.
Are these primarily intraday strategies, or are you trying to
No,
find longer term trends? Okay,
these are monthly strategies. Get rebalanced once a month.
gotcha. Yeah, excellent. Um, it'd be interesting to hear your take on um, some of the mistakes that you see traders make nowadays in terms of getting started and where they go for their information. Basically, if you are starting out right now, what would be your process for developing a system and learning to trade? And what would be the key skills that you would focus on to really develop? Risk management obviously is right up there with it. But if you were starting out, what would be your process for shortening that learning curve?
Okay, well, I would read a lot of books. The books naturally the Wizards books, and there's one before the new Market Wizards that I was in. It was Market Wizards, and there's lots of really good books on technical analysis and on strategies. In my day, I read everything I could, maybe 3,000 books at the time. And there's a lot of new books I don't read anymore because I have this methods that work for me,
Hmm.
what I do. But you should never, ever listen to the people the on CNBC or Fox News or those people. They are all positioned to be propagandists for the products they sell and for what they're. For example, even a station like Fox. I mean, they don't really want you saying things that they don't want you to say. I mean, they make their money as globalists, so they're going to be always for free trade, no tariffs, and for open borders. See, now that's basically it serves their purpose. They don't. It doesn't. Open borders doesn't serve anybody, but if you own a lot of businesses and you want cheap labor, so you shouldn't ever really listen. When I mean listen, I don't mean you shouldn't watch. You shouldn't use the information to make money or lose money. You got to get that from books, and you got to read the top economists historically. That would be the Milton Friedmans, the Alan Meltzers of the world. He was from Pittsburgh, from Carnegie Mellon, and there are many, many great economists. But you can't remember. You have to integrate.
Mm-hmm.
If economists are saying you're going to recession rates are going up, and meanwhile the stock market's not going down, there's something wrong, right? So you got to stop and you got to say, well, what's wrong? Somebody's missing something. And like I say, these top economists that I respect highly, they don't read these bills. They don't know the money is pouring in, and this is a game of money concentration. If the government is spending these astronomical deficits each year, it's going to hold up the market because that money goes to corporations eventually,
Mm-hmm.
at least as a percent, more or less. So, and of course, most of the money is going to the high tech companies, and without a recession, the high tech companies, and I'll be specific here, the Googles, Facebooks, Amazons of the world are not going to lose because they're getting a lot of this capital. But where they make a great deal of money is in advertising. When a recession comes, the first thing you cut is advertising. So they will get killed when you get a real recession. Now, when that'll be is when the governments, stop issuing the kinds of debt they're issuing and printing the kind of money they're printing. So you don't know when that's going to happen. But the key here is it's shown that a guy like Trump, he's no different than anybody else. he's an inflationist. He wants the market to do well, so he looks good. So the key here is they're not like the founding fathers. They're not signing the Declaration of Independence where they advertise who they are so the British will come and hang them. I mean, these are much different people. These are not public service oriented people or people in Congress. They're there for themselves. You got to understand that game. But all I can say is that you should not follow the newspapers because they're all propaganda machines. CNBC, you can watch them, but you shouldn't listen to them because most of the time they're telling you what they want you to do and hear so that they benefit, not you.
It was interesting what you said there a little bit ago, and just what you ended with as well. If the price trend is not reflecting your macro thesis, you shouldn't act just yet. You should wait for those things to be aligned before you would place a trade, or certainly place a trade with size, because you don't want to go against the trend, even if you think it's wrong, or have another opinion, basically.
Correct. It's the term I used is integration.
Yep.
The fundamentals to the technicals, the price action to what's supposed to happen fundamentally. That has to correspond. And then you got to know the basics. You got to know, for example, tariffs are deflationary. You got to know that intuitively so that you're suspicious of what's going on when the Fed comes out and says we're withholding cutting rates because of, we want to know what the tariffs are. They're not inflationary. They're price increases. You seem to know who Michael Howell is. You know who Michael Howell is? Right?
No, I'm not too familiar. Sorry.
Okay. Michael Howell is a guy he's the king of liquidity. He is the man. If you want to watch what's going on with liquidity, he's on videos and things. You'll see. He's a former Solly guy. He knows what he's doing. But he basically terms inflation two ways. One is monetary inflation, which is what inflation really is.
Mm-hmm.
And then he tries to distinguish it by using the term high street inflation. High street. So high like an opposite of low, and street like an avenue in New York, a street.
Right.
And the key here is that high street inflation is consumer inflation when you have price increases, which have nothing to do with inflation. They have to do with price increases. The government killed about 20 million chickens because they thought that there was a bird flu. Well, what happened to egg prices? Well, they went up because you killed all these chickens. And when they stopped killing the chickens, the egg prices went down. So, I mean, that has nothing to do with inflation. It has to do with a price-specific increase or decrease.
Gotcha.
And there are many. A strike, for example, will cause prices to increase, but it's usually temporary. When the strike is over, prices go back and adjust. There are many reasons why prices increase or not, and they have nothing to do with inflation, which is strictly a monetary phenomenon. So these are fundamental principles that people don't get taught today, unfortunately. I only know them because I've read a lot of books, and I know that I'm an Austrian school thinker, so I believe in Ludwig von Mises and von Hayek, and I did read the general theory that was Keynesian. John Maynard Keynes' book, but you read everything and you make your own decisions of what's right or not. If something is not working, it's not right. It's not true. So Keynesianism doesn't work because you get some growth, but you're sacrificing inflation to get that growth. So you're really not. I mean, people who own assets do the best, but the common man is getting killed.
Well, Victor, this has been fantastic. I've got some studying to do, some reading to do based on what you've said. So appreciate your time. Any last bits of wisdom for traders just getting started? What would you say to encourage them about the potential of trading, or just anything that you would say to kind of set them on the right path?
Well, be cynical and prove it to yourself that something stated is true. For example, if you see the BLS putting out an inflation number, if you study the CPI, how it's constructed, it's ridiculous. It's the worst index in the world. So nothing to do with inflation. It's a subjective judgment by a bureaucrat, and they can make it look any way they want. So you have to understand that. So you have to, dig in. Yeah, again, some of this stuff unfortunately requires time and study.
Yeah.
So I'm not counting that as being part of the business that you're in, but the key is you got to be mistrustful, and you got to be cynical until you prove it yourself. If it works, you find the answer to it, and you'll be a lot better off. But the government this day is not your friend. The Fed, they do things for political reasons. They do not do things to help the common man. So you have to understand that. Now, again, some of this is hard to believe for people. Why isn't the government neutral? Yeah, it's so incredible. People don't believe it. But if you analyze the results, you'll see it's true. So you have to be cynical. So that's if somebody tells you something, I would look into it.
Yeah.
But I wouldn't close it off. I would look into it and study it and research it and see if it's true or not. But the key is not to trust everything that somebody tells you.
Excellent. Victor, is there another place you would point people to for if they'd like to learn more about your style, or I believe you've got a website, correct? I forget the exact URL.
It really isn't conducive to individuals. We do this institute, like I say, the minimum investment is 100 million in this concept I use. So it isn't for individuals. So I don't use a website that we don't appeal to.
Oh, I meant more for education purposes. If they want to learn more about your style, obviously, I think your book is excellent. I've read it. I need to reread it. But any other place that you'd really point people to?
Yeah, my stuff would at best. I have 3 books and 1 novel, but the 3 books on Wall Street are the best, meaning they will give you my thoughts. Most of the things I've developed, I think I would tell you if anything changed, but they're all still they work today the same. And the problem there is you got to put the work into it. This concept I developed called the 2B, it's on the internet, but you've got to go and find those stocks that quote unquote too big.
Right.
And, that takes work, and you got to use computer programs usually to find them. But that's really the only way I can point you to it. I don't really teach anymore, and I don't update my websites to specifics. Occasionally, I write through a service called the Curmudgeon, and occasionally, and it's a free service, and it's been around for a long time. There's another gentleman involved who's the editor of it. I contribute, and that's where I keep most of my up-to-date stuff in there. If I'm doing something, I let people know.
Excellent. Well, Victor, thank you so much for your time. Appreciate hearing your thoughts. Really enjoyed this, and so huge thank you to you, to everybody watching. Thanks so much for tuning in. If you enjoyed, go ahead and leave a like down below. Subscribe if you're new to the channel, and we'll be right back. Stay tuned. Okay, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion conference, Stamatoudis. He is known for his reflective and in-depth essays distilling the principles of momentum and swing trading. He's a top performer at the U.S. Investing Championship with a return of over 290%. And today he'll be discussing mastering your trading foundation, thinking like an engineer. This should be excellent. Marius, thank you so much for your time and looking forward to diving in.
Hello, Richard. Hello, everyone. It's really great being here once again. I think this conference is probably the best source of concentrated and at the same time diversified, information due to the number of speakers. And as I said, it's really great being part of it once again, and I'm really grateful for the cause behind this conference. So today, since we have about an hour to speak, and I'm known for making long presentations, this time I have decided to break, the tradition and make a short presentation, but in my opinion, really effective one. Talking about the topic that basically represents, let's say, the central gear of every trader. And as you see, it's about mastering your foundation, escaping from the operator mindset and thinking like an engineer. So the goal generally for today, guys, is to think about your trading foundation, to make you think about it more and more, and what it takes to structure your system in a way that is solid, and how to approach trading like an engineer and not just an operator. And I've said it many times, and I will repeat it here because I find it really important, and it has helped me a lot during the years. Most of almost all of trading struggles, either the ones we blame psychology, revenge, FOMO, chasing stocks, not achieving the results that you want, in my opinion, always stem from the foundation we choose to build. So I believe, everyone, and that's, what I did through the years, that thinking about your foundation and understanding your foundation deeply enough is one of the best superpowers, if not the only real superpower, to achieve true clarity in the markets and eliminate the roots of so many struggles, and start getting closer to the results that you desire, right? So let's start with something simple, okay, something basic, which is, what is the trading foundation? I mean, all of the traders talk about, the trading foundation. They use the term quite a lot, and I use this term, a lot of times on my post on Twitter. So all of you that are hearing, this, you probably have a foundation, a trading system in place, or maybe you are in a process right now of structuring the system or enhance it. So my question to you is, what truly is a trading foundation? What does a trading foundation, represent? Okay, so for me, a trading foundation, represents, consists, let's say, of all the parts that make up our whole trading system, and each of the big parts and the big components have many parts as well. So the core parts of any given foundation, in my opinion, are the following: its basic knowledge about the markets, its market structure and philosophy, its setups, its math behind risk management and principles, its preparation, studying. It's about entry and selling tactics and some techniques for more enhanced performance, all merged with connections between them. And the best way to describe a trading foundation or visualize it, and I want you to start thinking of it this way for this presentation, is like an engine. And thinking of your personal foundation this way basically helps a lot to fully understand whether a foundation is faulty or not, or if it's missing something, or even if it is complete, to give you some more clarity of some areas of adjustment in order to achieve the results that you desire. It's truly the foundation honestly, guys, itself that shapes the trader. It's the foundation that gives identity. It's the foundation itself that establishes habits. It's the foundation that dictates and prompts us into actions. It's the foundations that really shapes us and our results. And as I mentioned in the at the start, it's usually issues, faulty areas or inconsistencies within the foundation that most of that create the roots of our trading struggles. Okay, so let's try to think of it a bit further. So let's say you have a trading foundation and visualize it like an engine, as I said, a trading engine. What's the first thing we want out of an engine? All right, think about that. The first of all, right, the engine must work. All right, so what does this mean? It means that you need all of the parts in your foundation. If any single part of the engine is missing, or if it's not solid, or if any part is there in a period of time, all right, and out of the engine in another period, the engine just won't work. Or if it works, it will break down, in a short amount of time. So remember all the parts of the foundation. Even if you have basic knowledge around the markets, even if you have some structural viewpoints, you have setups, you have, if you have a missing part, let's say solid selling tactics, or you don't apply them, it just won't work. If you have, every part in there, structure, entries, tactics, setups, selling tactics, but you lack, for example, preparation or studying, the engine just won't work. If you have everything in place, but you lack understanding of probabilities, math, principles of risk management, it won't work for a long time. And guys, last year I've done a lot of free calls in a one-to-one format, one-on-one format, and I met a lot of traders, and there were a lot of people that were struggling or felt that they were missing something, or that maybe they were break even. And the first question I asked to try to figure out if they had a complete engine, a complete foundation, I tried to ask them basically questions to figure out this specific stuff, right? If they have a complete foundation. And you can't imagine how many times I asked, for example, what's your position sizing? Or what's your risk per trade? Or how do you sell? Or why do you use the selling method? What's your everyday preparation? What's your routine? What are certain structural views about the market, and many more, right? So these are basic, foundation component questions, right? So a lot of times I did not receive clear answers, solid answers. Some people were saying, I don't use stop losses, or I don't have a complete selling system in place, or maybe they knew about setups and strategies but didn't have a market understanding to justify these setups, or they didn't have understanding of certain structural tendencies that make all these setups and strategies evident and meaningful. Other traders weren't preparing before the market opened, or they never went to study some phenomena and some repeating things that happen in the markets, both technically, behaviorally, fundamental wise. So that's incomplete foundations, guys. That's an incomplete engine. And what's strange in trading is that a lot of people with incomplete engines get rewarded in some periods, and they kind of forget that they need to fill more gaps to ensure some longevity, until it gets bad. Because when you don't have all the parts, you might hear some noise coming out of this engine, this trading engine, because some parts are there indeed. But that does not mean that the engine, will work for long. It won't, and that's the truth. And guys, like it's really hard after years of being in the game to admit that maybe my engine is incomplete. And I've been there myself years back with an incomplete engine, pretending that everything, is fine. This is mostly, in my early days. I may have had setups, but I may have not had a solid, specific philosophy about markets. I didn't have basic structural knowledge that makes everything connect and makes the setups evident. I didn't know the cause and effect of things. So I had many holes in my preparation and many more, right? Like it's natural, it happens to all. So the first thing that every trader must do to find, as he structures his foundation, his engine is, to fill in all the gaps to reach a complete foundation. So a trader must have, as I said, basic knowledge about the markets and understand structural tendencies, alright, and have a certain philosophy about the cause and effect of things, and understand probabilities and math behind risk management, have setups, preparation, studying, entry, selling tactics, and some tactics for better efficiency, better performance. So this is the first thing to actually make things start rolling and start gaining some longevity. But even that isn't even close to enough, guys. Alright, like an engine just being complete and working isn't enough. And there is a tendency in the trading world to forget about it. Like we spent so many years trying to assemble all the parts together, only to get some surprise at some point of why things aren't working out the way we expected them. So even if you have all the parts and you know about structure, setups, principles of risk management, you do preparation and all that stuff that we discussed, okay, you have to wonder why you possibly still face issues. Okay, people usually have complete foundations and think they are ready, and I was thinking that too, but the journey proved me wrong, because throughout my journey I learned that just having a complete trading engine with all the parts is not enough. So a trading engine must be able to do 3 more things, and that's why I said to visualize it like an engine. Okay, an engine must be able to perform 3 more tasks besides working. So what are they? Can you think? What does an engine need to do besides working? So to give you the answer, these are the other 3 requirements for our trading engines. As I said, first, a trading engine must work, and then the other 3 is that the trading engine must tolerate enough stress and harsh environments. A trading engine must not overheat and fail, and the trading engine must be fully optimized and efficient. And guys, these are the things that truly make a difference in a foundation and your longevity and your clarity and your confidence and your results. These last 3, okay? And I will explain. So, when I say a trading foundation must be able to tolerate enough shakes and harsh environments, it's important to remember that being in the markets and trading, is like being in an environment that always stress tests your foundation. It's like being in an environment of constant earthquakes and hurricanes, with some periods of great weather, okay? But you can't avoid these hurricanes. They are there, okay? And as I said, these constant shakes the market creates always stress tests the parts of your foundation and the connection and the bonds between them. So the better the structure, the more aligned it is, the better established connections you have, the better you will stand. So it's a common phenomenon for traders in certain periods, in the market that are generally, let's say, harder to trade, or even, just not extremely bullish, scenarios. It's really common for traders to feel uneasy and say, the setups don't work. Should I change my position size? Should I find new filters? Should I find new scans? Should I find other setups, new setups? And I've experienced that as well as I progressed. And I'm sure many of you, second guess many times the things you do, especially on harder periods, right? So have you felt this pressure from time to time? That's my question, right? And as I said, the market is always going to create pressure and stress test your system. So it's so important, guys, to build a foundation and structure it in a way that can tolerate all these shakes. And for me, in order to, for a trading engine, a trading foundation, to tolerate stress and ensure better resilience, we need two things. Okay? The first thing is that all parts must fit perfectly together and be aligned, and also all parts within the foundation must be bound together really strongly. And I will explain what I mean. So each and every one of us have different foundations, even in the same style of trading. Okay, we have different foundations. The thing is, though, that not all the foundations out there have parts that are perfectly connected, nor their parts are perfectly aligned. And this is, a really common issue for traders. Like, think about it. Some people might use setups they learn somewhere in books, right? A risk management method they heard, somewhere else. Some scanning methods, from someone that they found out on Twitter, or selling rules from a different trader, and have some structural viewpoints from somewhere else. So let's say someone has all the parts that we discussed before, which is perfect because the engine works. But that does not mean that all of the parts that were assembled together fit, all right, or that they are aligned, or that they have, listen, strong bonds between them. And this is a loop, most traders in the markets end up getting themselves into, and only a small number of traders are able to break through this barrier. And I was in this spectrum for long. So getting, to the first point, if, for example, you learn, some setups from one trader and try to apply the selling rules of a different trader, and you use scans from other people, okay, these things are not certainly aligned, okay? It's never going to work if you don't make adjustments to make things aligned. And just to give you a quick example, okay, listen to this. If your philosophy about the markets, your viewpoints around the markets, and what, let's say, you mentally, what mentally you're shooting for is capturing big moves, and you are shooting for extreme reward to risk scenarios, and you have adjusted many elements of your foundation to serve this purpose. Let's say you have adjusted your structural views, many parts of your foundation to do that, and you operate under a small win rate, okay, to be able to have tight stops, okay? So let's say you have adjusted a lot of parts of your foundation to serve this purpose, but you have, for example, a selling rule that is part of your system that prompts you to sell most of your shares after 2 or 3 days. This is a misaligned foundation. Like, it doesn't even make sense, because the selling part within your foundation doesn't correlate with other parts, because you have fine-tuned specific parts for a reason, and then you actually negate these very own goals with other parts. And there are many different combinations of misaligned foundations that people use, and they haven't figured it out yet. So I believe it's really important thinking about your foundation, and gradually align the parts, okay, and align the ideas you inherit from others, and make adjustments to fit your specific principles, okay? Every part within your foundation must correlate, and serve the goals of the previous part, and the next part until the structure gets completed and it's fully aligned to your own principles. Okay? And that basically leads us, to the following. Because besides alignment, I mentioned something else. I said all the parts must have strong bonds together. And this is, huge, guys, okay? This is huge. So let me explain. Okay, even if you've thought this through and you have an aligned foundation, okay, everything fits together and it's complete, you have all the parts, okay? Let's say it's a foundation you learned from books or from traders you admire in the markets, all right? So you got a full foundation and it's somewhere, most of the parts are aligned. That does not mean that your foundation has really strong bonds between the parts. And I mentioned this quite a lot when I'm meeting, with traders, because the successful trader whom you lended the approaches and the system itself probably has strong bonds and strong connections between all of the parts of the system. But your inherited foundation does not. Because strong bonds, okay, and connections within the system are created only, on a personal level, and they require work. So, you have to wonder, all right, like for all the things that you do within your foundation, the stocks you track, the setups you use, the stop loss width you use, the entries, the selling, like, do you do all these because you have found superior traits to all of these parts? Or have you assembled and apply all these parts, most of that stuff, just because you saw other successful people doing them and applying them? Like, this is the difference. Because if you do things just because others are doing it, or because others, other people have had success, you will never create strong bonds between your parts, even if they are aligned. And I will try to explain why not having these strong connections leads to problems. But basically, there is only one way to create these strong connections and bonds that it's needed between the parts, okay? And that is trust fully the foundation and eliminate all your doubts and answer most of your whys, and that's how you gain true confidence. Like, this is the sole way you can create strong bonds between the parts. And the reality is that a few people actually do this. So what happens when you don't, bond strongly these parts? What happens? When you have an inherited system or a foundation, you will naturally have many unanswered questions and many doubts. It's normal, right? Because you will operate the system, but you won't know the use of each part. There are a lot of people that don't know why they use setups or specific setups. They don't know why they use this specific position sizing method, or why they use these specific rules of risk management in their approach. They don't, fully know why they use a specific selling technique. And it goes on and on, right? So what happens eventually? Once the market starts being a little more unfavorable, they start doubting the system. They feel uneasy. They start changing parts because they don't like the feedback. They don't understand also if this short-term feedback is normal or not, or if it should be expected. So they change, the setups, they change the selling tactics, they change the entry tactics, they change rules, they change scans, they change the preparation routine and so on. And what actually happens, and it's funny, is, they end up with a different foundation where once again the parts might not fit perfectly together again and be misaligned, and then they try things again, things don't work out, the feedback isn't good, they have again doubts, unanswered questions, they change parts again and again. And if you think about it, it's an infinite loop, okay? Like, this is where many traders are stuck. So the question is, what do traders, do to escape this loop? What did I try to do? What's the common phrase you hear from a lot of traders out there? they say, one phrase. They say, yes, I picked up a lot of things, and then I made all of these things my own. But you have to understand the underlying meaning behind this phrase, because just picking up something new, okay, doesn't mean anything. You just fill a gap, of a part in your foundation. Before picking up something new, you must know the use of all of your parts of in your foundation. And when you pick something new, a new idea or a concept, you must tailor this new part, okay, whatever part it is, risk management, setups, whatever. You must tailor this part to fit your existing foundation without causing damage, okay, or negate the effects of other parts of your foundation and your principles. And you must answer all the whys within your system in order to create these strong bonds, and not second guess things, and to avoid confusion and loops. So picking up things and just throwing them into your foundation is the easy part, all right? The hard part, is spending some days going full philosophical to answer, these whys, to eliminate some of your doubts, and that's, the only way. That's the only way. This is the only way that truly gives clarity and confidence, and enables to not being easily shaken out of your foundation by the norms you choose to build within your system. And when I say answer your whys, okay, I truly mean it for most of the parts, of the foundation. For example, why do I do momentum trading? I have more options. I can do mean reversion, I can do contrarian trading, I can do social arbitrage, a ton more. Like, do I do momentum trading just because other people are making money, or because I found myself some superior trades to it and it corresponds with my personality as well? Why do I do swing trading or position trading? Why do I track, stocks that are in stage 2 in the cycle? Just because others have said that, this is the right way, or because I have convinced myself that this is the optimal way? And, it extends to many more questions. Why do I track this type of characteristics in stocks? Just because I saw them written in a book, all right, and applied from other traders, or because I've researched and verified things or came up with slightly different things my own? Why do I use these specific filters to find stocks? Have I checked every one of them? Okay, does every one of them make sense? Have I verified through history that they make sense? Or, I use them because someone else is using them? Are all the parts within my system in tune, okay, to keep me true to my principles? Or is something off? And it goes on and on and on, guys. Okay, so you must do this analysis of all the parts and some mini parts of your foundation. Both of your way of seeing the market and its structure, both for risk management and the math and probabilities behind it, the techniques you employ for the setups, everything. Okay, so to get back to the point, picking up things is perfect. That's the right way to go. Okay, you don't need, as many say, to reinvent the wheel. But listen, inheritance doesn't translate to strong bonds. I picked almost all of the things, all of the stuff that I do from others. I ended up, with a foundation similar to others, but I adjusted things and found some new things as well. Or if I did not adjust things, I answered, my doubts to solidify these parts. There is a huge difference between copy and paste compared to, copy, verify, align, adjust, paste, and then operate. Okay, so just to give you a quick example and not waste time here, for example, when I first heard that people, many traders were using tight stops, I said, okay, it has worked, tremendously well for them, but what's truly the reason behind using tight stops? Yes, you can have, for example, immediate feedback. Yes, your mistakes won't be as costly if you accompany this with small risks. But is there anything else? behind the scenes of using tight stops, and then I researched deeper, and I found out about both structural reasons and mathematical edges behind this approach, and some of them, I briefly discussed them last year in the same conference, and that, for many other parts in the foundation, guys, you will never share the same feedback from people that you inherit things. So since you won't ever share this feedback, you must find other reasons besides feedback to stick to it. And do you know when true clarity and confidence emerges? When you find, when you find personal answers to your doubts, okay, and you actually reach a point, listen to this. You reach a point that you say, you know what, from my research, 95% of what I do and what I include in my system seems optimal, both from a personality level, both in terms of personal goals, both in terms of hidden edges and behavioral reasons and system reasons. So, since I found out that most of the things I do are optimal, either I do that or I should better not get involved in the markets. And this is a phrase that I use oftenly when I'm speaking to people. I repeat it, guys. When you actually reach a state that you have eliminated doubts, okay, and through that you have fine-tuned some details, you should say, okay, I do that or I don't do anything at all, because what I have assembled, seems optimal to me. I've answered my whys, I found the good trades behind them, I've thought this foundation through. And this is when you actually can say that this is the state where true confidence begins. This is the state where markets, hostility doesn't make you style drift. This is a state where you are at ease with what you do, because you have solidified the parts and you have made these strong bonds that are needed. Okay? So that's about the topic of strong bonds. But as I said, a trending engine needs more things. Even that are not enough. And please, guys, don't be mistaken. I don't say, all that stuff are required to make money in the markets. Not at all, okay? I'm mentioning all that stuff if you really want to be, at the top of your game. If you want to really ensure longevity and operate, with a peace of mind and eliminate the chaos around you, okay? So, to continue with the topic, of mastering your foundation and escaping, the operator mindset, what's the next thing we want from an engine? Okay, so let's say now we have all the parts, they fit together, we have made them align, and we have, made some strong bonds. Now we want the engine to not overheat and break down. Another thing that leads, to many issues, especially the ones we usually blame psychology. So what does overheating mean? Overheating means pushing your engine, your trading system, beyond its limits without even knowing it. There are a ton of different foundations out there, as I said, but every foundation has, specific red lines that you shouldn't surpass. Otherwise, you will overheat the system and hurt your performance short term, or long term. The issue, though, as I said, is that people don't know what these lines are. So how do you avoid overheating? The answer is, learn the expectancy and the maximum capacity of your foundation. And that basically means knowing the ins and outs and the normalities that are bound to emerge from the very own foundation you have built. Like, you will be amazed, guys, of how often people get surprised by the normalities that they have chosen to build in their system. Okay, so let me ask you, some questions to start getting this idea about normalities and expectancies. So if I ask you right now, for example, based on your foundation, how many consecutive losing trades can you accept with a 99% certainty every month? Do you know if the answer is 5 consecutive losses, 7, 10, 15? at any given month? Or if I ask you, based on your foundation, what's the volatility you should expect, at any given period of time? Do you know the answer to that? Or if I asked you, based on your optimal stats within your foundation, what's the chance of having, let's say, 2 consecutive or 3 consecutive months, losing months, at any given point of time? Is it 30%, 40%, 10% possible? Like, do you know? And it goes on and on and on. Like, if I ask you, tomorrow you have a 5% drawdown in your portfolio, is it normal for you or is it abnormal? Should you expect it based on your foundation or not? Like, if you don't know about this stuff, then how can you decipher if the feedback you receive is to be expected or if it's abnormal? Are you sure that you are not overreacting at some periods from the things that were bound to happen or are considered normal, but by the very own foundation you have built? Like, think about that. Okay? Or if I ask you right now, do your stats trading under, let's say, an optimal mindset are able, or the ranges of your stats are able to generate triple-digit returns in realistic market scenarios? Are your stats able to create a capacity that aligns with your goals? Or or is your capacity and CAGR lower and you don't know it? And why I'm asking you all that, guys? Because, for example, if your capacity, if the capacity of your foundation doesn't align with your goals as a trader, and you don't know that capacity, it will be natural at some point to get frustrated and irritated and chase stuff and do other mistakes. So I'm asking you, I know that all of you or most of you want to have triple-digit years. Do you know actually if the ranges of your trading stats, trading optimally, okay, and following exactly the rules of your foundation, are sufficient to create that capacity? Okay, and I've actually run this experiment with a lot of people that are basically, stress tested their stats under thousands of simulations and various, let's say, market conditions. Okay, and there were many times that people, were shooting for a goal. Okay, but the capacity of their foundation could not deliver that goal in none out of 1,000 simulations. And just to get it, like, if you learned, for example, that based on your optimal trading and the ranges of your stats and frequency, most of the times, after thousands of simulations, your expected CAGR, your expected, let's say, annual returns is around 45%. But you are shooting for 150% or 200% in a year. What do you think it will happen after you spend 7 months and you are at 28%? Because the 28% is within your normalities and the capacity of your foundation, but way off your goals. So not knowing it will make you, increase the risk per trade, increase your frequency, say stuff, bend the rules, deviate from your principles, and then this is where overheating starts to occur. Okay, and then you possibly give way more money back than what was expected. Okay, so listen, guys. Goals should always be there. It's the goals that drive us, but the goals that we have must align with the capacity of our, of our personal foundations. Otherwise, at some point, you will get irritated and you will feel disgusted by the very own normalities you have chosen to build. So it's important, let's say, to stress test things and have an estimation, of the foundation itself, or if the foundation itself can create and deliver the results that you want or close to what you want. And if not, instead of pushing its limits and overheating your foundation, it's better to take a step back and analyze things and start tuning details that can increase that capacity. And of course, the opposite can happen, all right? Like, some people underplay their own foundation or use very limited resources of their engine. They use way smaller risk than they should. They are always underexposed in the markets due to not knowing what they can expect or the things that are normal to emerge. So, it works both ways. Okay? So again, expectancy and normalities have a lot to do with psychology. Most of our mistakes happen when we get surprised, when we don't know what to expect. Like, forget about trading and think about other aspects of life. Almost all of our big mistakes happen due to the feeling of uneasiness. Like, if you understand what's normal to happen from your own personal foundation in different layers, you won't get surprised that often. You won't have these big psychological swings. You won't have that uneasy feeling that leads to mistakes. And as long as you know that the capacity of your system is sufficient enough to deliver the goals that you desire, with your personal pain thresholds predetermined and in place, you won't feel the need to bend and change your rules of your system and drift away. It's the foundation itself and embracing and accepting the normalities of it, okay, the normalities that you have chosen to build, that creates the optimal mindset. It's not the optimal mindset and perfect psychology that makes the trader, guys. Like, we are all humans. We have emotions. We are prompt to make mistakes, and we will always make mistakes. I make mistakes all the time. I have emotions all the time. Like, you can't block that, and it shouldn't be blocked. But there is a difference between emotions and big emotional swings and big psychological swings and heavy surprises. These are the roots. These are what cause, what's causing problems like revenge and, chasing stocks, altering things. The more you know, the less surprised you will be. Okay? The less surprised, the better you will channel these things and trade under, a good mindset. So, alright, let's say now that, we have a full foundation. You have eliminated a lot of your doubts and solidified the parts, and you have increased your awareness around expectancy and capacity. So what else do we want from the engine? The last thing we want is to be efficient. And what efficiency truly means is adjusting your foundation in a way to deliver better results without adding a lot of pressure to the overall system. Okay? And it's also about fine-tuning parts as well. So remember what I said, previously. Even if you trust what you do, even if your foundation is complete, okay, if the capacity of it can deliver in many different simulations results that can get you close to what you shoot for, then there is no point of pushing it. Instead, it is better, as I said, to step back and analyze the foundation from within, to adjust some things to increase efficiency and performance and increase that capacity. Okay? So in order to gradually enable better efficiency in your system, okay, as I said before, first you must understand the cause and effect of your actions and use, and the use of each of the part within your foundation. So picture it again like an engine. Think about this for a moment. Inside an engine, there are certain parts that contribute to efficiency and better performance more than others. Am I correct? A classic engine, a car engine, right? And it's exactly the same, exactly the same happens with a trading foundation. There are parts in there that a potential adjustment and refinement leads to better performance and efficiency quickly. And if you gradually fine-tune these parts, you get results quicker than refining other parts. So the logical choice is what? What?
To focus on that part.
Exactly, Richard. You put a ton of weight into, these parts first, the parts that have the most contribution to the capacity, to the performance. Okay? And what I usually see in the trading space is that a lot of people put their primary weights and focus on refinement of parts, within the foundation that don't have so much of an impact overall, and forget to spend time and fine-tune the elements that truly have an impact. And I'll cover quickly some examples to make it clear. Okay, and I'm reminding you again that every foundation is different. Like a day trader might need to enhance different elements than a swing trader. A momentum trader, different, elements, than another type of trader. So I'll talk, about my specific foundation, which many of you, I know, that employ similar methods. So my way of trading, for example, is focused on asymmetrical opportunities and extreme reward to risk scenarios. Okay? And the core philosophy is based around the appearance of outliers. Okay? So I know many of you do the same. Big wins in expense of win rate. Okay? Win rate tends to generally be smaller, right? So let me ask you this. Where have you spent most of your time studying and refining? And be honest. Have you spent most of your time understanding setups and setup criteria and specific strategies? Or have you spent your time trying to understand structural things about the market and phenomena? Because when I first started, and for many years, all I was thinking about was A+ setups, 5-star setups, and criteria and filters and all that stuff. Okay? That's what I was trying to refine. That's where most of my time was spent. And I was neglecting other parts within my foundation. So the question for you, is what part of your foundation do you think is going to enhance performance and efficiency if you spend time studying? Is it market structure and phenomena or setups? And let me show you some examples real quick. Okay? So let's say, and I will open this platform. So let's say, okay, that you were trading back in June, July last year, okay? And let's say you have seen this sticker, okay? Let's go back. AST Space Mobile, right? All of you know this sticker and the move it made, right? So what does ASTS do? How many of you know? Okay, so this is the answer. ASTS is building space-based cellular broadband network to connect, standard smartphones directly, etc., etc. So the keywords for this specific company's business model is what? Space tech, and all that stuff. Okay. Now let's say you have seen ASTS make this move. Okay, you have seen this, and we are actually, let's say, around August, mid-August, okay, you have seen this being a great momentum leader, okay? So what you could think after seeing this, great momentum move, this great momentum candidate, you can start thinking, oh, maybe this space theme, maybe it will get activated. We don't know yet, but maybe this space theme is something. So what else was going on August? Then let's say a few days later after August, or if you are looking at July, 1 month later, you see a ticker symbol like this. Look, August, right? You see Rocket Lab. Okay? What does Rocket Lab do? Let's see. Rocket Lab is a leading aerospace company specializing in small satellite launches. Alright. So I see the same keywords. Space tech, okay? Wait, but before I saw Rocket Lab, before we saw Rocket Lab showing some relative strength, and let me put a fresh screen, show some relative strength back in August, September, right? We have seen what? ASTS doing great moves before. Maybe that's a theme. So would you be crazy, getting interested or buying Rocket Lab if you analyze the details structurally that possibly can make a nice move just because it had an emerging theme and a tailwind behind? Is it the 5-star or the 4-star or the A+ setups in Rocket Lab that make it make a great move, or are the structural details on, you know, and momentum elements and an active theme, okay, and a good period in the market that made Rocket Lab make a great move? That's what you have to think about, okay? And then after you have seen ASTS and Rocket Lab make great moves, you come across, you know, Lunar, all right, or, you know, Planet Labs. Is it, you know, the setup? Is it the setup here that creates a nice move? Is it the setup that creates a nice move? If you had no setup at all, would you make money buying, even randomly? And the same happened, you know, with nuclear names, with quantum computing names, with battery names. So if you understood structurally, you know, the progression of themes, you know, and track down the summaries of companies, keywords, some structural details, you know, and just bought randomly on many examples, on, you know, on Oklo, right, on QBTS, after you have seen IONQ make a great move before, right, on MVST, randomly, would you make money? And the answer is yes. Even if you bought randomly, you would make money. So my question for you, you know, is the following. What part of your foundation do you think it generates more money? Understanding structure, underlying meanings, you know, phenomena, or focusing on quality setups? Where should your focus first be to enhance your results? And the answer is simple, right? Creating a better universe of stocks to track, finding the elements of true momentum, understand the progression of stories. The setups is just, let's say, a moment within the full spectrum of a storyline and a phenomenon. So, you know, which trader would make more money? Someone who has mastered how a 5-star setup looks like, a 5-star breakout setup looks like, or someone who has tried to master these structural tendencies better? And you have to reply to that, okay? And, you know, when I was looking to increase my efficiency, that concept was big for me. I said, you know what? If I become better at building a more dynamic universe, I could possibly increase my chances of outliers, okay? By stepping into a more asymmetrical ground. So possibly increase way better the reward to risk factor compared to focusing on setups. Yet, most of the people, many people, not all of them, many people stay on the surface and think that mastering, you know, how a perfect setup looks like would enhance the results more. And I was there too. And I'll give you another quick example. And it's a question for everyone. What's, for example, more important? Understanding your pain thresholds and maximum threshold drawdowns, not volatility, drawdowns of your account, and finding your optimal risk zones per trade, or become extremely good at reading market breadth? What do you think? A lot of people might say, you know, understanding market breadth is way better. But have you ever thought the cause and effect of these things? Let's say, if you were a master at recognizing market breadth, okay, you are a master at recognizing potential shifts in the market. What actions this information leads to? And Richard, you can assist with that. Let's say someone has mastered the concept of market awareness. What action does this information prompt us to do?
They might put on more exposure at one point in the market cycle. Perfect. Versus another one. Yep, and de-risk when it gets flipped the other way.
Exactly. So some of you can say, let's say we can say the market might be weakening, you know, in the future, in the short, future. Some will say we can lower the frequency of trades, or decrease, as Richard shared, the risk per trade and exposure, or avoid taking more risk, and all of these replies are correct. So what is actually the effect of market awareness? It's a technique to add flexibility to risk management application. Flexibility on the concept of risk and exposure. So it's a part of risk management. So now let's repeat the question. What's more important? Understanding your pain thresholds and finding your optimal risk levels to operate with the core universal risk management, or learning how to adjust risk? Because the one is universal for every trade, no matter the market period. The other is a part of it. Okay? So the answer is first understanding the core thing and then add flexibility. Right? Which is market awareness. Yet there are many people that think that market awareness itself would fix so many issues or upgrade a ton the performance. It won't. There are other things that should be done first. There are other things with much bigger weight that need to be adjusted first before you move on bigger, on next things. And even when, becoming extremely good at market awareness, and listen to that, guys, that does not mean that all the times it is necessarily correct to lower your risk or get inactive. All of the great moves of last year, look at the indices, S&P or QQQ, back in December. Look what was happening in December. The indices are declining. Okay? All of the great moves before the end of the year, Ragetti, QBTS, MVST, all that stuff happened on December. A period where the indices were dropping. So, to recap, okay? There are always adjustments you can make, on your foundation that could deliver a boost to performance much faster than other parts. And everything is important to refine, of course, but you need to put, an order to find the most optimal way to synthetically boost your performance. And as I said, every foundation is different, so only after doing some philosophical thinking, what's more crucial to you. And you need to think about it and prioritize some things, and you will be surprised, how adjusting a few things, even with some brute force adjustments or something that takes more time, okay, but in critical parts, how much these changes can boost your efficiency and performance. Okay, so you see, guys, that most of the trading struggles emerge due to one of these reasons. Okay, think about whatever struggle you possibly face. You give money back, you style drift, you haven't reached the goals that you want, you do revenge trading, you chase stocks, whatever struggle you can think of. The root of this struggle will likely be due to one of these reasons or combinations of this. Okay, either you might have an incomplete engine, either the engine is incomplete, missing key parts within, or we might have misaligned parts, components inside that don't serve your core principles and don't fit with other parts. Either there are weak bonds, there are many doubts and unanswered whys that create, a stress and unease feeling and style drift, or the expectancy is unknown, you not knowing your system's normal outcomes and getting surprised quite often, right? Or, the capacity is unknown, not knowing what, as I say, you realistically shoot for, and if your goals align with the dynamics of your foundation. And last, there is a misplaced focus, you're focusing on refining low impact parts over the ones that truly make an impact on your foundation. So whatever struggle you can think of, either you think is psychology or whatever, it will likely be due to one of the or combination of these, guys. And to remind you of today's topic, thinking like an engineer, that's what it takes, guys. When we start, we're operators. We're given incomplete engines and foundations, and then we stick different parts that don't fit together. And when things don't work out, we don't know what to fix, and we don't know what to expect, and we don't have, a certain goal based on facts, but it's more of a dream. And when the engine doesn't work, we search for better engines or better parts instead of focusing deep on what we have. We are all operators when we start. But an operator can never engage with the system. An operator looks at the engine and sees complexity. He sees complexity. Okay? If you want to operate with clarity and with much more confidence and not second guess, things that you do and be at the top of your game, it's all about a mindset shift. And I truly believe that, honestly, that a lot of you that are hearing this, you are a few adjustments away from achieving things you desire, to operate with much more confidence and eliminate the root causes of a lot of your struggles. A few adjustments, a few realizations apart. Because this is exactly what happened to me. So, start thinking like an engineer. Focus on the knowledge that you may already have and try to enhance things a bit more. Trust yourself and your powers. And add an extra layer of thinking. That's how gradually, you become an engineer of your system and outperform both the markets and all of the people that want to keep being operators. So, that's about it, guys. As I said, I wanted this to be a short presentation to have you all focused. I hope you got some few ideas of what it takes. And again, it's about work ethic. And a lot of you have the work ethic this needs. It's about a shift in the mindset as well, though. This is what mostly, this is the most useful part. So, Richard and everyone, thank you, for your time. And let me know, if you want to comment on something, Richard.
Yeah, excellent. I definitely have a few questions here. Marius, I think this builds off nicely from your presentation from last year. The first question I have is, do you have any recommendations or questions that people can use to help find, if they're still building their engine in the first place, what are the missing components or the biggest areas of weakness that they should focus on? Is it just through a lot of post-analysis, looking at your trades, seeing the mistakes you're making over and over again, or are there other ways that you can help identify what you need to work on?
Perfect. First of all, filling in the gaps is the easier part, okay? Because you know what you need to put in place. You need some setups, and you need a risk management tactic and some structural understanding. What stocks do I track? Like, this is the easiest part to fill. As I said, the hardest part is later on to start making this alignment. For that, you have to actually, guys, ask questions to yourself. And as I said, spend some philosophical nights thinking about it. What I am, what's my time, that I have available in the markets.
What's your goals?
Yeah. What are my goals? What style does correlate most? What people do admire most, right? And try to, every part that you put, it's better to come from one source, because then you get more aligned things, right? Than having a ton of different sources. It's way better to have a ton of different sources when you're already kind of an engineer of your system, because then you can filter, right? But at the end of the day, you have to ask yourself these questions. And as I said, for everything, why I do momentum, why do I sell, at this specific place? What does, market research shows? Are all the principles that I follow within the system true to my selling system or my entry criteria? So you have to break it down. It's not easy to, to answer this in in 1 minute or two. Start breaking down all the parts and many parts of your foundation and ask a simple, why I do that? Is it because I found this is the most efficient way? Or because I saw others do it? Okay, I saw others do it, so let's research. And then you put a check mark, and then a check mark, and then move on. And then you reach that state of, you know what? I compared stuff, I found what's optimal, so now I know that's what I should do. Any other option, I've investigated any other option, so that's where you stand, really solid and on your own 2 feet in the markets. So it takes time, as I said. It's not something you can do, and you can use, there are, you can use some help to gradually align some stuff and answer your whys and doubts. Yes, you can do that, but it's a personal journey as well related to that. And please remind me your full question, Richard, if I missed something.
No, just any advice as people try to identify the parts that they should focus on or add to their system, or what they might be missing right now. Just any advice to help help people find what to focus on, basically. I think you answered it pretty well. And kind of the follow up. Did you have anything else you want to add on?
No. I think that's exactly what I included in the presentation, kind of step by step framework, right?
Yep. And then my follow up is more personal for you. What were some of the things as a momentum swing trader? What were the components that you focused on that you felt had the biggest impact to contributing to the performance that you wanted?
As I said, I think one of the most important is zooming out and getting away from setups and looking at the market,
the themes and the phenomena.
Like a game. The themes are not always evident, right? We get a few periods of themes, but more about structure. Where are structural points that enhance the momentum elements? How I can position myself in a place where asymmetry can emerge easier? What are really the dynamic characteristics between momentum? One of my biggest, things that I discovered was, I used to think that an uptrend is a momentum, and then I figured out, momentum will be expressed as an uptrend, but an uptrend is not always momentum, and then that led to a different universe, finding statistical edges behind using tight stops and mathematical edges. There are a lot of different things, slowly find out. For example, I use a different way of looking at fundamentals. I don't always look at revenues, for example, in companies. There are other companies that I focus more on EPS, other revenues, other I combine net profit margins. It depends on many factors, right? So as you study, you kind of find some edges that you haven't figured out before. But if I can put one or two, is these two. Focusing more on structure and zooming out and seeing the market more broad, from a zoomed out level, and finding, some mathematical edges around risk management. That's the two key things that really changed my results.
Yeah, excellent.
Through the years, right?
Yeah. And I really like this presentation and just the phrase thinking like an engineer, because engineers, as they're designing any project, any product rather, they're from the very start, they're thinking of the objectives. Those are the foremost things that they're thinking of. They're not thinking immediately what was the best tech I can fit into this thing. They're thinking high level. What are my main objectives? What are competing objectives that I might have to optimize and find happy mediums before? And, if you're designing a hybrid car that is designed to get the best miles per gallon possible, that's going to be a very different engine or car in general than a truck that's designed to tow on the construction site. And, in terms of trading systems, that analogy, there might be people who optimize for, they're focused on wealth preservation and growing with low risk and low drawdowns versus someone who might be going for larger returns, but will have to have, increased volatility to go with it. So I think thinking engineer is a really good way to think about it as a whole.
Exactly, Richard. And it's important, as I said, for what goal you shoot for, you should understand your pain thresholds and understand the normalities that come out of your system, right? Because there might be someone that wants to achieve 30 or 40% in a year and might be really good at it, but the way he operates, it might have a system just because he inherited from some others. It might have extreme volatility, but if he doesn't expect that, or if he doesn't adjust even this system, to smaller pain threshold levels and understand the normalities, someone is going to freak out. And, the opposite can happen as well. So exactly, all these are important.
Yeah.
All these.
Yeah, and where I was going with that is I think, as you've mentioned, a big part of making a system your own and the components your own is answering your doubts, answering the whys. And this is one thing that, you've recently worked with us at TraderLion to do the Momentum Trading Bootcamp, where you're showing your whole system, your whole process, but more importantly, you're showing how you answered the whys for yourself and your style, and use it as a case study. You showed the studies that you did with regards to stop losses, risk management, a lot of other stuff that you did with AI, which I think is really interesting to think about things in a different way. So I think answering those whys for yourself is a big thing, because it gives you that clarity, gives you that confidence to, again, as you mentioned, know whether a certain situation, a certain drawdown that you're experiencing is abnormal to your system, or it should be expected and just something you're going to have to deal with if you're going to use that process. So that's one thing I did want to mention. Did you want to say anything about what's been helpful about the Momentum Trading Bootcamp, or some of the issues that people have coming in regarding creating their engine, and any common questions or threads that people ask you with regards to that?
Yeah, I think when I was designing, the material behind this boot camp, I thought of myself, you know, basically of this structure, kind of, to think like an engineer, to actually make people understand fully the ins and outs of the system, right? And that's how I structured it step by step, to both eliminate doubts, answer the whys, compare things, find what's optimal, find your optimal risk levels, understand the principles of risk management, understand structure, to gain more underlying meanings, to gain, deeper things behind your foundation. Most of, the questions that I received before the bootcamp, because as you know, I've done a lot of free calls, in the previous year. So most of them were kind of related to that, and that's why I said that most of the struggles and questions happened, or root, or the causes of them are due to one of these reasons. So I think the bootcamp, after seeing the results of or the feedback from people after doing that, is a transformative, I think, experience, making all the stuff that we said here, making more strong bonds, eliminating your doubts, eliminating your whys, and having a more zoomed out approach and understanding the underlying meanings. Like, this is what peak performance takes. This is what real trading is, right? So if I missed something in the question, Richard, feel free to remind me again.
No, I think that's exactly the big benefit of the bootcamp, which people are interested. We'll have a link in the description if you want to learn more about it. But I think people go into it, they want to learn your setups. They want to use learn the parabolic short. They want to learn the episodic pivot, which you do cover in depth, and share your process for that and all of that. But it's more about you showing them how you've done the work and become an engineer of your own process and answered the whys for yourself. That's the important, I think, crystallization of the takeaway of the feedback. The benefit of the class is they see how you did it, and you lay the path that they can do for themselves. So just want to mention that.
Exactly,
anything you want to
Richard.
add?
Yeah, exactly like you said. Because as I said, having the parts, I could just give my parts, right, of the foundation. I do that, all the parts, right? As I said, it's not enough. So that's why we agreed together to do it in a small group format and do it live, and and spend many hours with each group, just to have this effect, of people truly understanding what it takes, truly understanding the foundation. So I think, yes, we summed up everything related to that.
Yep.
So again, Richard and everyone, thank you for your time, and I send my regards to to the rest of the speakers, and I'm wishing everyone a fun summer and success until we speak again. So
Yeah, excellent.
Richard,
Marius, thanks again for your time. To everybody watching, I hope you enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel. Drop any questions you have in the chat, and we'll be right back with the next presenter. Stay tuned. Okay, welcome back, everybody. It's my honor to introduce the next presenter at the TraderLion Conference, Dr. Brett Steenbarger. Dr. Brett Steenbarger is a clinical psychologist and performance coach renowned for his work with elite traders and hedge funds, blending behavioral science with real-world market expertise. He's the author of several influential books on trading psychology, including The Daily Trading Coach and Enhancing Trader Performance. Brett, first of all, thank you so much for taking the time. Great to have you back. Been really looking forward to this one. You'll be presenting on the best practices of professional traders. And this should be a great one. So welcome.
Awesome. Thanks a lot for having me, Richard.
Of course. Well, let's go ahead and dive right in. And as we go, if you have any questions, leave them in the chat. And it'll be cool to see what we've got in store. So let's dive in.
Good deal. Okay. Well, thank you, everyone. And I look forward to this. I'll be sharing some ideas about best practices from the best professional traders that I work with at various hedge funds. They approach trading psychology in a different way than beginners in the markets. And I think we can learn a lot from observing how professional traders approach mindset and how they approach performance. Now, in the subtitle, you see Keys to Positive Trading Psychology. And what I mean by positive trading psychology is the application of positive psychology, the psychology of our strengths, the psychology of our best performance, to the trading world. I have a book coming out in early 2026 called Positive Trading Psychology, and it's a direct application of research and practice in positive psychology to our performance in the trading world. I have a couple of links there on the home screen. The first is my blog, traderfeed.blogspot.com, where I post regularly on topics of trading psychology. And then there is a free online book written in blog form that's called Radical Renewal. And that is about the spirituality of trading, not just the psychology of trading. And we'll be talking about that a little bit more. And then finally, on X, formerly Twitter, Steenbab, Steenbab, a great way to contact me directly if you have questions, comments, and so forth. Okay. So let me start with a few preliminary comments. The first is that trading is a performance activity. Just like sports, just like the performing arts, trading expertise is a process of development that takes place over time, leveraging our talents, building skills, and leveraging our psychology, our mindset. Now, the reason I'm emphasizing this theme is that many times we hear that trading success is a function of particular patterns that we trade or particular approaches to trading. And if we think about that for a moment, we see that that makes no sense whatsoever. If trading success were simply a function of following chart patterns or ideas in markets, then elite trading success could be replicated by anyone. In fact, anyone who promotes chart patterns or setups as the basis for success, anyone with reasonable programming skills could program those ideas, back test them, produce the back test, and you could automate the whole process, but we never see that done. And the reason for that is that the trading ideas we have and the patterns that we follow are a little bit like the plays that basketball and football teams run during their contests. In fact, you might be familiar with Mike Bellafiore's book, The Playbook, that successful traders develop a playbook just like successful basketball teams have a set of plays that they run. But no one pretends that if I were to take a play or two plays out of the New York Knicks playbook, that I could replicate their success. The real edges come from how we implement. And the reality is that different patterns work in different markets. When I first started working at a large multi-strat hedge fund, I worked with quant teams that were developing trading systems. And what I found was that the systems that they traded, and there were many, many systems, I was surprised by how many they traded, the systems that they traded were not running all the time. Depending on market conditions, some systems would be running and other systems wouldn't be running. And then if volatility would increase, or if we have a more, let's say, risk-on set of conditions, other systems would kick in and others would kick off. So there is always a shifting of the systems being traded. Just like in sports, you don't run the same plays against every single opponent all the time. You select from the different plays. And the skill, the success comes from knowing which plays to choose and how to implement them against particular opponents or in particular situations. That takes expertise. So that, as in any performance activity, success is a function of expertise development. Think about sports, think about performing arts. You start working with a mentor, you practice, develop skills. It takes a while to achieve professional success where you can make a living from your performance. One of the big problems in the trading world is that people want to trade. They want to make money right away, and they take risk too soon. They take risk before they have gone through the process of expertise development. And as a result, they think they have the plays that they should run, but in fact, they haven't developed the expertise to run those plays and to know which plays to run in different situations, and they lose money. And then they become frustrated. And then they say, oh, my problem must be my frustration. My problem must be my trading psychology. But the trading psychology issues, the emotions, the frustration, and the eventual tilt trading, that's the result. Those are the results of the problem, not the actual problem. The problem is that we haven't taken the time to develop true expertise. What makes it interesting working at hedge funds that are running billions of dollars of assets under management is that everyone who works there has gone through the expertise development process. So that of the people I meet with at various funds, no one talks to me about trading on tilt. No one talks to me about discipline problems. Literally, I never hear it. That's not what trading psychology is all about. Trading psychology is about maximizing performance under conditions of change and uncertainty. Okay. So, what are some of the ingredients of positive trading psychology, of applying positive psychology to the trading world? The first one is what's called a solution focus. So often when traders review their performance, what do they focus on? They focus on their mistakes and try to correct what they did wrong, which is fine. What they don't focus on are their successes, what they do well, what they see well. To perform at our best, we have to identify what we do at our best. And we can only do that by studying our successes. So right away, you want to think about how you are reviewing, how you are studying your trading, and are you really developing your own best practices? And are you identifying best practices for different kinds of markets and different kinds of trading? Which is what a playbook is really all about. What I see in the teams that I work with is that they don't just focus on goals, which is important. They create visions. They have a sense of what they're trying to cultivate, what they're trying to develop over time. They have a vision for their success, individually, but also as a team. They're not just focusing day by day. They're not just focusing on catching the next move. They have an idea about how they want to develop as professionals, how they see markets evolving, and how they can participate in that evolution. And that guides their career thinking. They're thinking in big picture terms, not just the next day, the next trade. Dynamic review. The research in psychology tells us that expertise development is a function of deliberate practice. We perform, we review our performance, we identify what we did well and what we didn't do so well, we make changes, and then we perform again, and we identify what we did well and didn't do so well. And so we're constantly refining. In the best trading settings where I work, that review process is dynamic. It's interactive. Where I work in the professional settings, this is very important, no one trades in isolation. Everyone is part of a team, and they review performance as teams. So just think of that. If I'm reviewing my performance, you're reviewing your performance, and then we interact, and I share with you what I'm working on, you share with me what I'm working on, what you're working on. Now all of a sudden, I'm learning from your successes. You're learning from my successes. I'm learning from your mistakes, and you're learning from mine. So right away, the learning process is multiplied many times over. There's so much to learn and so much to master in financial markets, just like in any performance domain, that being in a team accelerates our learning, accelerates the development of our expertise. This is particularly valuable in settings where there's teamwork, interaction, but complementary talents and skills. In other words, in building a team, you want people who are similar in personality, similar in how they communicate and interact with each other. They get along with each other. That's very important. But you want complementarity. You want differences in talents and skills. Because then people on the team are going to learn from your strengths and you're going to pick up theirs. This is super important and super challenging for individual independent traders. How can you be part of a community? How can you be part of a team? How can you make sure that you're not just working in isolation? By connecting with the right communities, by connecting with the right teams, the right people, you can very much learn from them, help teach them, grow, grow, grow. Okay, this is a little review from last year's presentation, Richard.
Yep.
And what we're looking at here, and what I want people to assess for themselves, so this is a little quiz people can take for themselves. These are the values in action, VIA, categories of strengths that come out of the research literature in psychology. There's 6 big categories, and there are 3 main strengths in each category. The first one is wisdom, which includes creativity, intellectual curiosity, and a love of learning. Courage, which relates to risk-taking, bravery, honesty, perseverance. Humanity, which are interpersonal strengths, kindness, love, social intelligence, and sensitivity. Justice, so that's a different kind of interpersonal set of qualities, includes fairness, leadership, teamwork. Temperance, humility, being modest, self-regulation, self-control, prudence, and finally, transcendence. That includes gratitude, spirituality, hope for the future. Now, what I would like each participant to do is quickly jot down for yourself your top 3 strengths as you see them. These would be strengths that show up not only in trading, but in your personal lives and work lives. What are your top 3 strengths? And then identify your next 3. So you're identifying your top 6, 1 through 3, your top strengths, and then 4, 5, 6, your next set of strengths. And as you do that, notice which categories, the wisdom, courage, humanity, justice, temperance, transcendence, which categories are coming up more than others. Now, if you don't name a particular strength, that does not mean it's a weakness, but it just means that it's not something you routinely draw upon for your best performance. So, for example, for myself, creativity and love of learning in the wisdom categories are top, and spirituality would be my 3rd. And sure enough, that is a function that shows up in what I do for a living. I teach at a medical school. I work with people to help them with their performance in markets, help them figure out new ways of doing things, help them figure out how they can best succeed. Now, that next 3 on your list are called latent strengths. That's the term that's used in the research. And latent strengths means strengths that we draw upon when our basic strengths aren't available to us or aren't appropriate for a particular situation. So, for example, a latent strength, number 4 for me, would include some in humanity, such as kindness and love. I have 5 children, 7 grandchildren, and 5 rescue cats. Bringing up a family, taking care of a family, that's something very, very important to me, and shows up as one of those latent strengths. Now, what the research tells us is that many times our greatest growth comes from drawing upon those latent strengths. A situation is a challenge for us because our most basic strengths, those top 3, aren't working. They're not meeting the challenge. So we need to draw upon one of those latent strengths to meet the challenge. So for example, if I'm having problems in my trading, which I sometimes do, my basic strengths about creativity and love of learning and spirituality, they're not doing it for me, but maybe that latent strength about the kindness, love, the social sensitivity, all of which is related to teamwork. I may end up being able to draw upon my connections to other traders and my sharing of ideas with them in order to figure out something new for myself. That would be a simple example of using a latent strength to build upon one of our basic strengths. But notice here in the positive psychology framework, we are starting with the notion of strengths. We are looking to identify our strengths and make the most of our strengths to build our performance. It's not just about solving problems. It's not just about trying to get rid of negative emotions. It's figuring out who we are at our best and amplifying that.
And can I jump in with a quick question?
Please do.
Yeah, any advice for people as they're doing that exercise of if they're not quite sure what their top 3 are or what their latent strengths are, should they think more about what's happening outside the markets versus, how these apply to actual trading? Any kind of helpful words there?
Super, super question. And yes, I did not make that clear. You should definitely think outside of markets. Think about your life in general and what are some of those strengths. A great exercise that I do with married traders is I ask the spouse to name the strengths of the trader. Sometimes they can't come up with any. Another way of doing that would be list your greatest successes in life, your most meaningful experiences, your greatest achievements, and then figure out the strengths that helped create those. So that's, by reviewing your life, you can figure out what those strengths might be. All right, so let's get to a few best practices that I've observed with professional traders. The alignment of processes and strengths. In other words, how traders do their trading, their processes for generating ideas, their processes for setting up their trades, structuring their trades, managing the risk of those trades, updating trades, which means, okay, I'm in this trade and now it's 3 hours later. What's the risk reward now? Should I be sized the same way? And then, of course, after action reviews, reviewing performance, but drawing upon our strengths in doing that. And I'll give an example in a minute. So with idea generation, how do you find opportunity in markets? The best traders have unique ways of finding opportunity and ways that play to their strengths. So for example, one trader who I work with talks with lots of different people in markets, has lots of colleagues, people that he has known for a long time, and he talks with every one of them every single day. And he gets their view of what's happening in the world, what's happening in markets, and he jots down notes of every conversation he has. And not only that, all those notes go into a database. So that, let's say he's talking with 12 different colleagues, and 6 of those colleagues agree about a particular view. His database tells him, when these 6 people agree, how often has that worked out? So now, based on his social connections, he has a statistical method for identifying where and when there's opportunity. Notice how that's unique, how that's different. This is what I see with successful professional traders. They find unique ways of going about things based on who they are and what their strengths are. Trade structuring and management. So for example, there are traders who I work with who will structure their trades through various options structures, or who will structure their trades in relative terms. So I'm buying this asset and selling this related asset. So if I'm buying growth stocks and selling value stocks, it doesn't matter if the overall market goes up or down as long as growth outperforms value. So they have a different way of structuring their idea and then, of course, of managing their positions. Trade updating. This means updating the odds of a trade. So often we hear people put on a position and they have a stop. And they have a place where they stop out, they have a target. But the people I work with, as the market's moving, as their positions are moving, they're constantly updating. Is this idea working out? Is this more likely to outperform, less likely to outperform? And they'll get bigger in the trade, or they'll reduce the trade, or they'll hedge the trade. So there's a dynamic management process of trades, not just spot to stop, so to speak, being in the market and having a stop point. Now, this ends up being particularly important, and we'll be touching on this later, because very often the key to success is recognizing in real time when your idea is playing out and then getting big in that idea. And there's a separate risk reward for that piece where they're getting big. So they know, kind of like a boxer, in boxing, they know when to go after the opponent. They know when they have the edge. And vice versa, when it's working against them, they have criteria for scaling out or getting out altogether. It's that dynamic sizing process often that accounts for much of their profitability. There are many very successful traders who I work with where their hit rate, their percentage of successful trades is not much greater than 50%. But the reason they make good money is because they identify when it's time to get big and when to pull back. So their risk-adjusted returns are very good. They have a larger right-hand tail of returns than left-hand tail of returns. And of course, they have a dynamic process for reviewing performance, improving performance, using their strengths to identify what they've done well and to correct what they haven't done well.
And sorry, can I jump in with one more
Please,
question here?
Go for it, go for it.
So of these 4 major steps of a trade, I'm curious to hear your take on, where teamwork is most helpful and where it might create unnecessary noise. So for instance, step 1 and step 2, step 1 and step 4, idea generation, after action review. I think it would be incredibly helpful to exchange ideas with a team, exchange with a trading buddy, and then likewise, to help find ideas in the first place, and then after action review to get other perspectives, other thoughts, other feedback. But I am thinking about, step 2 and step 3, trade structuring and then trade updating. In the moment of the trade, is it helpful to have too much out? Is it possible that you get too much outside perspectives and that interferes with your own interpretation of what's going on in the charts, what's going on with the trade? So that's just what came to mind, but I'd be curious to hear kind of what you've seen on trading desks, if that's helpful, if that's true, my observation.
Yeah, very good question, and you're absolutely right. More is not necessarily better, and especially with the steps 2 and 3, the trade structuring, the trade updating, more can create distraction. And distraction is a big enemy to successful trading. Now, there are occasions where someone on the team will observe something happening in a related market.
Right.
Or they'll see related news, and that can help with the updating. A good example would be teams that I work with who are trading commodity markets. And they might be trading natural gas, they might be trading crude oil, they might be trading power. And someone on the team is monitoring updates in weather. Mm-hmm. And suddenly the weather forecast is changing. Well, that means something very different for crops, something very different, let's say, for consumption of power. And so if the forecast is in the direction of the trade, is supporting the idea of the trade, that could lead to sizing up. But it's not the portfolio manager who's necessarily following all those outside developments, like shifts in weather forecast or news items that may come out that could affect the evaluation of the trade. So sometimes it's helpful to get updates from team members that way. The other example would be at hedge funds, and large teams have members who actually do the execution. Mm-hmm. So the portfolio manager comes up with the idea, puts in the order, but there's someone on the team who is looking for the best place to place the order to get the best risk reward. The execution member, is noticing buyers and sellers in real time. And they may notice that selling volume is drying up in the market. Or they might notice that there's hitting of bids in stock index futures, but the index isn't going down. The sellers can't push it down, and they'll give that feedback. Price is holding. They'll give that feedback to the portfolio manager, and a portfolio manager might say, buy 10,000 more. So that would be an example of teamwork in the updating. But you're absolutely right that idea generation, coming up with ideas. There's a lot of input from different places, and synthesizing that input in the after action review. There's a lot of input and learning from each other and figuring out how to improve going forward. But many times in focusing on trades that are on, we need that focus, we need that concentration, and can't have too much input.
Yeah, those are helpful examples. Thank you.
Sure. Best practice number 2, focus. And there's something on the Trader Feed blog today that I put up about working on improving our concentration, improving our focus. So there are a few different ways that we can maintain what psychologists call the flow state, the state where we're really immersed in what we're doing and where we can access our best thinking, our most creative ideas, taking breaks at various points, strategic times during the day to refresh our minds ends up being very important. Fatigue can lead us to become distracted and to miss things that are happening in markets. Alternating work, doing different kinds of work at different times. So we might do reading early in the day. We might then interact with different traders and do that work. We might summarize charts. We're doing different types of work over time so that we're not overly taxing any one particular cognitive modality. Physical state, lots and lots of research about how optimal physical states lead to the flow state of performance. If we've gotten the right amount of sleep and the right amount of deep sleep, if we've gotten the right amount of exercise, if we're energized physically. It turns out that physical strength, physical development impacts our overall well-being, and that impacts not only our health, but our performance. The next category is what I posted today on the Trader Feed blog. And Richard, this is what I see as the great frontier of trading psychology. So we can go back a few years from now and figure out if I'm full of shit or not. There is a new generation of wearable devices that measure our brain waves, that measure blood flow to the cerebral cortex, the frontal cortex, so that we now have access to information about our brain functioning that never used to be available to individuals. You had to go in a lab or in a physician's office to get that information. So in real time, I can see feedback of when I'm more focused, when I'm more distracted, when I'm more in a problem-solving mind, or when I'm in a flight or fight emotional mind. And this is the important part, I can practice different techniques to increase my focus over time, to increase the quality of my concentration. And when my focus is greatest, and when I can sustain it, that's when I'm most likely to see opportunities in the market, pounce on opportunities in the market, and not be distracted by what's going on in the market. We can literally train our brains for better trading. I think this is a really important frontier. I'll be writing about that, and it's part of the book that I have coming out. And it creates a way that we can end up coaching ourselves. I'll just mention parenthetically that a lot of what many traders attempt with quote unquote meditation doesn't work. It doesn't put the brain in optimal states for concentration. Not because meditation is worthless, of course it's not, but just clearing your head and taking deep breaths, that might get you relaxed, but there's a big, big difference between being relaxed and being focused. What we want to train is not just reducing emotion and quieting ourselves. That's nice. We want to train our minds for better and better and better focus, because that's how we'll see things most clearly in markets. When we are very focused, ideas come to us. We're not trying to manufacture ideas. We observe, and we start to see it coming together, and we know what to do. We can access our expertise, our experience, better when we're in a state of high focus. Creating challenges. What the research in psychology tells us is that the flow state goes away. We can't stay focused on what we're doing if our tasks are too easy or if they are too difficult. We want to have challenges that keep us maximally engaged, but in a doable way. So the best traders that I work with, they're always growing. They're always looking at new things, different things, trying out different ways of trading, because that's creating challenges that keep them psychologically involved and cognitively involved. And finally, there's a lot of research about the role of having fun. Teams that I work with not only review performance together and develop ideas together, they go out together. They have fun together. They share fun experiences. They get together after hours and talk about business, talk about personal life, but that builds the teamwork, but it also makes the work enjoyable. And when we are in a state of enjoyment, we're most likely to do our best thinking and performing. Best practice number 3, creativity. Every single very successful trader that I work with does something unique. They have some unique way of finding opportunities, of expressing those opportunities, of managing those opportunities. They look in unique places for opportunity. They have unique ways of processing information. So, for example, in terms of looking for unique opportunity, they may start to monitor new data sets. There are AI applications that will evaluate language in news reports and will tell you when the language fits certain categories, certain emotional categories. And many times those can point to how the public is thinking and feeling and might give an idea about market-related sentiment. unique ways of processing information. The teams, again, play to each other's strengths, processing information visually, discussing information, sharing written reports. There are many different ways of presenting information to help it sink in. And the research in psychology tells us that we're most likely to remember information and most likely to be able to use information when we've processed it in multiple modalities, in multiple ways. Networking for creativity. So talking with different people who have different strengths to help generate new ideas and new thoughts. Positive brainstorming. It turns out in the research literature, traditional brainstorming doesn't work. You come in with your ideas, I come in with my ideas, we share ideas. What really works is if you have done some research and study, and I've done some research and study, and our colleagues have done some research and study, and then we come together and we share our conclusions. Some of the teams I work with will actually draw mind maps based on what all the team members come in with to see where the ideas come together and where there might be some real edge, some real opportunity. And finally, as I mentioned earlier, sharing trading reviews. So when I review my trading and what I do right and what I need to improve, you're doing that and other team members are doing that, and we're benefiting from each other's experience. The creativity is that we can learn from how other people are improving their trading and make that a part of our process. Selective sizing. It's so important to know our risk personality. Some people are real risk takers. They enjoy taking risk. Others are risk sensitive. What the research tells us is that people who are risk takers, people who are more extroverted, tend to go for absolute returns, make the most money from their trades. People who are more introverted, who are more risk sensitive, go for risk adjusted returns. They're trying to make the most while losing the least, which would show up in a Sharpe ratio, for example. Many times, if we try to take more or less risk than our personality is wired for, we experience frustration. So we need to know what our optimal risk taking is. And how do we do that? By studying our performance, by seeing when we're performing well, when we're not performing well. And as I mentioned earlier, updating risk reward as trades go forward, and then becoming selectively aggressive. The idea is playing out. We see that it's working. One of the areas that I pursue in my own trading are studies of market breadth. So this is for the stock market. And how many stocks are advancing and declining? How many stocks are making new highs and lows for different sectors? How many are making 5-day new highs and lows, 10-day, 20-day, 50-day, et cetera, et cetera, et cetera. So I'm looking for patterns of strength and weakness, patterns of breadth, the way that some people might look for chart patterns. And sure enough, if you do back testing, if you collect a database of breadth, which I do, you know that certain breadth patterns show very positive, very bullish results over the next 2 weeks of trading. But I'm a short-term trader. I'm not going to just put on a position and let it sit for 2 weeks. But what will happen is I'll put on my position. It'll go up, it'll go down, it'll go up, it'll go down. And then I see, if I'm long, I see buyers coming in. And I can identify, aha, the 2-week pattern is starting to play out. And I can selectively get big and keep my stop at a reasonable level. And again, it's that selectivity that accounts for much of success. And of course, selective profit taking. If market conditions change, if the breadth patterns change, we're quick to take our profits, we're quick to scale down. So it's flexibility in risk taking, not just all or none. Well-being, best practice number 5, maximizing our experience in life, because that's what will maximize our performance in markets. There are 4 big dimensions of well-being, according to the positive psychology research: happiness or fun, enjoying what we do; fulfillment or purpose, doing things that are meaningful to us; physical well-being; and quality relationships, romantic relationships, friendships. To perform at our best in markets, we have to fire on all 4 cylinders. We have to experience on a regular basis joy, contentment, physical well-being, love and connection. I mentioned my online book, Radical Renewal, and gave the URL on the first slide that talks about the spirituality of trading. Does our lifestyle give us energy, or does it deplete us? In the professional trading world, the big enemy of performance, or one of the big enemies of performance, is burnout. Are we living a life that inspires us, that gives us energy? And many times that means having things in our lives that are more important to us than trading. Because during the inevitable drawdowns, we always have something that we can draw upon that's meaningful. And finally, best practice number 6, adapting to market conditions. This is so important. Not only do you want to study your performance, again, what works well and what hasn't worked, you want to study your success across multiple markets and multiple market conditions. That means, back to Mike Bellafiore's idea, that you're going to develop a playbook of your best trades, but you're going to be developing multiple playbooks for different market conditions. Bull markets, bear markets, choppy markets of low volatility. And then you're going to have processes for adapting your processes. In other words, you don't just have a trading process, one thing that you do all the time. Rather, you have a process that allows you to adapt your trading to different market conditions. In the hedge fund world, they monitor closely volatility, how much movement there is, and correlation. Are things moving together, or are they moving separately? If we see increasing volatility and increasing correlation, that often happens in momentum markets, happens quite a bit in risk-off markets. And that might point us in one direction as far as trades that would be helpful to maximize the environment. If we have a low volatility environment where there's low correlation, some sectors are doing one thing and some sectors are doing another thing, we call that, a rotational market. And so we can figure out which sectors are stronger and which are weaker, and we can find stocks within those sectors to maximize the pattern of weakness and strength, and that helps us adapt to market conditions. But in our preparation, we're not just looking for certain chart patterns, we're not just looking for certain ideas, we're first looking at the environment. Think about being an airplane pilot. What do you first look at? You look at the weather conditions. You look at what the environment is going to be like for your flight, because that will tell you altitudes at which you fly and how difficult the flight might be and so forth. You're always identifying your environment and adapting to that environment. And finally, what's more important to you than P&L? These are two of my rescue cats. The black one is Aries, the white one is Molly, and they have fallen in love with each other. We rescued them at different times. They literally, I have so many pictures of them hugging and kissing and carrying on, but raising a family, rescuing animals and giving them a wonderful home, helping people, not only within the family, but in the trading world, in the world of psychology. Those are things for me that are more important than day-to-day, week-to-week, month-to-month P&L. And it's because we have something that is more important to us than short-term performance, that we're able to have an energized, fulfilled life, even during the ups and downs of trading, and put our energy into our trading efforts. The best way to be fully engaged in trading, fully energized in trading, is to have a life that fully engages you and fully energizes you. Richard, thank you so much. I appreciate the opportunity to share ideas with everyone and look forward to questions and comments.
Yeah, first of all, that last sentence that you said, I think, is so important. That sums it up perfectly. And I wanted to ask, is that a heating pad that they're sitting on? That looks like a good spot. Is that a heating pad, or is that just a blanket of some sort?
That's a blanket,
okay.
But I like the idea of heating pad, although with the weather being what it is right now in the Northeast, I think we'll avoid heating pads.
For sure.
But yes, they would love a heating pad. But that's a very soft blanket, and one of the places they hang out together.
Yeah. My dog, in the wintertime, we've got a heating vent right under basically pointing at the dining room table right underneath it, and that's her spot that she sticks there all the time during the winter. That's what they love. But anyway, getting to the actual questions. First, I want to go back to what you said at the beginning, the distinction between how hedge fund traders and professional traders approach trading psychology and more beginners approach trading psychology. You mentioned how professional traders don't experience tilt as much. Is it that they don't experience tilt, or is it that they've learned how to deal with it? It doesn't impact them as much. They have processes in place to protect them from, having negative impacts from its tilt. I'd be curious to hear your distinction about what separates, a beginner trader experiencing tilt and how that might affect their trading, their portfolio, versus a professional trader who's very experienced.
Yeah, I like that question, Richard. Yes, so professional traders definitely experience frustration. they research, they work hard, they come up with an idea, and it doesn't work out. Anyone who's achievement-oriented will be frustrated in that situation. So it's not that professional traders are emotionless, not in the least. But they don't allow their emotions to overwhelm their trading,
right,
or to interfere with their trading. There's an important reason why. When I first began working full-time at a hedge fund in Greenwich, when you entered the front door, so on the left-hand side, there was the security desk, and on the right side was a big framed mission statement for the fund. And even people who worked there for a while would stop and read the mission statement. And the mission statement was all about what's called fiduciary responsibility. The hedge fund, which was managing more than $20 billion, was managing the money of investors, and particularly of pension funds. This was people's retirement money. And so they put that mission statement up there to remind everyone who worked there that you have a responsibility to the people who have invested in us. You are the caretaker of their retirement money, of their future. And when you're aware of that kind of responsibility, you don't go on tilt. You don't allow yourself to get overly emotional. You learn to take a time out if you're frustrated, that kind of thing. Many times having a higher purpose for our trading is part of what helps us avoid tilt, because we have a greater sense of motivation for our positive purpose than we have our frustration when things don't work out.
Excellent. And throughout this presentation, as well as last year, you've kind of said quite a few times how beneficial it is for these professional traders to act as a team, work as a team. Obviously, retail traders, that's something we have to seek out and really find for ourselves. Are there any qualities or advice you would suggest to people as they're looking to find a group of traders to trade with or exchange ideas with? Anything that you find is really helpful on the professional teams that they can kind of replicate in a retail situation? Twitter can be a great community, but or Discord groups as well. But you want to make sure it doesn't get too noisy and maybe not too big. But yeah, any thoughts or recommendations for people as they try to look and find those groups to work with?
That's great. And I would start, Richard, by, if someone's at the very beginning, I would start with just finding one trading buddy. Mm-hmm. Don't worry about a whole team at first. Find one other person who's a giver, not just a taker, who has experience that can teach you things, and where you have experience that could teach them, where there are personality similarities, but maybe different experience, and just work on the teamwork on a buddy basis. And if that works out, then the two of you can figure out, maybe we should add a third and a fourth. Right. And pretty soon you're developing a team. But it starts with that one-on-one connection. Just one person to review trading with, review ideas, start the trading day with. What are you seeing in markets? What am I seeing? Who do you get along with? Who inspires you? Who informs you? And you might have to reach out. It takes some, you have to date before you mate. You have to reach out to a number of people to find the right trading buddy. But a community is a place where people can get together, virtually or otherwise, and where you could find potential trading buddies. That's a valuable aspect of a trading community.
Excellent. Yeah, that's great advice. Going back to practice number 4, I really liked what you said there about, you gave the example of, you look at the breadth metrics and that helps you build conviction and confidence and size up a trade. And I just wanted to make the point here. There's not really a question here, but just to emphasize, how amazing that is. That is one of the edges that you incorporate into your system, and your edges might look different than myself, another trader. Warren Buffett's edge is completely different. He's looking at the fundamentals, but edges come in all shapes and sizes. And it's all about, characteristics that we pick up that represent, the higher potential for a trade being successful. And that can show up in many different forms: technical analysis, fundamental analysis, macro analysis. Pick and find the ones that, work for you and make them your own, and help you trade confidently. Because a confident trader, I think, is one that executes better and just has a little bit more fun as well. So I think that was a great point that you made. Anything to add along those lines, Dr. Steenbarger?
Yeah, and when you do find a trading buddy who looks at their own unique things and you're looking at your unique things, the combination can be quite powerful. I've mentioned in past presentations that for years and years I've studied the NYSE tick, T-I-C-K. That's the number of stocks trading on upticks versus downticks every moment during the trading day. And right away, you can see from the NYSE tick who is involved in the market and what they're doing. If institutions are really involved in the market, you're going to see lots of upticks, lots of downticks. You're going to see a wide range because they're trading baskets of stocks, and there'll be a lot of stocks upticking at the same time, downticking at the same time. If you see very low levels of upticking and downticking, institutions really aren't involved. Those are going to be less volatile markets, and they're going to move very differently. Who you're trading against will be very different. And so by monitoring the NYSE tick environment, you know who you're playing against and which patterns in your trading are most likely to work out.
Excellent. Well, I've really enjoyed this discussion. Thank you so much for sharing your expertise. I definitely want to maybe scroll back to the very first slide because I want people to know where to connect with you if they'd like. But any last bits of words of advice for people as they're going through their trading, studying trading psychology, or, just trying to incorporate positive trading psychology into their existing processes?
Yeah, one practice at a time, one improvement at a time. If you try to change everything all at once, you'll end up getting frustrated and confusing yourself. But you want to review your performance, and you want to really identify what really worked. Like I said, just one thing that really worked, one thing that I really want to improve, and just do that day after day after day. And cumulatively, you make some pretty big changes. So you have my blog there, the traderfeed.blogspot.com, as well as the book on the spirituality of trading, leadingrenewal.blogspot.com, and my Twitter, my X handle, @Steenbab, Steenbab, and people can contact me through there.
Excellent. And I forget if you mentioned it, was the title of your book going to be Positive Trading Psychology, or do you have the title in mind just yet?
Yeah, that is the title, Positive Trading Psychology. Yeah. And that will be coming out early in 2026. And Harriman House is the publisher.
Oh, very nice. We just worked with them on our book, so fantastic. Well,
yeah, they're a good group. They put out some good books. They've really taken an interest in the trading community, and I think they're doing some good work. But yes, so these ideas I'll expand upon in the book, but also I expand upon on the blog and invite people to get involved.
Excellent. Well, looking forward to it. And again, thank you so much for your time. To everybody watching, I hope you guys enjoyed. Let us know what you thought in the chat right now. Leave a like if you enjoyed. Subscribe if you're new to the channel, and we'll be right back with the next presenter. Stay tuned. Thank you very much. All right, welcome back, everybody. It's my pleasure to introduce the next speaker of the TraderLion conference, Scotland. He'll be discussing how he interprets charts, identifies pivots, and how he trades them as well. Really been looking forward to this and excited to hear his take on things. I think it will revolutionize how a lot of you look at charts. So, Scotland, thank you so much for being here, and excited to dive in.
Well, that's a kind introduction, Richard. I don't know if it'll revolutionize things, but this is really, I guess, my way of kind of leveling up. I've done this before, and we've talked about some other setups, but over the last few years, I've kind of worked on performance optimization, and this is kind of my thought process and kind of where we're at, or where I've gotten to since that point. You probably have heard me if you followed me on Twitter. I talk about Icarus levels and Atlas, levels, and I'm going to get into that and how I came up with, those kind of observations and what it can mean for my trading as well as hopefully other people's as well. So let's see if this goes. So my presentation, Icarus to Atlas. Those are my two Greek characters. Obviously, Icarus is flew too close to the sun and melted some candle wings, and Atlas held up the world. So those are the kind of the visual images that I have, in my mind when I'm trading. So with that, we have our legal disclaimer. It's not financial advice, and you're welcome to read that. But essentially, I'm not making any representations or giving trading advice here. Okay, a little bit about me. I became very interested in trading when I was in college. It was the internet.com era. I saw these, I guess, news programs, 60 Minutes maybe, on day trading. I thought that sounded like the coolest thing ever. When you're working at a coffee shop or some other low-paying job, when you're hearing people making thousands of dollars in a few minutes, that sounds pretty good, right? So that was kind of the awareness of what the people were actually trading. Yeah, what is happening here? It all sounded very scary, but then there were some people in my dorm that were I don't know if they were trading, but they were investing, and they kind of showed some of that stuff. So I'm like, oh, people, you don't have to be in your 40s to do this. You can be a 19, 20-year-old kid and do this as well. So then I really became interested in that and started getting involved. Yahoo Chat was the original FinTwits back in the day. Message boards, and just kind of, there weren't a lot of resources, but I would frequently study in the business school, and I read it, whatever, financial book, whether it was Peter Lynch or William O'Neill or, anything that was available. I was reading, that every day. I tried to learn as much as I could. At the same time, I began placing trades, and I was primarily like a breakout trader, I guess what people would call like a low float trader, finding a new high, and it would almost always gap up the day after you bought it. So it was very, very easy to make money in that environment. Obviously, things changed, but at that time, it was a very forgiving period to learn. Probably similar to some of 2021, 2020, and frankly even last year. Very easy periods that you can trade, and so I became interested in that. Thought about, what's the next step? Is this something that I can do as a career? Lo and behold, I took an interview with a market making company. They traded stock options on this CBOE. Got the job and spent a year there. The best part of it is I couldn't trade my own account there, and so I got to keep a lot of the gains as the dot-com burst. But really saw how that environment was changing, and people were getting laid off. The market went into a bear market. Trading volumes dried up, and it just eventually they cut the program, and kind of picking everything up from ground zero again. And when I started trading a couple years later, went to grad school first, but picked up some trades, and the breakout trades no longer work to the extent that they used to. So, and I realized I didn't really have a great system, and so the next I guess couple decades, and I'm still doing, is just getting better and better, and I keep to hope on that trajectory. I've had some great years, and that's kind of really what have I learned from that, and how do I build on that, and a little bit, tried all the things, found out what didn't work for me, found out what did work for me. I guess if I have a philosophy on the market, it's and I've gone down so many like false, I guess false idols. If we're going to search for, the perma bear arguments all sound very interesting and stuff. The commodities, the Jim Rogers or whoever these guys are, Peter Schiff, right? They're gold bugs and they're like, oh, we're out of debt, but that didn't make much money. These tech companies that are quote unquote unprofitable seem to do pretty damn well, right? So I eventually, if I've gotten to the position or, kind of my philosophy now is a price, the only thing that you need to know is price. Obviously financials and earnings move a stock, but that's reflected in the price unless you have some insider information, which I don't pretend to have. So I'd rather just follow the big guys and than try to find it before they do. You can be sitting on the next gold mine, but the average person isn't going to be able to hold that trade or go through at a base or whatever. So my trading style from that is, okay, how do I get in the lowest risk point? When a stock, I want to be in a stock just as it's going to be going up. I don't want to be sitting in positions for a long time. And I want to, try to ride the trend of it's going. Sometimes I'll hold stocks, over a year. I'm still holding Spotify. That was my first trade of I don't know, was it last year? I bought it at 190 something, and it's more than a year later, more than a year and 6 months later, or so. I'm still holding it. But and I can have trades that last not very long at all. And it's just kind of like where's the information or where's the opportunity of that particular trade. So that's kind of how I've a little bit about background and kind of what sets the stage. Obviously, I've talked about a lot, and we've chatted previously about kind of my favorite setups. Mm-hmm. And these are the setups, and I guess I have to lay a little bit of an introduction for them before I can move beyond them. And so my favorite setups is this one called the slingshot and another called the fishhook. A slingshot is essentially a pullback setup. The problem I was always having, right, is you buy a breakout and immediately you get faded and you get stopped out, right? Or there's slippage because everybody's watching the same breakout, and particularly in a lower float stock, everybody knows if it's if it's going to go through $50, right? You're going to get filled at 51 just because you want to make sure it's up there. You hit the market order and everyone else's orders do, and it immediately backfills and stops you out. And so I didn't like that very much. So I thought, okay, all these stocks eventually pull back, but how do I know that they're going to pull back? So first you start looking at, well, what is a move? The obvious one that most people tried is, well, look at a moving average. But the problem with the moving average is that I found that it doesn't offer much support. The stocks would tend to slice right through it, or just keep going. Or how do you know if you think you're going to buy at the 10-day moving average and then it winds up pulling to the 21-day moving average and going up? It doesn't help you a lot, right? Because you've missed that. So eventually what I came back with is a method of, kind of basically showing, I've heard people say, I think you probably have said it before, buy the strength after the weakness. And so how do I quantify that? And so that was a slingshot. And I'll get a little bit more into exactly what it is, better, but just kind of give an introduction to it. The other one is a fishhook, and fishhook is really my gap setup, with a stock that really takes off. Maybe a lot of your viewers have heard of the term EP before, or episodic pivot. That's a term that Stockby I learned from. I used to be a member of that. And it's these seismic changes in a company that leads to these massive moves over time. The problem is once you hear this term, episodic pivot, you think everything, you get all these false positives. You think everything is an episodic pivot because it's gapped up. And so, I would chase them, and more often than not, they would fade on me the next day, or that day. And so I needed to figure out how could I get into one of these positions without losing, taking you don't want to, if a stock's gapping up $10, you don't want to wait to $10 of risk to put that on. So there's got to be a better way. So I'd worked out, kind of trial and error, finding what is the best process and how I can define that.
Yeah, and I just want to mention, I think the fish hook was the focus of the previous presentation you did at the conference. Definitely recommend it. We'll have it linked in the comments. You also talk about developing a setup and going deeper into that process. So if you find this useful, highly recommend that. That was one of my absolute favorite presentations from that year. So yeah, sorry to jump in there, but yeah.
Yeah, well, thank you for that. I mean, I think, developing a setup, whether it's a slingshot, fish hook, or something, that, you come out with, I think that process is incredibly valuable. And, but I am not going to redo that presentation, obviously, here, but I do think it's important to kind of see where, as a foundation. So the slingshot, the way I defined it, was I was essentially looking for a crossover of the 4 EM of the highs. I tried a lot of moving averages over to kind of define it because I wanted an objective criteria to say I could scan for it. And really, by switching my moving average, and I don't know why I decided to do that, I guess, to the highs, it told me that prices just climbed back over the average price of the highest price of the last 4 days. And that seemed to align very, very well with a resumption of the trend. So you can see in this stock on this particular chart, you had this big powerful move, it pulls back, goes up, pulls back. You had a gap down, and probably the people that were chasing the stock because it was probably powerful got stopped out here on this gap down. Tightens up, it's not giving anything back, but then it resumes a trend, and you can see it just launches from that point. So that's really where you want to go, because you can take such a low risk. I mean, the bars are obviously very, very narrow at this stage. But if you're trading up in here, they get pretty wide. And if you wait to here for the breakout, maybe here's your breakout bar. The very next day, it's you put you under pressure. Does it work? Did you stay in it? I don't know. But I know that if I'm here, I don't have to take that. If that doesn't factor into the the decision there, it's an easy hold.
And for those of you watching, you guys should know what chart this is. If you know, drop it in the comments below. But if you studied some great gaps, and I'll give a hint in the 2019 range, let us know in the chat, and I'll give the answer in just a minute. But this is a great chart to study and a really good example of the slingshot. And Scotland, there's actually a slingshot closer to the first gap. Do you want to point that one as well, just to give another example?
Sure. Right. We probably had a slingshot right in here too. You could pull that off. And you notice on the bottom of the screen it says there's an E. Obviously, that meant that this was an earnings gap. And obviously, you want to be tracking earnings gaps because they launch. Most stocks need a catalyst, and earnings more often than not are this big catalyst. It's a reaction to earnings. Whether it earns how many billions of dollars, 100 million, it doesn't matter. As long as the market is reacting positive to that earnings and moving, stock on these type of bars, you want to be following that. The other thing I'd actually note on this chart, and maybe we'll get into this kind of later, is do you notice, like we here got this close on this day one, right? How the price set up right in that same range, and then it slingshotted off of that. I think that becomes significant, as we'll see a little bit later. I mean, it tells us that there's demand at that price, and particularly we've just blown through the slingshot tells us we've just blown through supply, and it becomes a pretty easy run after that point. All right. There we go.
There we go.
All right. Yeah, so click. So here's another example of a slingshot, and I guess I want to draw kind of a distinction, because people think, well, any time that you are over the 4 a.m. of the highs, like right here, it's a slingshot, and that was never in my intent with this setup. To me, that's just a normal breakout, and it's it's a pullback setup. So here we have in this Verona pharmaceutical, you kind of looks like an earnings gap, pulls back, bounces pretty high off this prior support level, which happens to coincide with a 65 EMA. Then you have a slingshot here. So you have the weakness, then you have the strength, and then the resumption of the trend. To me, this is at this top level, which it would technically be over the 4 EMAs. That's not a slingshot. There's no pullback. It's just a straight up breakout high at that. So that's all. I just wanted to show the distinction on this one. All right, so here's the formula. A lot of people will ask, what is the formula? You guys have that, I guess
Deepvue,
oh, yeah, in Deepvue, they've already got it codified. There's a lot of people that have coded it or whatever, but here was the original code, and I guess this was. Do you guys know who Marston Parker is? He's a market wizard, but he actually helped me with the code. He wrote it up like in a second. A great guy. So essentially, what we're saying is like price is higher than in TC 2000, which is what I use, than the moving average of the 4, and it's below. And this is what at least I coded on my chart. It's below the last 4 days. So what the point is that we're just looking for a new signal, because once you're over that 4 EMA, you're going to stay over that 4 EMA. It's you want a fresh signal and not the just because it's over a 4 EMA, and there's nothing special about about that. A lot of questions that I'll get is, well, how do I scan for this? And TC 2000 makes it super easy, where you can just create a column and you can filter, just sort it. So that's typically if I'm looking for a setup, and particularly if you've had a strong move or a pullback, kind of in the broad market, you want to see what's pushing out. So it's just a very, very easy way to look for that. And then you got to do you can do it on the hourly, weekly, because obviously a slingshot's going to start, it's going to start in the 1 minute and go to 10, 5, right, and all the way up until it all the way goes. But you can kind of follow along and see how it plays out. I love sortable columns. I use them, all the time. And you kind of see just, for example, when I put the slide together, it's sorted by some of these are actually going to be slingshots and some are not, but you have to go through kind of manually. So examples of what I would call a slingshot is pi, and I'm just curious because it looks like it would have been I guess up a little bit, or went up to about 114 today and slide, but that would be a pullback after some strength and then some new strength. So I think that's a decent enough signal in this environment. And I'm trying to find like new signals here, just going through as opposed to the Hall of Fame list, because we don't have the luxury of going through Hall of Fame and every time. But certainly we want to be looking at some of those. You probably remember this one. I think this is kind of one of the first slides when we talked the last time that I showed as a great example. And at that time, I had the white dashes that signify the 4 EMA crossover, but you had the tightness and then the price expansion off from that point. And because look how tight those candles become at that point. So it was obviously you're not taking as much risk as if you were going to be, if you buy the breakout, you're buying what right here. To me that's a higher risk trade. Same thing with AMAT. Same type of thing. And you can see, like, once you get a slingshot, you can ride these for, long periods, and, because you've entered so nicely. So in a sense, that's kind of the slingshot. Here's one more, that recent one, and this is kind of a name that I certainly traded here. It triggered, obviously it was above, but it didn't close. But if you're buying that stock, and I was taking a position in this range, just because it doesn't hold your slingshot doesn't mean you sell it. You want to make sure it honors that stop. And so this wound up being a incredibly good one. Builder. Okay, and I just put an ask. You guys, would you think this is a slingshot? And it triggers, right? But see, to me, that this is not. There's no strength. It's not just because it goes over. This is just some junk in the base. So just because you're over this, this 4 EMA or in a downtrend, to me, that's not what this setup was ever meant to take place. Same thing with like this, although, to me, this is just a range bound, example. But it's above all the, key moving averages. But to me, that this is insignificant. It's just noise. This one we're probably getting a little bit closer. I think you could probably make an argument that, at least you touched off the tops and then pulled back. You had some strength from March. is this a great slingshot? No, but if I was interested in the stock, this is probably not a bad spot to take that risk. All right, we'll go down to the fish hook then. And as I alluded to earlier, my problem was how do I trade EPs? Stock gets up, and I'm convinced that I just be able to ride it, and it's the next Facebook or Amazon or one of these stocks that you can just keep going up. The problem is I buy high and wind up selling low, and that's not a very good way to make money, right? Because they start fading on you, and you get stopped out. So how do we know that the momentum behind that initial move that was so powerful is real and not just a 1-2 day move? So my concept was, well, if a stock essentially could retake where it kind of closed on day one, then it seemed to show that there was some more buy-in or interest in demand. Yeah, there's interest that people, there's going to be there's always going to be some initial profit taking if somebody's been in the stock and all of a sudden it's up, to 20-30%. Some people are going to be like, oh, they're going to use that exit. But then when the real big money comes in, that's when they start buying. They're not taking profits there if it's like the next big thing. So that's really what I was trying to capture. And so this would be an example of something that it was common. I thought, oh my gosh, KBH gaps up, knew there's going to be a new strand, and then it kind of makes a push, and then it immediately fades on you, right? So this is going to be something you're like, and a lot of people, you can lose a lot of money very quickly by chasing these type of gap ups. Conversely, ARM, this was one of my better trades of last year. You can see it started low. You had the first day, and everyone's I don't know, what was this, about $60-$70 probably at the time. Gaps up, runs all day, pushes a little higher. I think it pushed about 120 or something, came in, but it really started trading in this like $115 to $118 range. And on day two, it started low and then pushed right ahead of it. And then I'm buying that at that level, and it's it just kept going. Similar with Reddit, that was a great one where on day 5, it wasn't right away, but you had the initial profit taking, it comes back, and then they push right through that key level, and then that was really off to the races at that point. Here's a recent one just from a couple days ago. What is it? I don't even know. AVAV. I have a massive earnings thing, new high. Initially checks down and then off to the races, another 40 points or so. I don't know what it's doing today, but it was a couple very impressive day. One thing I would always caution is check the news, just because buyouts are not EPs. They're not going to move from that point typically. So just make sure it's earnings or some type of catalyst. Maybe it's a new contract, drug related, if there's an FDA announcement or something, and depending on the type of stock. But that was kind of where we left it at the last time we talked. And there's obviously I got your the kind of interview and the last TraderLion seminar that we did, so we can learn some more information on those specific setups. But so my next chapter was, well, how do we go from there? Because those setups objectively worked very well for me, but they weren't. Sometimes you were still looking at the trade journals and stuff. I'm like, well, why am I buying here? That's where it broke up on the daily. But is there a way I can enter tighter, sell it faster if it's not working against if it's working against me, type of thing. And so I started going through, and then I had this kind of epiphany. I went to a charity auction, and it's like they do. They had this nice dinner that they were auctioning off. It was a dinner for 12. They had, they're selling it up. You got all the wine, the food, and they bring in the opening bid. They said, okay, it's a $2,000 value. Okay, and they open at $2,000, but nobody's bidding, right? And so they start tracking it down. It goes, okay, $1,700, $1,600, $1,500, and at $1,500 you start getting to some bids, and then you go $1,600, and then it starts going higher again, and it shoots right through that original opening of 2000 and keeps going, and maybe they sell it for 3,000 at the end. And I thought that was so interesting. Why that nobody was willing to take that open, but then everybody got interested after they took it down. I started thinking about, isn't that what we see every day in the financial markets, particularly so many stocks gap up in the morning, you gap down, and but really the difference between the charity auction where you have just one dinner. In the financial markets, you have two simultaneous auctions running. You have a buyer's auction, right? What are they willing to start, bidding at or feel comfortable trading at? And there's also a seller's auction. What do the sellers start, feeling comfortable? What are they willing to sell at? And they've got a lot of supply, and and buyers have a lot of demand. It's not just, the one dinner that you're auctioning off. So, to get kind of that example, if price starts too high, there's no bid. So price drops down to a comfort zone, right? That $1,500, and then people start feeling, oh, that seems kind of reasonable. That's, and they start being able to trade in that environment. One bid, two, then somebody else joins in that level, and price starts going higher than the original. Then it goes up to it starts stalling, right? It goes up to the next level where you're going to find it starts stalling out, going once, going twice, and then maybe a bid comes in, but maybe it doesn't. But that's where the trade happens. But if it goes through that, somebody gets FOMO, and then they start just bidding whatever they maybe the spouse is yelling, and the husband's here start bidding like we really want this, and and somebody else is bidding at the other table, so they all start trying to up themselves, and then the process eventually keeps going until there's no more bids, and you have a trade. Similarly, you see the same thing in the seller's auction, right? If price starts too low, there's no sellers, and then you'll see this in the market in the opening, right? The price spikes down in the open, there's no bid, and then eventually there's nobody follows that price down, and so the buyers step up, and then price snaps back very quickly. Once it stalls, then once it's clear that it's not going to, the sellers are gone, you kind of you get panic, or you can get that type of action. But conversely, if starts selling below that starting price, and there's still demand, people start loading up their sales. They're like, oh, we're not going to get back to that higher price where we would want to sell it, or we have to sell it now, and the process still goes until really the supply is exhausted, and that can drop. We see it all the time. It drops very quickly sometimes. So I guess the initial question is who, on every particular day or even on time frame, is who controls the auction? Is it a buyer's auction? Is it a seller's auction? And sometimes it flips back and forth throughout the day. Really we have three options. You either have a balanced option where it's kind of just going sideways, buyer, or you have a buyer's auction where they just keep bidding, until they feel comfortable, and or you have a seller's auction and price goes down. So there's really those only three options. And so to reintroduce, Icarus, and in this auction contest, I would notice that there was a lot of these candles that just have a lot of tails on it. I'm sure you've heard Oliver Kell talk about his wick play. And I'm thinking, okay, well, why does the wick play work, right? We have this price goes above, creates a wick because it trades back below, right? And you see these long tails, and some people are like, well, that's just, there's tons of demand if it doesn't hold right away. That may be true, it may not be true, but if you have these wicks, there are areas where the sellers are really in control if they push it down, and it's going to melt the wax on those candlesticks, and price is going to go down. Conversely, you have Atlas, who is going to hold your price up, and it might shake it a little bit. It might make you nervous, but it's going to step in, and demand's going to be there, and you're going to push the price back upwards. So how do I take this auction concept and optimize our performance? How do we get better, right? So one of the things that I started doing is using. I use a trade journal. Like I personally use TradingView or TraderView. You can tag your charts, but the best part about it was before I started using this journal, I would just take a picture on the daily, time frame or whatever, and say, oh, this looks pretty good. But then if you can look at, it on multiple time frames at the same time, you start noticing things. So maybe you have I personally have it set up as a daily, a 10-minute, an hourly, and a weekly. Kind of see how all those time frames, does it make sense on multiple time frames? If it makes sense on the daily, was there a better entry I could have had, or am I trading against like the weekly as a whole? Is that kind of the primary trend? So I started looking at that. What are the ways that I can do better? And some of the observations were, this is the first one. You'll notice that most of the charts I post, I'm starting using the 10-minute chart. And it's not because I'm, thinking I'm in a day trade here. I just feel like it shows that auction process the best, right? You'll see that those price spikes and whether it's going to hold, and or whether it's one of these, initial short-term pops or short-term, sell-offs that you particularly, see most common in the morning of the day. But there's times when you'll see a late day flush or a late day spike. But you want to, I feel like the 10-minute shows whether it's going to build up there or if it's just a spike. So that's kind of my go-to. The other observation that I've had is you see these wicks on a candle. And maybe you want to find I can find an example, or I've got them, but they all form in the first 10 minutes or 20 minutes of the trading day. Yet more often than not, so to me, what does that tell us? Is it really, do we really need to put our stops at LOD or HO or buy stops at high OD, day? Is that really where we're going to be buying if it has to take out the high, or does that not mean anything at all? Is it that we're just going to find a bid at, and use that auction, they're going to flush the price, but do you really need, then if they start, most common, is trading at 2,000, do you really need to go back to 1,500 to know that it's not going to work? If it goes to, 2,500, I don't think you do. I think you can tighten that up. So wicks on daily, I don't think they matter for support or resistance when they form quickly. In other words, that quick spike or quick flush, there's really not an auction taking place at those levels. It's they're just price exploration. It's not the real price. I've heard the phrase that time at price is more important than volume at price. In other words, if a stock it's trading all day at a certain level, that's significant. That's where people feel comfortable trading, and price might get away from it, but it's often going to retest that one direction or the other. So that's kind of the things that we'll look for. If a stock is actually going up, is it just a quick spike that's going to Icarus and then crash, or is it something that's going to build above that level and because shows that there's real demand at that level? Like I said, price forms consolidation levels, right? We have a buyer's auction, we have a balanced market, and we have a seller's auction. So a lot of the trading day in most of the markets, they're relatively balanced, right? There's a price that most stocks feel kind of comfortable that they're willing to trade at those consolidation levels, and you see price clusters. And then if a price will bounce between price clusters, then they'll either be accepted or rejected. And I kind of, to me, the concept is kind of ladders, right? You have different rungs on the ladders, and if you look at a lot of the charts that I post, I'll have lines at one level, and you'll see it bounce to the level above or fall to the level below. And these kind of consolidation levels where they can be in play for months or even years. So they can be just, so you just leave them on the charts, and it's funny where if you have like a pivot and the stock might have gone away from that for a quarter or even longer, and then they have an earnings miss, and sure enough, in after hours or something, it retests that price almost to the penny, and then it'll find that demand level, and it's interesting, along that way. And I guess my other thing, and it's probably my most controversial thing, because I personally didn't used to believe this, but moving averages are overrated. The price is supported at these congestion points, and not just because a 50-day moving average is there. If there's no price support on the chart, the 50-day moving average is just going to get sliced through like butter. Just because it's a moving average, it's a kind of an imaginary line of the thing. It doesn't mean that an auction actually takes place kind of at those levels. There certainly are valid, functions for moving average that I use. They're great for using to sort trends and that sort of thing. But if I'm buying into a moving average, you're asking for trouble unless there's, some type of, real support at that level.
Are the pivots and, how you're interpreting things, is it similar to the Darvas box type theory with the boxes and going above and below a certain level? Yeah. Okay. Cool.
Yeah, I think that's a great. Yeah, I mean, so for people that don't know, I mean, it usually typically use a like a pivot on like a weekly charts, but they kind of pivot high, pivot low.
Yep.
I guess we have now the advantage, and he was using the newspaper charts and everything that they didn't have the tools that we have, and where we can really zoom in on where those precise levels take place. So when I was saying that we get these price spikes, if you notice, and I think this is Roku, but you have the price start up, and the very first thing in the market, you see a spike, right? And there's no build above that spike. So I had this 81.90 as a pivot level, just based on another action that had been going on in that in this particular stock. But then it spikes above, but then it can't really build above that, right? So what does that tell us? We've got to attempt to push over, but then sell it. So the sellers are saying, "Hey, we're going to sell anything in here." It gets in this thing. They all feel comfortable selling, and there's so much supply that it's going to be really hard to cover for buyers. So it tells us sellers are in control of this particular auction, and then until it tightens up here on that $80 level, right? And throughout the day, it trades above that, and then all of a sudden, now we're comfortable again. Now buyers are still taking a little demand, but then they spiked it up again. And this has been weird about the market lately. Is we'll see a lot of these spikes in the morning in this type of action, and then they fade it, and then it tries to make another run later in the day. Kind of conditions of a typical what you see in a chop type environment. Where you don't just trend all day, but it's the type of thing. But I guess the point I'm showing with this chart is these spikes happen most common in the first 10 minutes of a trading day, or 20 minutes. It's very common to see price fall or spike, and then find a real trading range that's later, throughout the day, like along this $80 level. Here's another example. Is cut off the candle. So when I draw these pivot levels, I don't find significance with these price spikes. So I cut off the wicks on them. And I guess if a price is able to build above it, then you have demand. If it's not, then the sellers are still in control. So I guess that's kind of really where. I look at the market every day. Kind of, are you able to build above a level, or is you getting rejected at that particular price level? Let's do another. Okay, I figure let's talk kind of throughout all of these things on a chart. Mm-hmm. So let's go back to Roblox. So let's see what's on a. So here's what we're looking at a daily, and now you're gonna oh my God, there's 1,000 lines on this chart, right? Yeah, but you can toggle that on and off on the daily. But really, what I'm looking for throughout the day is it growing or contracting throughout the trading day. So we have this initial price spike here, and there's a congestion, and it pushes above that, right? So it tells us, look, there's demand above this price congestion. And then it's supported, right? It revisits it where we found it before, pushes above, revisits it, puts supported, and then here's the first price spike that gets rejected, right? We kind of just steady contract, normal price action. But once you get a price, test in this obviously looks like it was first thing in the morning. They gapped it up, and they found sellers until the next day they gapped it down, but it also found demand at that same level. But then it keeps kind of growing out, and you can see as it just kind of trades between the ladder. So we know that we had a rejection point right here from this previous, Icarus level, right? And when you can build above that prior level where it was rejected, that tells us that's a pretty good, that may be a place you're interested in taking risk or taking profits if you've already got the position, or you want to monitor it. So it pushes back, and then again, the same level that where it was Icarus was flying is now becomes resistance becomes support, or support becomes resistance, and that obviously it works both ways. But you get this kind of demand area that had previously been supply, and it becomes an area where people are going to support it. So, and it's supported again. So we know that there's still demand. They tested, then they tested again here, this level where it kind of pulled back into, and until you get up to here, where you get the $100 level, they gap it up, and then they play games. They played games up, they played games down. These kind of $100 levels tend to be these price points that are a lot of games get played at there, because it's a big round number. It tends to attract price, it tends to attract trading, and then so moves above that a lot of times get faded, so just expect games into the $100 level, I guess. And so then let's talk a little bit about how we get distribution now. So after we've got these rejections, 1, 2 above 100, the sellers start taking control. I suppose you could draw you had a congestion point in this area, and then once it starts taking down, the first thing we're going to do, it's going to go to that next level, or the next rung on the ladder where price was supported, and undercuts it. But then the buyers try to step in, but once it takes out that low again, it's just signaled to everybody that the sellers are in firm control here. That the demand that came in here and here and here and here is no more. Buyers aren't willing to pay that anymore. So it's going to go down and find the next level where buyers are willing to step in. The more congestion, so we had a lot of congestion, between 82, 84, 80, 85. The more trading that happens in a thing, the more likely prices to either stop that or buyers to step in. More trading activity is going to take place. So for this particular example, it was sufficient to find some demand here, and they bid it back up, and yet again they retest that higher pivot. Okay, it looks like they poke through, but Icarus starts to play his games, and then you get the supply, and it flushes down. So I don't know if that makes sense, or we're Ionic, and one that's trading, it had some pretty big wicks. And so what I think is interesting to do is whenever you see wicks, is to zoom in and see how those wicks are getting formed. Like this is in a stock that these price spikes in here are not indicative of a stock that really is going to build and make a healthy move higher initially, right? It tells me that that there's just people are willing to sell it just as aggressively as they are willing to buy it on the open. Where this type of action that it's shown more of recently is much healthier, right? It's you get consolidation above these levels. It's not just spike spike for 10 minutes and then crash. So resistance becomes a support, and then price is going to move at ladders. So I think where price tends to spike is where I'm very interested, right? Because price can move very quickly. For example, this 41.40 level. You've seen when you previously get above it, you get these quick spikes for a couple bucks, and I think that's something. If I'm looking to take a position, that's something I'm kind of interested in, is how fast they can move through that. But if you've gotten other stocks like this Oclo, right? We had these big pushes, and we had these kind of real big candles. They try to push up, and we've got these fades out of there, which is kind of similar to Oclo as it was trading. You'd have these price spikes, and it shows that demand is not overcoming supply because you've got these wicks that are forming. You can see on the 16th, for example, right? It was first 5 minutes, 10 minutes of the day. He spikes up, and then it can't push beyond that. So to me, you see that type of stuff, I start getting nervous, and particularly on a longer term chart. I mean, the daily, if you're building up, playing this on the daily, and you're looking at this level, if you want to see it start building up there, even as a swing trader, because if you can build above that level, it tells you that there's demand, and the bigger the level, the more times it's been rejected, and then all of a sudden it's above that has significance. Here's a comment I'll open. I think this is from Friday, right? So we have kind of the price rejection, like it kind of pushes up and then immediately gets rejected. But then the rejection got rejected, so to speak, right? Because buyers came in just as heavy, pushed it above to the next pivot level, and they retest it, and they start, although we had a level here where we had a spike, we've got demand here. So I'm curious to say, once we get above this, where it previously wicked, as it builds above, it tells us the stock is actually, strong, and it's, poised to make a good move higher.
And just to use this as an example, if you go back to that one, what type of price action would say, okay, it's building above that level, just to be really clear with folks?
Okay. Sure. So let's just talk about this 3089. This is where I have this pivot, right? It poked up in the first thing, got rejected. Poked up, got rejected. So it's really struggling with this level. So I want to see it build above, right? And so here it goes above, and maybe you're looking at taking the position here against, but that if it gets faded, you can stop out pretty quickly, because I don't need to take it all the way down to 382 to know that's not going to work. I can do it just for a couple bucks. Maybe if I take it brief undercut of that line, maybe my line's not exact to the penny, but I know it's generally in that range, so I'll give it a little bit of room. But once it starts building up, it doesn't reject it. Its price is filling out in this range, right? It's building a new trading range, and that means it's going to test higher. And frankly, I think it looked like it tested 406 or 407 today. Where we are filling out, so we've got the demand that's sufficient to not get rejected like it did, throughout here. So and that happens really on all time frames. If you look at it, I kind of like to watch the action as it actually fills out during the trading day, and try to narrow it so I can get my stops or my entries as close or as tight as possible.
So just to say what I'm seeing, a rejection is where basically the next bar we fall over, or even that same bar we wick, we put a wick and we fall right back below it. Yeah, perfect.
Yeah. I mean, it's supply, it's demand, and it just tells us that there's more supply. I mean, I guess we'd call it a fake breakout, right? And what happens with a breakout that fails? Like, more often you see it a lot of times go the other direction. Right. So that's the type of thing you're cognizant of, but that the breakout is not necessarily the high of the day, or the I guess the on the daily that a lot of people will draw their lines at, or they'll say, some of these stocks you can get in significantly cheaper than where they're printing.
High day pivot or something like that.
Yeah, something like that. So here's kind of an example on the price ladder, and here's how I feel like it looks like I'm just day trading here, but I assure you I'm not. This was in this February time when things were getting choppy in bed. Even in that, TEM breaks down. Then it kind of shows that it starts building above. So we got this price support here. But I'm not taking the position per se until it actually is showing that it's able to, overcome this spike or this area of a price. But once it breaks through, I'm looking at, okay, so where would the next rung on the ladder be? It's the level where a gap opens is generally a level that you want to look at. So you give it to that level, and sure enough, it went up that 10% move when the market's falling, and it wasn't terrible. then then it kind of fades. It's showing that now all this demand or all the supply is sufficient to it's not going to be able to close that gap. That supply that causes gap is still there, and so you're pushing down. So I'm forced to. I think I probably just raised my stop along the way, trimmed a bit, and then cut it out. But that's kind of the concepts that I'm looking throughout the market to do. Like the big takeaway is these kind of congestion areas where you have a clean line you can draw that the trend has changed once you can break out of that. But it's not a bad spot. I'm not necessarily a day trader or a swing trader. I mean, here's Spotify. I mean, and a lot of people will say, well, I want to hold stocks for positions, so how does this help me, right? So Spotify, this is a stock I think I mentioned. I bought it at 197 or so. So how does this this concept help? And I've got the question, well, this is the weekly chart of Spotify, and obviously this past year we had it sliced, some pretty heavy, significant, pullback moves. Went from 660 to just about 480 or so, and slicing through the 50-day moving average, slicing through the 65 moving average, and if you use the moving average, you would have lost this position, right? Because you're selling either here, or maybe you ride the first one out, but then you're certainly selling it again right here. But what I'm looking at is, okay, where is a significant level of demand? And if you look, where did this price launch for? It's got this base right here, and you're going to retest. This is the rung on the ladder that I'm concerned that I want to see, I want to see hold, not the moving average that really isn't much in the way of actual support. It's this area where all this trading was feel comfortable enough to get enough demand to launch it, into the 700s or 600s before its recent move. So, you look at where did that kind of that pivot happen? Like we're holding here, it might have, and this is that day where we had that big reversal, but it might have opened right below, but it immediately, has that demand. So I'm able to keep that position. Now, if it would have started building below this land, I would have probably sold the position if it were fading down beyond that. But so that's I guess an example that I'm still holding this position, but of why or how I use these and why I'm still able to stay in this position even though it slices through all your 50-day moving average or 60-day moving average or whatever other kind of I guess
levels,
level or trend follower. Trend followers, would typically use that as a rule, and they'd be out. But to me, this important level was never violated. Core. I know we talked a little bit. I kind of preluded this is one of my bigger trades this year, but I actually pulled it off. So if you study IPOs, you recognize that kind of this level of where an IPO base is at or where they're able to hold has a lot of significance. So an undercut of that level, and you get your hourly, this is a significant pivot level wherever, they were obviously holding it throughout, that initial pullback. This is a stock that you should be interested in because, any stock that's going to take this type of move off the, the IPO, and then we had is something that shows us that there's demand here, there's power here. It's something you want to try to find a way in if it's going to have a resumption of that power. And so when it retook that IPO price, where it level, I guess it would technically be an hourly slingshot on the hourly, but that's where I'm looking at getting in this position, and then we have these this levels. This is what it looks like. Let's go back to the daily. Right. So on the daily, it looks like we've got all these wicks here, right? So we're having a little bit of battle, but I guess this would be what Oliver Raquel would call a wedge pop, right? You've got the downtrend, and then but it was showing that this one day, it's showing we have enough demand, and it's showing that there's still supply in there. So really we're watching for that to where it's to do throughout. So as I mentioned, I bought it kind of on this hourly slingshot where it resumed. We get the gap, and then it looks like, maybe it's going to fade. So I took a little bit off. I bought more, then took it off, and then when I regained that level, I'm putting it back on. And then, at that point, and then it's just watching this level. So where it was kind of wicking on that daily chart. Yeah, we're really, really interested. So even though we're here, I feel like I'm okay enough in my position. I took the bulk of it here and, kind of here. And while we're revisiting it, the pack gets picked up here, multiple days in a row. It tells us we've got, that Atlas level or that support. So as it starts going, and then the gap up above, above that kind of level where it was wicking, tells us it's really, really it's ready to go. And I know it did throughout, kind of all of May. Here we had earnings coming up, so I sold covered calls on that, and I think about half of the position. I got a really lucky buying. I bought those in, and then because it got a little volatile immediately after earnings. But what I saw was there was like 58, 59, and it started, kind of bouncing off that level. So I bought my calls in, and then as it felt like it was, recapturing levels, I added on the position, and then regrettably I sold it into 100. So there we are. But it was a nice little trade. Kind of these. And we had, I think this Hood did this kind of the same thing, where you had kind of a what I'd call a hidden fish hook, in the sense that you had this earnings pivot, but it really didn't, it was kind of, it didn't gap, but it was still like a very heavily significant level on earnings day. And that's kind of where I was looking at, okay, here's where most of the trading on that day one happened. If it's going to push above that, I'm going to add it. And obviously I had a lot of gains to be able to, to support that. So I was able to put on a pretty sizable position at that point. And then, I guess I look at the fish hooks now kind of the same way, where I'm looking at these levels, right? So I used to probably be buying, right here, or the first day close, or maybe about the first day close right here. Now you can see that there's a really heavy consolidation area. So you're able to buy it, just in here. And then, I saw that in this particular one, it faded in, and I wrongfully sold out, and then I corrected my mistake, and and then wound up taking it from 11 and selling out 13, 14, 15, 18, and then I guess it looks like 15.90 or so. But that's the type of thing, like, so where if you're buying on these pivot breaks, you have so much less, kind of exposure or risk, right? I mean, you can take it just off that $10 level, as opposed to, or I think I probably did 10, 50, and then add it back in 11. But as opposed to if I'm looking at a break of 13 to 10, that it kind of makes a game changer in the sense of how many more shares you're able to get, or how tight your stop is, and all those sort of fun things that go along with it. Let's see. So, I guess along with, really anything is, you make trades, track them, how to, I always look, is there a better way to get into my trades? I try a lot of things. Some of them work, some of them don't. If they work, I, just kind of get it a little bit better, and try to get a little bit, I'm always asking myself, how can I get a better entry, or how could I have held that trade better? What is the right environment for a particular trade? So I guess I've got questions, and I ask people what kind of questions that they wanted to hear. So I guess I would, if you're interested, I'll kind of go through that, because I think maybe other people might have similar questions. So this poster asks, I'd like to know how you size in some of your trades. I think you posted here that you have 40% of your position in Pelletier. How would you size into that? How much risk, and how do you define your risk? Percentage loss of total equity, or something else? I guess the first thought is all risk is not the same. So factors I consider is the distance to a stop. So my first cut is like, I don't want to take more than 1% of my portfolio in any particular trade. So what we're that if in taking a look at it a rung of a ladder, if it's a tight rung, then I can take more shares without taking necessarily more risk. But if it's a stock that trades it wide and loose, then I might have to I'll have to take smaller positions. The liquidity of a stock is also something that a stock like Pelotar or Apple, they kind of these bigger names, they trade in penny increments for the most part, and it's not like some of these other stocks like what is it, the flavor of the day CRCL, right, where that's trading 70-cent spreads type of thing. It's you can get a bigger position if it trades tighter. What is the common, I guess, our one day, and the price of the stock doesn't matter. Like, I mean, people are a lot of, impressed if you say you got a 50% position of stock, but if you're buying Netflix, you really aren't putting that much, you can put your entire account in Netflix and not take that much, much risk just because it's a very high priced stock, but if you did it in a $5 stock, that's insane, where one day, 20% moves are so common in a $5 stock, but in a $500 stock, how often do you see those type of moves? It's just rare. So you're looking at that, the price of the stock, the volatility, and then do you have gains to build into a position? A lot of times I'd like to, if I'm building into a position, I'm not taking per se all my risk at once. Okay, so another one is how do I balance trading leaders with some wild ones? And so, because I will occasionally trade stocks that are, I guess, quote unquote wild ones, looking just by sorting by the higher ADR, names, average daily range, and then I just set alerts, and I don't, you capture occasionally, some of these stocks, but it's not my bread and butter. I might take 1 out of 10 of these type of stocks, but just by, a lot of times they do follow these pivots really well. So just by setting alerts and seeing what is it doing in relation, to that? Is it climbing or not? And then, so that's something that, I'll just track, and I set alerts at every one of these pivot levels, and, just kind of see it. So, if in these type of stocks you get bigger moves, so you take, fewer shares, and then, once it spikes you set your stop to even or better. So that's how I would trade kind of the wild stocks. Stocks, I mean, and they all have personalities. Like, I think Oculus started off as kind of a wild one. It maybe became more commonplace. But stocks will go through phases as liquidity comes in. How do I scan? A lot of times I've got a short list of stocks that, anything that has an EP type move or along the way, I'm putting it on my short list, and then I just set the alerts, go through it every day, update those. And if the alarms go off and they trigger, then that's something I'm looking at, not necessarily to take a position, but I want to know if the market generally is getting stronger or weaker. If stocks are dropping below pivots, I know it's getting weaker. If they're going above, then I know it's getting stronger. So I'll also go through IPOs. I want to start tracking those. Obviously we've had some of the best moves this year has been in like CRWV and CRCL. And those are stocks that, just by tracking IPOs and seeing that they're going stronger. HNGE is a new one that just made a new high as an IPO. I've got that. Hopefully it's still up during this presentation. Those are the type of ones that I want to be tracking those and having the alerts, and those are something that I always want to have my, kind of on my attention. Do I keep a database of past research? And yeah, I used to use OneNote as I was going through, charts. I'm a visual person, so I like to keep the annotations. You would annotate whether I'm buying, whether I'm selling, go bar by bar, and then you have to be honest with yourself how you would, really trade it. If it's a breakout, but then it reverses on you, what if you really kept that position? What if you rebought it? You have to ask yourself, how would have I found this particular stock coming out of a move? What scan do I have? And what part of my process would have let me caught this stock? So I think that's kind of the best way you can get, I guess, trading experience under your book, without going through real money it was just kind of, trading these stocks mentally as you're doing your homework and studying these great moves. Now TradingView makes it, even easier for me to do that because I can look at my own, stocks, and I can do it by, I can, in multiple time frames at the same, time. It gives me a chart of 4 at once, which is great. Have I found flow? And this is a fun topic because at points this year, I think I have at points, but it's fragile. Just you can feel like you're executing, very well in the market, but then you make one mistake, or you just, and it can get you a little bit off kilter a little bit. So finding it, it's not like if you're in flow, you keep it for the year and handle that. It's there are certainly moments where I feel like I've read the market really well. There's certain moments where I feel like I'm not reading the market, particularly well. I guess the question is not, how do you prevent yourself from giving too much back during those periods where things are a little bit more difficult, and how do you make sure you don't tilt?
You put out a good tweet. I don't know what exactly you said about it, but and it was a little bit ago, but you were like, sometimes as a trader you feel like a market wizard, and then sometimes you have imposter syndrome, and that's such a great, that puts it all together. When we're trading well and the setups are working, all that, we can feel on top of the world, but then when we're a correction, buys aren't following through, it can feel completely the opposite. So I think this goes along well with this question.
Yeah, and I think that's kind of what I was thinking it as is, we've had moments this year where things have seemed to all line up and it's been pretty easy, and you feel, you try to remind yourself that you're not that smart when things are all working, just it's the markets, right? And you're not that dumb when things are, aren't working, unless you, kind of keep trying to force things. So it's kind of that balance. I mean, it's easy to feel smart if you've got the your equity curve at a high, and you just got to remind yourself to kind of, it's the process, and there's, not every trade is going to be a winner, and even if you hit 10 in a row, that's not sustainable. So I guess, trying to keep balanced, but you certainly want to try to read try to get to the flow, because it's really amazing when you're in that kind of feeling where you feel like, you're hitting your buys where you want to hit them, and that type of thing. So other questions for me, Richard, or if you?
Yeah, for sure. I've got a bunch here. So first, just to kind of bring it all in perspective, and this is my observation. Please correct me if you have a different slight interpretation. But the levels, the pivots, it's kind of an added layer on your existing slingshot and fishhook setups to try to refine a little bit the entry, get a tighter spot where you can manage risk. All of that is that fair to say?
That's correct. It's I'm not trading in isolation. It's we're finding what is the kind of the trades I normally would be taking, but how do we get a little bit better, right? Yep. So that's kind of how I'm looking at it.
Yeah, exactly. And I think that's a really good point where you just said you're not just looking at a level in isolation. You're considering the overall context, the daily chart, whether it's a new IPO, has potential based on other factors. We're not just looking on a 10-minute chart and trying to trade a pattern out of nowhere. I had a question. What creates more significance around a level? Is it more wicks down into that or wicks into it? Yeah,
sure. The more like if let's for example, let's take like a big base. Maybe the more like look at Reddit last year, or coming into this year, right? It was really kept getting rejected. I think about in the 160 level or so, right?
Yeah.
Or maybe my lows are off, but it was just bouncing off of that all sustainable. So the more times it's showing that there's a supply level or wicking there. And when it finally clears that, you're going to have a lot of it is significant, and it's going to move very quickly. And I think Reddit moved to, I don't know, what did it top out, 240, 230, but it moved really quickly through that. I mean, I remember I loaded up at that point, and then I don't know, I think I sold in the 220s because it had earnings coming up, which turned out to be a pretty good move. But that was just it was just going to rip once it finally cleared off of that excess of supply. And conversely, like, stocks will fall through if they fall through a base, they fall very quickly once that last, buy point or, demand point has been cleared out.
Yeah. And then I think you mentioned this a little bit, but I'd be interested to hear a little bit more detail. When a stock is in a range between two levels and it's been wicking into the top level, and then we get a gap, often, there's the great setup, an inside day or whatever, and then we get a gap above. How do you interpret that based on the pivots? Like, what would be good behavior for it? Just like pulling back into the top level and respecting it. What are you looking for in that situation?
There's two things that you would expect, or I guess three things that you expect to see. The one of the most common, right, is that it gaps up above that and then it fades all the way back down. It's an Icarus at level, and it's pretty common.
Yeah.
It's also, possible when a stock, just is ready to go and it never looks back. And so you're looking at that gap move. It's also, one of the more common things, and what I looked for is not the first 10 minutes, but a lot of times it'll retest that pivot on that, maybe the second 10 minutes of the day. And if it holds at that point, that's where I like to take the risk on the retest of the pivot, and it shows that, we're ready to go above, right? We've back tested or backfilled that already, and now we're ready to launch. But if you're buying that gap up on the daily, and it comes in $1 or so because it needs to backfill that, then you're under pressure already. So, are there times when I might miss a trade at that level because it's just a gap and go? Sure. But more often than not, it's going to at least try to backfill a little bit on that. And if it proves that it's ready to hold on the backfill and have demand, you're getting, basically your cake and eating it too. You've gotten the stock that shows that it's ready, and you're getting a much better entry than just buying the gap open.
Yeah, I think that's really helpful, because I think a lot of people, they're scared of buying gaps because they don't have a process to manage risk on it, and just buying blindly off the open, might work sometimes, but that process that you just mentioned, testing it, proving itself a little bit, manage risk versus that level that pulled back to, that might be a better way to go.
Sure.
For the names that just go, is it often more that there's a catalyst behind the move, or because sometimes they just go?
Sometimes they just go, right? I mean, demand is built up forever, and the market tends to sometimes it looks for catalysts to explain what there's just demand.
Yeah.
So I think that, but the other thing is, like, I'm assessing, if a stock is gapping up, for example, or even gapping down, like, is it gapping into another, rung on the ladder or pivot, right? So if it's gapping up, I might be looking at, okay, well, this is a level where it's above one pivot, but maybe I'm taking some profit off of that table. Or conversely, if it's stock gaps down, but it's gapping into another, I might be buying a gap down because I know I can play it against that other rung in the ladder where everyone else is panicking out or getting stopped out. But you got to play it by ear to kind of see how strong that demand is, or that is. But it's certainly something that it lets you kind of zoom in and say, I'm not just buying blindly, or I'm not just selling blindly. It's is there a reason why it might sell off here versus might. A lot of times you'll see a gap up, and everyone's like, oh, it's ready to go. But then you see, like, you look left on the chart and you say, well, it's a gap up, but 6 months ago it topped out here. So is this really the one where I want to be buying, an EP type move, or is this a little bit more skeptical here?
Yeah, and it might be more hindsight bias, but I think I've seen it enough that it seems to be a characteristic. A lot of the names that eventually do work and push higher from a range, you see a gap down. I think CoreWeave did it right before it pushed that gap. You had a gap down and then just held tight the rest of the day. Tight. I don't know if that's something that you notice quite a bit, but that's definitely something that I seem to have found before they eventually go. There's often, if there's weakness off the open, maybe it's a gap, it just holds, especially if the market, it has a sell-off day. It pushes down further, but that individual name just holds a lot tighter. Right.
You find it, and if it's typically where, if you were to look left on that, on that chart, and kind of it consolidates, and the chart will make sense because it'll show that it previously held in that area.
Yeah.
I mean, yeah, I mean, there's times when it'll form a new trading range at something, but more often than not, I find that I'm looking at a particular level where it seems to just going sideways, and then you look back and a couple of weeks ago or a month ago, it did the same thing, or it found support in that level too. But moving averages move, so that's not necessarily going to line up with your 10-day moving average or your 20, right? It's just where it, if you draw a horizontal line, that's where it previously held.
Yeah, and then shifting to the fishhook setup, which is for everybody, it's the gap up setup where you're buying the push through the high volume close or the pivot level around that level in this scenario. I was actually going to ask you about if you prefer a range that built a tight intraday range that forms the end of day one, and then looking to buy through that range, because a lot of the times it shakes below that late day range and then goes. So yeah, can you provide a little bit more detail about what you look for day two or beyond? Yeah.
Yeah, I'm looking at that tight range. It's not necessarily the highest price it spiked at, or even the close. Even if it spiked, it's the area where it might spend 70% of the day.
Right.
A lot of time, in that it can trade very tight in that range, and if it does trade very tight in that range, that may be something that we want to buy it as soon as it runs through that range, and don't worry about going to the high or the low, because if it breaks through that range, well then the bottom of that range gives you a nice area to place your stop, so you're not taking dollars of risk, you're taking whatever
less than a dollar.
yeah, you're taking less than it, right? Depends on I was trying to say 50 cents, maybe it's 50 cents, but some of these stocks have a little bit wider trading ranges, but so it kind of what they've said is 70% of the time the stock is just in range, at least, and that happens whether it's on the whatever time frame you're using. It's going to be on the weekly, 70% of the time it's going to be in bases or whatever, or daily, or 10-minute chart, and then it's on the day. But it's very rare for a stock just to trend all day.
Yeah, process wise, especially for a fish hook, where are you setting alerts, or how are you making sure to notice when a stock is pulling below the range that's set in day one or about to test the top one? Are you just setting alerts, or are you only watching two names so you can really track it well? What are you typically doing?
Well, the first thing is you need to be able to catch it. Your process needs to catch those gap ups, right?
Yeah.
And then if it gaps up, I'm not necessarily looking to buy the gap, so I know I've got a whole day to figure out exactly where it is. But if you want to look at an example here, let's see if I can open a screen, and Nike obviously just had a gap up yesterday, or I guess on Monday, right?
Yeah, you might have to stop share and reshare.
Yeah, I'm gonna open up my trading window here.
Perfect.
Let's see if it's a good one or not. Okay, and kind of how let's see. So let's take a look how we say Nike. Now, I'm looking at it's right. We have a nice big gap up. Is it the best? My hesitation on it is, look, there's a lot that this between 70 and 80. There's a lot of price
overhead.
action.
Yeah.
There's a lot of overhead. So, but there's a lot of volume here. This is the biggest volume in a long time in Nike. So it's something I'm interested in. If I were going to say the high of the day or even the close of the day, those, and you hear a lot of people saying, oh, once it goes over that high, you're buying at 75. Does that look great? So for me, I'm looking at, we won above here, but we came in, we touched, most to me from that 72.53, and I probably call it 72.50 is the level that I'm most interested in seeing price trade above, right? And but below that, it's not really official. It's not really in go. Now you're seeing some, I guess, demand here at the gap, which is good. So you can, maybe you're thinking if you want to try to cheat and take a bit on it against the gap, that can work, but it's not the true,
fish hook.
I guess, fish hook. You're really looking at something that we think is just ready to launch. So that's kind of where, so I'd have my scanners for anything that's an EP. And this is all based on a kind of a sigma type move. or or the standard deviation, like how I've done it. I don't. Let's. I mean, okay. Now what's going on in this one? I have no idea, but this is pretty interesting, right? So let's see how is it the trading. I guess we have a little. Let's see how it closes, but 1406. Maybe, and then we can see that's kind of been an area of interest because we're stopping here. It's got Icarus right here. It keeps rejecting, but when it builds above that level, it goes over 15 or 16. Now, is this a stock I'm interested in trading? Probably not. I mean, to me, a stock that takes from how many days to go $1.50 probably isn't worth our time. But this type of bar, is interesting because it's. Yeah, I mean, it gets my attention. That's I've got, on the bottom panel is like the standard deviation, and that's a 6 standard move here. So that's something it stands out. So I guess, that's kind of what I would be on my process. And obviously it's not earnings season, so we're not going to see a lot of that type of stuff.
Yeah, do you mind actually going to Sezzle? I don't know if you can go all the way back to the 10-minute there, but it was a good example of a range forming end of the trading day, I think. And then actually this one pulled back more. It didn't get too tight.
But this is when I took those. Yeah. So here's how this is. I mean, I don't know if I can get a 10 on it, but I can. Okay. So what this Sezzle is obviously in it. Let's go through kind of the criteria.
Sure.
Right back up. Okay. Now this is a stock that has shown a lot of power, right? It's early in the last year, gapped up kind of through the 70, has done it again. I mean, the problem with these stocks when you've seen they make big moves, you kind of hide the real move, right? So it kind of runs and launches into this level where it previously found supply, but it was a big move. So, but I'm thinking, okay, here's a stock that has shown a lot of power in the past. Or has that ability. So if it clears this level, it's going to be a pretty good chance that it can run a lot higher. So that's kind of where I'm looking at that 75 level, where it previously had come in, and that tended to be the kind of the opening, and I think it was about the close of the first day, but it actually gapped below it, or maybe I don't know if it gapped, but it traded below it very shortly, and then immediately back up. But I was buying it, through, I don't know, 77, 78 in that level, and in that, just kind of that, knowing that it's situation that the 74 level was where it previously topped out on it, and it's showing it went below, and there's demand above that, so it's something I want to be in. The problem with Sezzle was it was kind of a thin stock. I mean, I remember the spreads being. I mean, I bought a fair amount, but it was kind of the amount where you're like flipping on the bid and the ask, and you're seeing some pretty big changes in the numbers. But I wish I could have held on to it. But it kind of felt like it was, the market was giving kind of mixed signals. But
yeah, did you take Dave at all that same day?
I did not. It's one I've been tracking. I've just never, found it. Dave has been obviously just a great stock this year. We had that balance. I mean, we had this kind of where he consolidated here, and reversed and ripped. Did not take that one, unfortunately.
Yeah. LEU on the gap up wicked down. Well, it didn't wick down, but like the original gap up down a little bit above 100 right there. I remember off the morning it like dropped immediately, found support. So yeah, you're kind of you opened right where the top pivot was near 114.83, and then it immediately dropped and pulled back. Yeah, I don't know if you can go back. Yeah, I'm pretty sure I remember that right.
Yeah, so I mean, I guess how you would draw it, right? So I would draw like a pivot line on the bottom of the support, and kind of where it spiked up, but then it wicked below. So I'd be looking at, like you said, that 114.80,
Gotcha.
115. Maybe you hit it, at the tie at 118. I mean, I've traded this one in the past. I did on the back early in this year. I did not try touching this one because I know it's a wild. It's wild. but again, it's been people who did very, very well. You hit that kind of that 100% move.
Yeah. Any others that come to mind as good examples of drawing pivots, ranges, high, low, or I think we've shown a lot, but up to you if there's another good example. Yes, sir.
Yeah, let's do it. Let's do kind of an IPO level, because I think this
Sure.
is one is interesting. So we had kind of this in an IPO is like there's always one that runs when nobody's really watching it, and so this is the one that came in and then it gapped high, and for me, if I get an IPO or a stock that starts like with this type of move, that's interesting, right? I mean, that tells us that there's a lot of demand in this one. So this is something we really want to be starting tracking, pretty closely. In where did it find support? Like right around this kind of 100 level, and then in here, in 111 or whatever. So it comes in, finds so we gap up, and the stock is either going to collapse at this point, as they ran it really high. And the fact that it didn't, the fact that it was finding support really at this gap close was very interesting, to me. But then, so then if I'm drawing up the pivot line, we hit levels where it kind of just, it always struggled above this point, is kind of put a support, level as well.
Yep.
And then it kind of, but it's struggling, right? So then it, kind of has that one last flush, and then undercuts that, what is that, about comes in about, I think probably just above 100, and then it starts getting tight again. And that's really strange when a stock that, had done this move gets tight, right? I mean, that's, you don't necessarily see it on the daily, but, if you got on the smaller time frames, like when you're trading like this type of, tight action, when you have a stock that had really almost, doubled, from the open, it's something that you really want to get in. And so I'm like, so this is my top buy. I'm like really gearing, and it goes up, then pulls back, and then pushes that through. And I'm like ready to buy this thing. I'm like, I got to leave in 5 minutes to see my kid's 8th grade graduation here. So I didn't buy it there, but, it did just launch from that point. It came in through, 125 set again and ripped again. I did have a few day trades on this one, where it took out the new high. Like I bought it right here, when it took out this high. And then I did buy it through 100, or I guess through 200 the first time, and then just took a $10 move on it. But
if you bought it at that original spot that you were watching, where would your stop have been, just to show an example?
Oh, great. Yeah, because if you notice, I had the green fish hook bar there too, or a slingshot bar there.
Yep.
All right, so buying here, I would have been at 108. Buying 111, stop at 108, right at, kind of after that, you can say it better right here, right? So, this is the kind of, right, you first thing in the morning spikes up, and then it checks down, right? It holds that kind of that low, and then pushes back through that, that first, that 111, level. So, you can have a really tight stop on that, and particularly for this type of stock, it would have been very good, and I'm dreading it, how much money I missed because of that.
Yeah. Yeah, no, but the IPOs have been great. I know you'd like to focus on them when you're in vogue. Hinge has been good. By the way, I just want to mention for folks, CRWV also had that initial strong move the first few days. I think it pulled back one day and then pushed strongly, almost.
Yeah, right, exactly. Yeah, so, and this is something that you should be looking at, anytime like an IPO makes a strong move, you're not trying to get that first 1, 2, 3 day move, because there's so much, price dynamics that need to work them way out before that happens. But it just tells you that this is a stock you really should be watching closely. I mean, I think eToro is one I'm kind of watching closely. It looks like it's forming a base, but the move between 60 to went up to like 80. I mean, it tells us that there's some power here, right? It still hasn't. I think it needs to really start building above this, kind of level where it's been growing a lot of wicks before it's really ready to go. But it's certainly something. I think I own a bit of it, but I'd like to get bigger into this name.
Yep. And did you have something you wanted to show on Hinge? That's another recent IPO, I
Oh,
know.
oh yeah, sure. Hinge is something, we had the recovery, obviously, but anytime an IPO takes out, it's kind of that initial high level, it tells you that it's really in motion and it's, something that you really want to be, at least looking at. The struggle on a lot of these IPO names is they don't necessarily trade a lot of volume at the front, so they can kind of be whippy. But this is one that I did buy, as it kind of made that new high, and I guess I can check it, but I had a trim order today. We'll see if it got hit or not. I think I hit it somewhere in the 52s. So maybe it's a good guess. Maybe I still own all of it. Maybe I don't. But that's and then the other thing I'm noticing about this Hinge is when it tried to pull back, and throw an arrow right here. You see how it held that
Yep.
IPO day? Like that tells you that there's demand there. So that was like another kind of a confirmation signal for me that I want to be in this name and in it for a bigger move.
Did you pick this up on the slingshot or elsewhere?
I picked it through the new high.
New high.
Slingshot, I was watching it, and honestly, it just didn't seem to have enough volume or stuff. And IPOs can be very whippy if you don't have it. I mean, I know there was another one. It was a Chime.
Yeah.
And I was watching. Okay, you got a slingshot here, but even I mean, it would have been a great move today. I mean, I saw it here, and I had the alert on it and stuff, and I'm like, I don't know. It just doesn't feel as robust as some of the other ones, just because one sell order and an IPO can sink it pretty quickly. So you got to make sure that there's actually demand, not just manipulating the price action. But obviously so I've got a window here where I'm basically put every IPO on it and kind of see how they develop and they fill out. So anything that has shown some strength or something is something I want to track.
Yep. Excellent. This has been fantastic. Any last key points that you want to make about the pivots or using them in combination with your other two setups? Any last key takeaways that you want to make sure everybody watching kind of walks away with today?
Sure. I mean, I just think, looking at your charts on multiple time frames and seeing how they address, the levels, I think there's a lot of information that can be derived from that. I think that's something that I felt has upped my game a little bit than just, taking the kind of the simpler or the more simple approach of, that I had been using. But I think it's, think of the market as kind of an auction process is, do the buyers or do the sellers have control? And, where are they likely to sell or continue buying or buy and continue selling, and that's kind of just how my process has evolved. If I'm happy to address questions and speak, I'm on Twitter, it's been a great community there, and it's been fun seeing you grow. Actually, how long have you started this? And you've interviewed some of the best, minds in this. And
yeah, I mean, my first trades were in late 2018. Took the class in 2019, and then started interviewing in 2019. I think Leif Sperandeo was one of the first. But yeah, and I've learned.
Yeah.
Yeah, and I learned a ton from you on Twitter, so it's cool to see this refinement that you're making. And again, if you enjoyed this, I really would suggest watching Scotland's first presentation on developing a setup, and we go into a lot more detail of the fish hook there too. So, this was fantastic. Thank you again for your time, and hopefully everyone watching got at least a few key takeaways. And thanks again, Scotland. I appreciate your time.
Absolutely. Thank you, Richard.
Awesome. Well, we'll be right back with the next speaker, so stay tuned and make sure to check out Scotland's Twitter, and we'll be right back with the next presenter. Stay tuned. All right, welcome back, everybody. It's my pleasure to introduce the next guests of the TraderLion Conference, the Lifecycle Trade team. We've got Kurt Dale, Kathy Donnelly, Eve Bobach, and Eric Kroll. They are the authors of the Lifecycle Trade, a fantastic book researching IPOs, using aggressive sell rules, how to find the best ones. A great research book. You can see it actually right behind me, right there. And today we'll be discussing kind of a fireside chat of current top IPOs, the state of the 2025 IPO market, and some different key concepts and takeaways that they have based on their IPO research. So first of all, everybody, thank you so much for joining us. Really excited for this one. And to start things off, maybe Eric, I'll throw this over to you. Do you mind giving a little bit of a backstory on, why you guys were interested in the first place into researching and studying IPOs, and kind of the impetus behind, writing the Lifecycle Trade?
Okay, great. Well, it all started because first we were all friends. We all studied Bill O'Neill's Cancel investing system, and we were part of the Naperville IBD meetup group. And Eve and Kathy and I were talking one time about how terribly we've been doing on trading IPOs, and how certain ones we got out of too fast and other ones we just totally missed. And we decided to put together an IPO study. And we started working on researching IPOs and found how hard it was to get data from IPOs 20 to 30 years ago. And we were working on this really cumbersome outline spreadsheet of how to study IPOs. And Kurt and I got together one time to study stocks. And he looked at me moaning and groaning in one area of the house that we were renting at. And he said, "What are you working on?" I told him about these IPOs things we were looking at. And he said, "You guys are doing way too much. You guys got to simplify things." And next, we invited Kurt to be on the study because he had some good ideas about how to simplify our study. And then we all worked on it separately, and with each had assignments. And next thing you know, we got together and really struggled once again. And we decided to have like a lake house conference where we all decided to work on this IPO study. And after some false starts and some more work, we eventually got to the point where we could actually look at a lot of IPOs and really categorize them and summarize how they acted and come up with some buy and sell rules. And it took a long time, but ultimately we came up with a good report. And then Eve decided she wanted to write a book. And after Eve decided she wanted to write a book, Kathy said she'd help, and Kurt and I said we are out. And lo and behold, we eventually got back in, and with Eve and Kathy burning the midnight oil between Christmas and New Year's, we eventually got the book finished, and it became the Lifecycle Trade. And we've had a lot of fun putting it together. And what we've all just found was, after we did the study, and especially after we worked on the book and published the book, we used a lot of the information that we discovered and material we came up with, and it's improved all of our trading. We've all had great success, not only with recent IPOs, but with the trading in general because of what we found in the book.
Yeah, excellent. And I think one of the really cool things that you guys included was the different rule sets that you use to trade both stocks in the IPO advanced phase as well as in the longer term institutional advanced phase. And I know we'll be touching a little bit on some great case studies from this year, Circle, CoreWeave as well, talking about the Everest rule set, Eric, which I know you developed. So excited to dive in. Why don't we start with kind of a current state of the IPO market, and maybe Eric, you can go ahead and talk things through and just let me know when you'd like me to switch to the next slide.
Okay. Well, this goes back to January 1st of last year, and we're looking at, this goes back even further. This chart shows the IPO activity for up to 10 years. And you can see that in 2021, there was a massive peak in IPOs. And this does not include another 450 SPACs that came out in that year. That was like a climax top in IPO activity. And you can see the next year when we had a bear market, how IPO activity just dropped precipitously. And it hasn't come back yet. When you look at the numbers of the next 3 years, starting in 2022 through 2024, they're still all below the prior years. 2022 was the lowest activity in over 10 years at that point. The market's coming back a little bit more. You can see this year that at the bottom there, it shows we're up 45% in the number of IPOs over the same period last year. However, if you look at the slide on the right, the number of dollars raised is down 3%. And so what that tells you is the ones that are coming out are, in terms of dollars raised per IPO, they're pretty small compared to past years. So we're not getting the highest quality IPOs coming out. And the next slide will show us a little bit more about that. And you can see here, these are 18 IPOs that trade over $20 million of volume per day, which is our minimum volume for what we look at for stocks that we would even consider trading. And that's because these are the ones that can get institutional support. There's only one stock besides these 18 I'm showing that actually trades over $20 million a day. It's incredible how few there have been. It's only 10% of the stocks that IPO'd since January 1st of 2024 meet our minimum value. When we wrote the book, it was around 28% on average come out and trade over $20 million a day, but these are only 10%. That's one more sign these are not the highest quality IPOs coming out. But on this list, there have been some stunning moves, and we'll get into some of those. But you can see there's a few that have traded over 100% gains from their day one close. In fact, there's 12 of them, and some of them have been good big winners for us. These are the IPOs I'm currently watching. CoreWeave, I've been trading that one. Eve has too, and I'm sure Kathy and Kurt have. Reddit, which is one that had a great run and then a big correction, and now it's coming back. And Astera Labs, or A-Lab, that's another one that, like Reddit, had a great run and had a big correction, and now is maybe poised to break out one more time.
Yeah, excellent. And this is just for everybody, this is a daily chart here of CoreWeave, and these two are weeklies of Reddit and A-Lab.
And one of the key things we want to talk about IPOs is we always say don't buy on day one. And the reason is you can easily get excited by seeing a stock making a big move. There's one that came out recently, Circle. It had a stunning move, and CoreWeave, and it's easy to get caught up in the hype and say, well, these things go up so fast. I know it's maybe not at any kind of a base or buy point, but I'll just buy it because they keep going up. And or maybe just buy day one because all the other IPOs recently are doing well. And these are ones that came out after CoreWeave and Circle. And you can see that if you did buy them on day one, and I marked day one close on all the charts, you could see that you'd be down. And if you bought somewhere on day one, you'd be down a lot, even if you didn't get the close if you bought early. And so you can see these stocks, and the one on the right, eToro Group, has had a good run, but it also came back. So we always say don't buy on day one, wait for a base to form, and then see how it goes from there. And these are the IPOs we're excited about potentially for this year. And this list hasn't changed much in the last 6 months. We've been waiting a long time. Unfortunately, SpaceX and Starlink seem to be, I'm not sure what Elon Musk is waiting for, but they haven't even filed yet. StubHub filed earlier this year, but I think after the Trump tariffs came into play, they decided to hold off. Looking for Discord, Stripe, Klarna, and Databricks, and not so sure we're looking for Impossible Foods anymore. I think the shine is off the gem on that one. I'm not sure too many people are interested in substitutes for beef anymore after the other company. What's the name of that one again? I can't remember.
Beyond Meat.
That's it, Beyond Meat. After that one kind of had a short run and then has not done well.
Yeah, excellent. And I think that's it for these slides. But yeah, just want to call back to this. This is why we're talking about IPOs, is because there is such potential here. But as you guys, found with your research, you have to treat them the appropriate way, use the proper sell rules, proper entry tactics, proper sizing. And you guys share a lot of those great key takeaways in the book. And we're going to talk exactly that, here. And we have also in previous podcasts and the previous conference presentation. So let me go ahead and share, Eve, your slides here, and we'll jump into some current and recent ones. I know everybody wants to hear about CoreWeave and Circle, so we'll probably start there. And let me jump back here. And you guys can all see this? All right,
Yes.
Perfect. Yeah,
Thanks,
great.
Richard. Thanks
Yeah,
for having us.
Of course, my pleasure.
Great fun. The reason I picked Circle, there are two IPOs that I've been focusing on the last few months. And they're the most liquid names, with high revenue growth and strong technical action and some fundamental catalysts. So I recently showed the CoreWeave trade in detail. That's on a YouTube video. So I'm going to focus on Circle today, but both of those IPOs, as you mentioned, Richard, have had phenomenal runs. And they also underscore some of the rules that we outlined in our book, The Lifecycle Trade, on what rules work better during the IPO, the initial advance phase, which is usually short-lived. So I'm going to actually show you the live trade pretty much because today
and
I'm totally out of
So
Circle
sorry
at
to
this point.
cut you off, Eve, but before we do, just want to make sure we mention this disclaimer. All
Okay.
this is for educational purposes only, and you guys can definitely read on your own time the rest of this disclaimer. But yeah, just want to mention that, as I'm sure many of us may have positions in the names discussed. And
Yes.
perfect. Sorry to cut you off, Eve.
No, no problem. Thanks, Richard. Thanks for bringing that up. Yeah, that's a very important point because none of the stocks we recommend, I'm not making any recommendations. We're not making any recommendations. We're just doing this for educational purposes. And as Richard mentioned, we may have positions in the names that we talk about, and I'll try to remember to share that. But Circle, I have traded. As of today, I'm out of the trade, but let me kind of go through from the beginning. One thing I want to point out with IPOs is they're very, very volatile, as many of you would know when you're trading them in that initial run. It's very easy to get stopped out. And I go in with the expectation that I'll be stopped out several times before I get positioned. So in Circle, the gray boxes show you where I attempted to get positioned in this IPO. And I set tight stops. And I'm usually doing smaller test buys when I'm first trading an IPO. I want to see, how liquid they are, how they act, how they trade. So you can see I was stopped out several times before being positioned. And one thing also if you think back to June 13th, that was a pretty bad market day. A lot of leaders were getting hit. The market was weak, ended down. And that's when Circle decided to start moving out of this little pennant high tight flag IPO formation. And so typically I would take a position in the stock, but since this was a high risk trade with the market selling off, I did decide to buy options on the stock. So whenever I trade options, I typically, once I'm up significantly on them, I actually sell the position in lots. So I did end up taking profits on that trade. And then when the stock set up again and the market kind of calmed down and started acting well, I did take a position in the name. And one thing that we talk more about in various webinars is the super gap. So here what happened was Circle moved out of that high tide flag and then staged a super gap. It's a gap that's usually 10% or it could be a lot greater on huge volume, and it's coming out of a consolidation. And if you see on the following day, even though it was a red day from the super gap, it did hold that gap pretty well, closed pretty tightly, and then started moving out. So I was buying the stock on June 18th as it kind of followed through after the gap. Now this says I'm holding a partial core position because I updated the slide yesterday. That partial core position has been stopped out. And the reason for that is, see the little triangle, and maybe Eric can chime in too on the Everest rules. The Everest stop actually stopped me out of my remaining core position today. But before that, I was taking profits into strength. And I try to do that always when I'm trading an IPO in the initial advance phase. So as you can see, Circle with the blue arrows there, Circle went into a parabolic move after that super gap. The move was stunning, and I was taking profits on the trade several times as it made that move. And then the final partial core position was sold today on an Everest sell signal. Now, Everest really looks at parabolic moves, you know, we have multiple gaps, huge price moves, looks at a number of factors, and then it sets a stop 2 days back. So if you see where the little triangle is, the undercut of that day's low was the stop point. And so that's why I was stopped out of the rest of the position today. Whenever I'm trading an IPO, I also try to look for a precedent. Now with Circle, it was very difficult to find one. And if you move on to the next slide, Richard, Upstart was the closest one that I could find as a precedent for a very fast move, a high tight flag type of formation. And this chart doesn't show what happens afterwards, but Upstart, I believe, corrected 60% after this point. That's one of the reasons, and I don't know if Circle will do that, but one of the reasons that I sell into strength when I'm trading during this phase is whenever a stock moves up this significantly so quickly, it's very volatile. It can also correct very quickly. And you can see that with Circle's move off of the top in a matter of a couple of days.
Yeah, and this continued down and again, as you mentioned today, undercut this low, which was the sell signal you were waiting for on the rest of your position.
Right. And I have an excerpt here from our book on the rocket ship life cycle pattern. What's unusual is that this is a very rare pattern, but we've seen a couple of them this cycle, right? We've seen that with Circle and we've seen that with CoreWeave. And both of them are very liquid names. So basically the rocket ship pattern is pretty tricky to trade because it doesn't usually give you much of an opportunity once it gets going. The moves are usually stunning, but the corrections can also be very, very deep. One of the things as well that we're looking for is the percent move from the first day close. Now, on the previous slide, I had mentioned that from the initial IPO offering price, Circle was almost a 10-bagger in a matter of 12 days or so. But we look at it from the book's perspective and from our perspective, what's most important is the price that an investor can actually get. And that would be starting from the first day close. So even if you take the move from the first day close on Circle, it's been very, very significant. And one of the things that we found is that if a stock can move up very quickly in a short period of time, it's more likely to have a larger run in the future at some point. So I always put it on my watch list. And what we call those is rare jewels. So if a stock moves up over 100% in 90 days, correct me guys if I'm wrong, then it's considered a rare jewel. And what I do is I always put on a special watch list. Some examples of those names in the past, one was Palantir. So when you trade that during like the IPO advance phase, then it may base out for months or years, but I always keep it on a special watch list and check them periodically because it can point to a couple of leaders. So CoreWeave and Circle qualified for that in the past. Palantir has, Robinhood. I believe I have a list of some of the key names on one of these slides. I don't know, is that on the next slide, Richard? Oh, no, we got the sell rules. Maybe go one forward.
Sure. Oh, I don't know if you include that.
Oh, okay. It might be on the other slide. Well, here, I have it right here. Another couple names are Upstart and Twilio as well. So those are examples of IPOs that had a significant, very fast move, 100% or greater, and then later they might have gone through like a correction phase, an institutional due diligence phase, and then resumed their advance.
So basically those rare jewels are stocks to focus on even as they go through their correction phase, to watch to see if they develop a longer, basically an institutional advance phase later on. Is that right?
That's correct. And so even though now I am out of Circle, I've finished my IPO advance phase trade, that's going to go on the special rare jewel watch list. So it may consolidate for a while. I don't know what it's going to do, but I'll keep an eye on it and see if over time it can set up again. Now, CoreWeave, I do still have a core position in. As I mentioned, I had a YouTube video that kind of goes through the details, so I'm not going to go through that today. But that is also qualifying as a rare jewel. So that once I finish that IPO advanced phase trade, I'd be watching that name as well. The reason I included this slide, there's an excerpt from our book on the best rules for different phases. And this is a list of the rules that I typically use on the right here for an IPO advanced phase. Often I'll sell most or all of the position into strength. I try to always hold on to a small core, but most of the position would go into strength because I've seen, and we've seen as part of the research, how quickly that IPO advanced phase can reverse. And occasionally I'll use the ascender rule. The ascender rule, you can see it and reference it in detail here, but basically it looks at the 21-day, a close below the 21-day, a close below the 50-day, and then it's a time-based rule after that. Also, when I see a parabolic move, as in circles move, I'll sell into that move or a break of that move. So I'm watching for parabolic moves. And then I often use the Everest rule. So once the Everest signal triggers, I'm watching for an undercut or intraday or a close below 2 days back as a sign that this stock might be done for a while.
Yeah, excellent. And Eric, is there any additional color or things to look at when it comes to the Everest rule? I know the specific, the exact rules are your own, but is there anything that you'd want to, mention to folks who might be more interested in studying parabolic moves to help them trade that type of scenario?
The only thing I'd add, and I thought Eve did a great job explaining it, the only thing I'd add is sometimes the Everest signal occurs at the beginning of a move, and it's a sign of strength. And so you have to be careful in that. If it does trigger and the stock has just started to move, you kind of have to look at it and say, well, I'm going to maybe ignore that. If you're in the IPO advanced phase, then you should pay attention to it like in circle. But if you're in institutional advanced phase, which is later on after it's had its due diligence, then it can sometimes mean it's the beginning of a move. But the good news about the Everest rule is when it does trigger, you don't sell right away. It sets a trailing stop, and you always have the option of looking at the trailing stop, and if you close below that trailing stop, you don't have to sell all. You can sell half or whatever you decide to sell.
Yeah, excellent. And it might be good actually to take a step back for folks who maybe aren't familiar with the terminology. We've been talking a lot about the IPO advance phase, which is the initial move that a stock can make after its IPO. It's often it burns bright. It's over maybe very quickly, but can be some spectacular moves as we've seen from CoreWeave and Circle. And then often stocks, and most of them will undercut almost that entire move, that IPO day one low. And then go through an institutional due diligence phase, basically a basing pattern, which can last quite some time, and basically consolidate for quite a while until institutions do enough research to actually decide, hey, we're going to build a position in the stock, and that creates potentially an institutional advance phase coming out of that breaks through that level. Kathy, I know you love to trade those institutional advance phase. Anything you want to mention more to viewers out there about what you look for to add more color to that time period within a stock's life cycle?
Well, to reiterate some of your points about the statistics that we found doing the research, you're exactly right. 91% is the exact number. I just happened to pull it up here, undercut their entire structure. And so I think it's important to point out, since we mentioned Palantir had a beautiful IPO advance phase, and if you look at it on a monthly chart, it undercut that entire structure for a long period of time before it came back and built that new first mature base, is what we call it, within that institutional due diligence phase, where it's really not tradable and investors are trying to figure out if this is viable for a future trade. And so it's really one of the, I would say, top stocks where you had a very successful IPO advance phase, a very traumatic institutional due diligence phase, and then now a very beautiful, amazing institutional advanced phase. So there's so much to study here. And I would recommend to a lot of people to take these model stocks that we're talking about and practice and study, week by week, day by day, how you would want to trade them in the IPO advanced phase. You have a guideline of rules that we have shared with you here on this summit webinar, but then also in our book. And then, tweak them for yourself. And then once, the run is over, which we know usually isn't going to last very long, it's going to go sideways, which Palantir did, and then undercut the whole structure. Then you go and you say, okay, well, what are my institutional advanced phase rules if it comes back? And then you study these due diligence phases and look for those mature bases and how to trade those as well. So it's very important to have rules for both sides. And it's really great when you can trade both sides, because both of them, especially Palantir, can be very lucrative if you trade them appropriately. And then I also want to mention, though, because IPO advanced phases can be really great, only 10%, that's another statistic that we have, actually it's 11% hit an all-time high and then never go higher. So some of these may never even come back. So we may put it on our list, like this is a special stock, but there's a good chance it may not come back either. I mean, 11% is a pretty small number. So again, we're always looking for the cream of the crop in IPOs and all stocks. So, and actually, if you want to go quickly back to Eve's presentation on her Circle trade, I also traded Circle, and we traded it almost exactly the same, but my rules were different. But although we ended up with the same result. So as it was consolidating, what Eve was calling the flag, I also bought out of that flag. And actually, she was mentioning that the market that day wasn't very good. And it was actually a Friday, I remember specifically, because I actually set a stop buy. And I said, well, okay, if this goes above this consolidation, I want to make sure I get in. So I did. And then I remember looking in Friday thinking, oh my gosh, my trade went through. What am I going to do? But it ended up working out great. Now, I did not add to it when Eve was talking about there in that pullback, probably the slide before this one.
Oh, sorry. Here we go.
So she added where she has that arrow. Oh, no, my bad. She bought the calls. So I didn't buy any calls. I just bought it straight out at a stop buy, as I mentioned, on that first arrow where she shows IPO high type flag. And then when it kind of gapped up and then paused there for a second, I didn't add to it. But like Eve, although I wasn't following the Everest rule, I also sold it today. And the reason being that it hit my MCP 50. I've recently been studying the best way for me to handle these type of moves, because my bent is, as you mentioned, the institutional advanced phase. And the MCP for that purchase price for me, and I can't tell you what exactly was, but essentially it's the high of that consolidation there, was around $209. And we can see what it closed at today. But anyway, it hit it intraday, and I wasn't going to wait, right? I wanted at least to retain 50%, which ended up being about a 73% profit. So I was like, great. And so at this point, we'll see if it's going to go sideways, go down. Maybe it'll consolidate again, create another type of flag. We'll see. But I have it on my radar for those reasons. So so that's just a little bit of different kind of perspectives and how to look at it that I wanted to share.
Yeah, thank you, Kathy. And here's that Palantir monthly chart. I think actually, Eve, it was a super gap that started this move. I think we actually talked about that here. But here's the IPO advance phase on a monthly chart. Here's the long-term institutional due diligence phase. And you guys would draw the turbulence zone right about here. Is that correct? So that's that IPO high. And then it finally broke out in 2024, though it had a nice tradable move before that. There were some spots to get in, but this is where the move, almost really got started, breaking through that high. And then there's obviously been some great opportunities here. Anything you guys want to add, and maybe Kurt, anything you want to add on the institutional due diligence phase or that turbulence zone based on the research that you guys did?
I would only say that I've noticed that it is a line that's a marker. And you may see other lines as you look at that would come earlier. But what I've noticed, especially that in the top, is that it will usually noodle around 10% or 10% above and 10% below that number. So you can expect it to kind of bob and weave. And of course, you're looking at a monthly, but what happened with Palantir in maybe 2 or 3 places I could find that look like resistance zone is you ended up in a tight basing area, and once it came through, went through with power. And occasionally they move through there so quickly, like Applevin. If you go back and take a look at that, they go through so quickly that it takes your breath away, and it's like, hey, this isn't going to play. You need to be in the stock. It doesn't mean you wouldn't take it on a breakout. It just means you can expect a little bit of a rough ride for a short period of time.
Yeah, great. And I want to go to a weekly and actually bring up CrowdStrike because I think it's a good example of what you guys talked about in your book, where you've got the IPO advanced phase here, right here. This is the institutional due diligence phase under the turbulence zone. It broke out of that, had the great institutional advanced phase, Kathy, that I know you love to trade. And then after the major bear market in 2022, it started this most recent run right here and has a amazing move since. Anything that you guys would like to add about CrowdStrike? Because I know you guys, you don't just trade the very recent IPO advanced phase moves. You guys also like to trade recent IPOs as a whole because they've got such potential. But anything you guys want to add on CrowdStrike, or we can bring up another name. I think Hood would be great to review. But any extra color on Crowd and how you guys kind of interpret this chart.
Richard, go ahead, go back to that first turbulence zone, and
Yep.
you can get an idea of what I was talking about with how it bobbles around.
Mm-hmm.
And you'll notice that it really had a tough time in there, even though it tried to come out and swing back in. But once it got going, the chains were off. And there's others you can study Zoom in the past after COVID, and it had a tough time too. But once it was released of that area, it really took off. So that's a great example of how that works.
Yep. And I'll bring up Hood since a lot of people are trading it now. This had quite the bust after the IPO advanced phase here, but it's been a great stock after this breakout, this resistance down here, and has been trending beautifully after this most recent correction. Have you guys been focusing on this at all? And if so, have you handled it?
So this,
I've been, go ahead.
Go ahead,
Oh.
Kathy, to start, and then we'll go to Eric.
yeah, well, so I found this stock to be very challenging because it's a little bit more, it's moved around a little bit more. And I missed that first move out of that high I missed that move from the institutional due diligence phase. So I tried the base above that one and then got shaken out, as you can see, with that big bar. And that was when the market had a really big shakeout as well. And I think there was a spike in the VIX that day, and then everything started running. So I was lucky enough to actually get back into it right after that. And I do hold a position in it from that point. But I have not added to it for the reasons that you see. It made a great high up there where you had that line drawn, and then it went back underneath. So for me, this has been a more challenging stock. However, I have a good gain in it, and I'm continuing to hold it. It's approaching now, finally, its turbulence zone. So it'll be interesting to see what it does there. I don't know if you can bring it in so you can show where that turbulence zone is. It's pretty close to it, but so it's almost there. So, to Kurt's point and what we were looking at, those other two examples, will it bust through, or will it kind of go sideways a little bit like CrowdStrike? That's all to be determined. And my style of this institutional advanced phases, I do like to get into that first mature base if I can, maybe the second. And then I really just want to hold after that, because I know a lot of these will start to get choppy, and Palantir was choppy too. And I currently have a position in Palantir as well. And I want to be able to hold on to these big names for a long period of time, even within the chop. So very important for me to get into that first or second mature base, and then be able to use the long-term hold rule of the 40-week moving average that we've discussed in the book in concert with mental capital preservation, retention of gains, making sure I'm always retaining at least 50% of my gains.
Yeah, excellent. Eric, did you have something to add as well?
I'll add just a couple of points. first, we categorized stocks by in the IPO book, and this one to me looked like a disappointment. When you look at the beginning part, it had only like a 2-week IPO advance, too fast for anybody to really get into, and then it came down and it just had a due diligence phase way below the day one close, and it stuck down at the bottom for a long time. In fact, it was off my radar for a while, and then I started to see it come up, and I started looking at it every now and then. But something came up that Kirk can probably talk about on this one too. I think this one exhibited a liquidity tell, and the liquidity tell is where you start to see the volume come in, and the stock hasn't moved much, but the volume has, and that was maybe something that worked on this stock. I didn't look at it for that, but I'm guessing it showed a liquidity tell, and that was a signal that maybe the stock is starting its institutional advance phase.
Yeah, here's the dollar volume I added, so you can see it maybe a little bit more clear here, as it's gotten crazy liquid now. But this is definitely
I've
nice
seen
peaks.
some green bars and looks like February, March of 2024. I don't know how go further ahead that section there. I don't know if those are more than twice what it was when you go back to the fuchsia bars further back, but my guess is it is, and that's a liquidity tell to me that it really started to get some dollar volume, and then it started to go. I was even later in this stock than Kathy. I see at the far right where you have that line drawn. I saw that correction, and when it started coming up the right side, not the bar that two to the right of that one, that's where I got in because it broke above what I looked at like a consolidation, and it got above, I think, is that the 50-day moving average line?
Yeah, this would be the 10 week. Yeah, 10 week.
Yes.
Yep.
And that's where I got in, and it's been a good hold for me since then. But it's interesting to me how there's 4 of us who wrote the book. We all play it different ways. We see different things. I'm not as fast as Eve and Kathy, but many times I get texts from them that say, "Hey, look at this stock," and then I start watching, and then that helps me out. So it's always good to have trader friends who trade a similar way, because you can't see all the right stocks at the right time, but maybe your friends can.
Yeah, it's interesting. You finally seeing a big jump in institutional ownership, the number of funds coming in during this most recent move. That's definitely what you want to see in institutional advance phase. And Kathy, I actually wanted to go back to crowd because I think it was in a podcast we did a while ago, something that I know you look for to potentially, start to focus on a stock more for potential institutional advance phase is the 40-week moving average or 200-day moving average starting to show up. Anything you'd like to share with everybody about, how you look at that and, why that's a time frame that's relevant to you?
Yeah, absolutely. I think that was the New Year's Eve podcast we did. And we looked at a lot of these recent IPOs from that time frame. And yes, the 40-week line, since I've been looking at it, I haven't done any official statistical analysis or anything like that, but just looking at so many charts and so many IPOs, once I see that 40-week moving average, that gives me a guardrail or a barrier, right, to watch for. And sometimes I will see a base form right underneath the 40-week moving average or right above. And that's when I'll start to play with it, right? And so in this case, it didn't really form that base. But again, this was the pandemic.
Yeah, it was a quick correction.
Yeah, exactly. Correction. So you really had to get in these. And a lot of these were like, yeah, you were just getting in. But yeah, the 40-week moving average or the 200-day, whichever time frame you're looking at, that line, I find it more often than not that, that's where the turnaround kind of starts to happen. And that's about 6 months. Is that right? So 40 weeks, well, a little more than 6 months, but in any case, yeah, it's a great marker. And you can also apply that to even the IPO advanced phase, or just not even the IPO advanced phase, but just that early phase, as like, okay, how mature is this base? If you already have a 10-week line, there's already been some time put in. And when we look at Reddit, or if you want to look at Reddit now, it didn't build that base that it jumped out of until you had that 10-week moving average. So even in that case, like if you don't have your IPO base, which in that case you're looking at 10 days, potentially 10-day moving averages and 21s, then you can use the 10-week for the more mature IPOs that aren't necessarily crashing down right away. And this is Reddit, you said?
Yeah, this is Reddit on a weekly. Would you like me to go to a daily or
No,
What?
the weekly,
Yeah,
it just looks different to me for some reason. I don't know why.
it might be the scaling you're used to. Your scaling. Yeah,
Yeah.
and this was a nice super gap too. I'll actually go
Let's see
to
that.
a daily chart here. This was a nice super gap on after earnings where it blew
Mhm.
everything out of the water.
Oh,
Um,
yeah, right. Okay, so go back to that IPO phase,
yep.
the beginning base there. Yeah. Okay, so that first base, right there where it was kind of staying below 80. Yeah. So it's kind of like, I guess you could say that's still an institutional due diligence phase, but a little bit shorter. And you've got that base right there, that, and it built that base there, kind of straddling the 10-week moving average. And then the breakout was actually the turbulence zone from when it first came out. Um, so I use all the moving averages in the different stages of the IPO to determine, like, okay, where is it and how is it acting around them, and are they forming bases in those areas? So like the 10-day for the really short, quick IPOs. And then, okay, it's not necessarily crashing, like a lot of them immediately go and they crash and go down. You've got Reddit that was a little more not, it did undercut, but right away, and then it came back up. And then you've got your 40-week moving average then for some that are moving a little bit later than that. So you can use any of them in that way, and that's how I like to do that as well.
Great. And I actually wanted to bring up and get your guys' thoughts on Gev, because there's kind of been more names similar to Gev where it's a spin-off. Any thoughts on that and how you'd kind of interpret that based on, the research you guys done? It's not exactly an IPO, but it's similar in many respects. And yeah, Eric, you want to start?
Well, I have found that for the most part, they're not very good. If you look at I forget which one is it, the one that spun off from Johnson and Johnson, begins with a
KView,
K. Which one?
KView,
What is the
Kvue.
ticker?
KVUE.
Yeah, there you go.
Yeah, that's more typical. Where you have the spin-offs and they don't seem to do very well because many times when they spin something off, they spin off the stuff that's not very good. They want to keep the businesses that are growing, and they spin off the ones that are more mature. But if you go back to
Gev.
GEV, it turns out that what they spun off, and this is the power systems division. They make generators and all those kind of things. That's a hot market because who knew a few years ago that with AI they were going to be needing to generate a lot more power in this era when the environmentalists didn't want us to build any power systems or transmissions or generators for 20 to 30 years. And all of a sudden it is becoming urgent. And this is one that came out. I think you just treat it like an IPO. And all the same rules apply. And you can see from this one, it came out, it undercut the day one low, formed a really short base, and then broke out. And then look at that nice flat pattern there. That gives you a second chance if you miss the first breakout. And then it's had given you no trouble until we had the beginning of the bear earlier this year when we had the tariff tiff, and then now it came back.
And this one was very liquid as well. I think that's worth mentioning. During the space, I think it was trading about 20 million shares a day and was about over around 150, even more in price. I know liquidity is a great takeaway that you guys have from the book. Anything related to that here, or just with liquidity in general? What do you guys typically look for? And maybe Eve, we'll go to you to start.
Sure. I'm glad you brought that up because I was just thinking as we were going through all these charts and the names that we're focusing on, a lot of the names that we're trading, they're all highly liquid. And that allows institutions to take positions if the company has catalysts for future growth. So I really focus in, and we found in our research that you want to look at stocks definitely over 20 million a day, but I tend to look at even names that are, 100 million average daily volume or higher. And a lot of the sorts that I do, I run sorts to check from the bottom day. So if you look back, April 7th was kind of like the bottom in the market. And I started running a power screen, which I find to be very, very helpful. And I focus in on the names that have had the fastest, most powerful price move off the bottom, because those are likely to be the leaders. And then I look for liquid names. So 100 million, definitely 20 million as the bottom, but 100 million or better. And then I look at the revenue growth. So I'm looking for names that have uh, high revenue growth and have some catalyst for future growth. And I ran that screen, believe it or not, midday April 7th. And then I ran it every week for like 8 weeks after the market bottom. And believe it or not, midday on April 7th, the names that popped up were Palantir, Hood. They were among the names that had the fastest move already on April 7th, on the bottom day, midday. And they were liquid, they had the revenue growth. And you can take a look back at the charts. We're talking about names now that are pretty extended, right? I think we want to bring up that point because we've had tremendous runs in these names, but there are screens that can identify those leaders early, and it's very important. Kathy made an excellent point. These are volatile names, and it's hard to get positioned and then sit with them. But the earlier that you get in, it's easier. So when you have that cushion, it helps holding the name. So like for instance, I am holding Palantir since April 7th, my core position. And the reason for that is this power screen and the fact that it's liquid and it had the revenue growth. And to your point, Richard, I think was it like 2 years ago at the TraderLion conference where we went over Palantir? I know it's
So
been quite a while. And I know you did that clip and we covered it in great length, but you made some excellent points. That had the institutional footprints. It showed early on, it showed the volume kicking in, the super gap. So there were signs early in that beginning institutional advance phase where it was still coming out of the due diligence phase. So there are ways to find these leaders early, and I would just caution that a lot of the names we're talking about now are very extended.
yeah, and Palantir, it looks really nice and clean. I'm sure Kathy, you'd have no trouble holding it, but it's been hard. There's been a lot of shakeouts here. Kathy, you're the pro, so but even though this was a great run, I think it made like 80% in a few weeks here. But then, it's been hard to get going more as a swing trader mindset, position trader mindset even. I know, Kathy, you're just chilling on the monthly chart, so you're good. But this is a great move to study for sure, and it looks like one of the leaders coming out of here. I wanted to go to a few R names. We've got RBRK is probably worth going over as well. This obviously is in the cybersecurity theme, which has been strong with CrowdStrike as well. Any thoughts on this initial base here, or the action thereafter? And maybe Kurt, we'll start with you if you want to cover this one.
Certainly. The one thing that's there, the revenue growth is slightly below 50%, and no earnings yet. So it'd be interesting if you look at things that are out there like CoreWeave, you're dealing with 400% and over that for earnings growth. But it had a nice initial move out of an IPO base. Didn't have much of that initial setup. I guess you could call this the due diligence through October, and has done very well. Kind of a sloppy consolidation in a bad market, but it did reemerge again, touching the 40, getting back through the 10, and has set up a peak, and now looks like it's in the third week of some kind of a consolidation. Looks a bit like a cup. So I would be looking at those things. And again, one of the standards that I know Eric and I have talked about is we usually look in that 50% number when there are not earnings, and then the catalysts like Eve talked about. And when you see real power in that revenue growth, you can sit back and say, okay, there's something significant there.
Yep. And one more R1, Roblox. It's funny. This one has been amazing. I haven't been focused on it at all somehow, even though it's had this amazing move. But this is one that I remember trying to trade in the IPO advance phase, and maybe I got an okay trade here, but it wasn't. It didn't really catch fire as we've seen like a lot of the ones, and then of course went through a pretty significant bust, undercutting these lows, long-term consolidation, and just now is really emerging. Kathy, do you want to take this one to maybe talk through the chart?
Well, I probably won't be able to do a very good job on this one because I just couldn't figure it out, and I kind of really didn't trust it. It said so many fails in that institutional due diligence phase. I think, like you, I tried it in the IPO advanced phase, and then I might have tried it once or twice. I really don't remember. But this last move, I feel like every time it would go, it would just kind of like fail and fail. And so when it happened this last time, I was just like, well, I don't need this one too. So, but you can still apply the same principles. I go to that high. Let's see. No, not that one. The one right underneath where it almost hit right there, and then draw a line that shows across. So, if I was one that was really top of my radar, that's where I would be looking at it from. And actually, that's a really great. That second touch there is a great little pullback to the 10-week moving averages. Move your cursor a little to the left.
Oh, sorry.
Right there.
Yeah.
So right as it touched, it pulled back ever so slightly to the 10-week, and then that's when it had its move. Now, granted, it came back again, which is why I would have been frustrated with it and probably wouldn't have. But I do see that pattern a lot in a lot of stocks where it'll hit hit the top of a line from a previous resistance from the far left and kind of make like a little flag, basically. I mean, if you don't ignore kind of the stuff in the middle, maybe you could say it's a big cup and that's its handle. So that's something to keep your eye out for. But this one just for me was hard to trade, and I kind of just took it off my list. Some stocks I just never jive with me, and this is one of them.
Yep, no worries. And Tem, I think might be interesting to talk about because it's more. Would you guys call this the institutional due diligence phase right now? What's going through? It's had a little bit of a move. It's had some tradable spots in there, but mostly since back in this period, we've pretty much gone sideways, and you could draw a line across here or the line across there. But Kurt or Erica, would you guys like to talk through this one and how you would interpret the chart and where it's at in its
It's
phases?
very choppy, Eric. Why don't you go ahead and take a run at it?
All right. This stock is on a special list in my watch list. It's called Do Not Trade.
I agree so
Well,
far.
It's still there. I still watch it. It got involved with the AI craze, and it started to break out, and I bought it, and then it failed, and I got out, and it broke out again, and I bought it and failed, and then it's like, okay. It's very choppy. I don't know what the average two ranges on this stock. I just know it moves a lot. I would say yes, it's in a due diligence phase, a choppy due diligence phase. I'd like to see it settle down more, but it's just been a mess. I don't like stocks that try to break out and then have these very sharp pullbacks, and so that's why it's on a special list called Do Not Trade.
I think to add to that, and also kind of similar to Roblox, I mean, at the end of the day, I'm still looking for traditional cup and handles and flat bases that I learned from, William O'Neill and how to make money in stocks. And I want them to be 30 to 35%, and I want the flat bases to be flat bases. But yeah, when I see a stock like this, I don't even need to look and know what the average true range is. I just know, like, where is the clear, concise, low risk entry, and I just don't see them in stocks like this. And at the end of the day, I want a low risk entry, and I don't see that. Now you could say, well, Kathy, the IPO advanced phase trading just a few days after, is that a low risk? Well, yeah, because there was a tight little consolidation on Circle that Eve showed, and so to me, for that type of stock, it had a low risk entry, but I don't see a low risk entry here, not for me anyway.
Yeah, basically you can't find your edge. It's
right
just there.
Yeah, and I'll just make a comment about the risk. I try to trade only two IPOs in their IPO advanced phase at any given time. My preference is one, but two is my max, and that's only during a strong market. And the reason for that is just what you guys are talking about and pointing out, the volatility, the higher risk level. You really can't, when you're trading an IPO in like the IPO advanced phase, it's not easy to put a trade on and then walk away. You really can't. They're going to move intraday, the average true range. I mean, Circle and Core Weave, while they look great now, when you look back in hindsight, when you're in some of those days, the ranges are sometimes 10, 15, 20%, and they're swinging back and forth. So to keep the volatility lower on the portfolio to manage risk, I typically cap it there. I don't know if the other team members would like to comment on what rules or what they limit their IPO advance phases in their portfolio.
Well, I think it's unusual. Oh, I think
Go
it's
ahead.
unusual to have like Circle and Core Weave happening at the same time. For one. So normally I wouldn't necessarily see it as a problem, but I do agree with you, Eve, and I do want to quote something that you did say. She mentioned a YouTube video that she did with the IBD Live folks on CoreWeave, which is really great. And everyone, if you're interested in seeing how she traded that in detail, go watch it because it's great. And one thing that she says in there is the buy once, sit still, right? So you get in there early, like with Circle, before it got crazy volatile. And then at that point, you just got to manage taking your gains and making sure you sell. And the same thing with CoreWeave. So anyway, sorry, Eric, go ahead.
Yeah, those are good points. I'm like Eve. I don't like to have too many really volatile stocks in their IPO advance phase. And it is unusual to have CoreWeave and Circle at the same time. But I try to limit it to two. And I also take smaller positions on the IPO advance phase than my normal size because of the volatility. It helps me stay in longer because they do move a lot, even intraday.
Yep. Excellent. Well, this has been fantastic. Thank you guys so much. Oh, well, actually, sorry, I brought up the CoreWeave chart. Definitely we'll refer to the other video with E, but any other thoughts that you guys would like to share on this move, this name? Obviously, this is part of that AI theme, and that's fueling this and has contributed this immensely. But any other key takeaways as you guys have observed this happen in real time? This is a fantastic case study. Yeah, Kurt.
The big thing for me, and I learned this from Eve when we were putting together the program that was done with TraderLion, and that is that initial buy point down in the hook, and not waiting until you get up into new high ground or for it to handle at that high ground. And Eve can speak to that, but it's an absolutely fantastic place to go and be in it. And I used it in ARM and several others, and it was here as well. And it could have put you in somewhere in the 46 to 50 area, and you end up, it may be topping now. It looks like it's failing in what you might consider an IPO high type flag, but you've really got cushion to sit if you were active in the stock that early, and it was like closer to the buy once and sit tight and make a decision.
Yeah. I'll make a couple points to add to Kurt's point. This IPO had a deep correction, and it reminded me of eBay in 1998. So precedent analysis really does help. When I was looking back at eBay, I actually put the charts side by side, and it really helped me think of what the possibilities might be for this name. Whenever you see an IPO that gets done during a bear market, I put that on a special high watch list. The deep base didn't bother me as much because it was during a bad market period. So I was watching it early and then comparing it to the eBay precedent. And as Kurt mentioned, there's several possible buy points on this name. And when you get positioned early and kind of like off the bottom, kind of like just like a fish hook like pattern, when the name starts to turn, it gives you a lot more cushion and you can sit with it more easily. So I would just say that the precedent analysis is very, very helpful when comparing and looking at these names to see what might be possible. But again, we're talking about two very, very rare names today in IPOs. We've spent a lot of time on CoreWeave and Circle. These are rare patterns. The high tide flags that we're seeing in some of these names, the fast moves, the rocket ship patterns. So I would just harken back to Eric's slide on buying IPOs very quickly, getting too enamored with them. or thinking that IPOs are going to look like this. These are the exceptions rather than the rule. A lot of IPOs are disappointments, and that's why we spend so much time looking at them and making sure that the characteristics are there that help to make them a potential successful IPO. So we spend a lot of time, our research, Eric started out talking about the research and why we undertook the project. We wanted to be able to find the next Google early. And was there a way to identify those, characteristics in an IPO so that we can position them early? And we ended up focusing on, how can we trade IPOs more effectively? And the research has really helped us. And the main reason we wrote the book is we found the research so helpful to our own trading, as Eric had mentioned. We wanted to share that with others in case it might be helpful.
Yeah, excellent. Yeah, go ahead, Kurt.
Oh,
Please.
I'm sorry. Would you draw a turbulence zone line real quick on this? And you can see it's conventional, the up and down and bobbling all over the place. And then put a little line down in the 46 area where that hook pivot is.
Right here.
And this is why you really want to understand that, and it's part of the webinar program where it's discussed, because when all that's going on and you're really concerned about the position, it's 50%, 40% away from where you're at. And that's why that is so incredibly valuable.
Yeah, excellent. And Eve, I know you still have some of this one. What would be what action would cause you to sell that last bit of your position? Are you watching the 21 EMA or another sell signal?
Exactly. I'm watching the 21-day EMA because I'm applying like the ascender. I did sell some into strength. And now at this point, I'm making sure I want to see if it can hold around the 21-day EMA. So I'll give it a little bit of room because I have a large cushion and the core is been quite reduced at this point. So the risk is pretty limited of giving back a lot on the trade. So I'll give it a little bit of room because this name is really unusual and has the precedent of eBay from 1998. It's a rocket ship pattern. It has the liquidity. So I'm giving it a little bit more leeway and room.
Yeah, and you're exactly right. I think the ADR on this is over 10%, and some of these intraday moves, it's not for the faint of heart. Some of these reversals down, that it holds the 10 EMA, keeps moving, and just now we're testing the 10 EMA or breaking below it kind of for the first time here. So we'll see how it acts versus that 21 EMA if it pulls back there. Perfect. Any other thoughts on CRWV? Obviously, this is recorded, so you guys will know in the future what happened. We'll see what plays out. But any other key takeaways from you guys about this name? Because it's obviously a really cool case study that is kind of happening in real time as we're prepping for the conference. Nope. And no other thoughts? No problem.
Yeah.
All right. So with that, I think Eve, you kind of teed us up really nicely, mentioning how helpful the book and the research has been to your trading. I want to kind of ask each of you guys what has been kind of one bit of info that you think has had the biggest impact on your trading, or you just think would be very helpful for people out there. It doesn't have to be just trading IPOs, but also just trading at large. I think the MCP concept by itself can help with all types of trading. But Eve, I'll start with you.
Sure.
What was kind of one of your key takeaways from the study, and how do you think that can help other people watching this?
I would say the power of the team. Working together, we just learned so much from each other, and actually doing the research ourselves. We can share it, and I think it can be helpful through the book and through the webinars, but actually conducting a research project yourself, really digging into the details, the amount of takeaways that can be gained from that is just amazing. I think it's really made me more disciplined in the IPO advance phase, knowing what's possible and how quickly that phase is given back. I tend to apply the rules that we have listed in our book, and they've helped me capture a majority of the move in the names that have good IPO advance phases. And really, so I'd say do the research, dig in, and really stay disciplined to the rules.
Excellent. Kurt, we'll go to you next.
I think we hit it here with Eve. The community side of this is huge, and you really push each other because it's like, this doesn't make sense. We have to find a new way, and then it gets into the point where you're trying to build coalition, but you have to do it with facts, and you get things going, and it really created some things I don't think were known, at least at our level, about IPOs. And it got published through. So I'm really proud of everyone that was involved and what's come out of it, and the fact that it's being shared.
Excellent. Kathy, I'll go to you.
Yeah, so research, doing the work, and the structure. Like, so, Eve said, do the research. Kurt mentioned, having a structure. It's all great to say, oh, I can do this. I know it kind of does that. But unless you write it down and then you study it and you do the comparison and you go week by week and then you write it down, you can't. I feel like that's the best way to then be confident in how you want to execute. And the goal for me and a lot of people that I talk with and share ideas with is to trade with confidence. And I think the only way to get the confidence is to write down what you did and do the research. Even doing the research and writing down what you did, like, it still might not work, right? So then you have to do it again. You test and retest until you get to the level where, like, you are confident in this trade. And even if you're not confident in the trade, you still need to make the trade to get the experience, because without the experience, you still can't build that confidence. So I think the goal I'd like to share with everybody is to, build to trade with confidence. And to do that is like doing your post analysis, studying the precedents week by week, day by day. How would you trade them? And then come up with some rules. You can use the ones that we have or tweak them however, and then execute it. So that's what I would like to share.
Excellent. Thank you, Kathy. Eric, close with you.
I would say the thing that I learned the most from this research and from trading is patience pays off. And what I mean by patience is, I used to think before we did the book and the study that you had to be there fast with these IPOs because you miss the next Google. Well, Google was a rare. We thought we'd find a lot of Googles. We found very few Googles. We found most stocks end up doing the IPO advance phase that we've talked about, and then they correct, they undercut. You can't believe how many, 90% undercut their day one low, and then they go along with this due diligence phase that can last 3, 6, 9, 12, 18 months. And that due diligence phase is really institutional investors saying, can the earnings announcements and sales growth match what they promised when they IPO'd? And that might take multiple quarters, and then it takes off and breaks out and goes. And you could have waited 3, 6, 9 months. You'd have to dive in on the first day with a big portion and then lose money. And then when you actually are in the stock, the patience to hold on. I mean, you can, if you turn on your computer every day, you can see wiggles and it might make you trade here in and out. But when a lot of these charts we saw today were weekly charts, and we talk about, it's moving in the turbulence zone. It went up above the turbulence zone and came back up. Those were weeks. Those were like 3, 4 weeks. That's a month. If you sit there and get scared by every wiggle, you're just not a good trader. You're acting emotionally. So patience and waiting for the IPO, waiting for the IPO advance phase. I'm sorry, the institutional advance phase, waiting for the due diligence to play out. And that's the key thing, I think, is patience and trade slowly.
Excellent. Well, thank you guys all for being a part of this. Always love chatting and learning from you guys. Definitely recommend picking up the book if you haven't already. And I think the masterclass we did, the IPO masterclass, was really amazing because it kind of showed how you guys each applied the study in addition to updating some numbers and presenting some more key findings. Kathy shared how she has that amazing patience and is able to hold for the long term. Eve, you shared the super gap setup and how you like to trade that. Kurt shared how he trades some of the fast moves even before, very early on in a stock's life cycle. And Eric shared some amazing research in the Everest rule as well. So definitely check out the IPO masterclass if you haven't already. But where else can people learn from you? Where would you point people to? Is your website the best place to get in touch? Yeah. Okay.
Yeah,
so
I would go
yeah.
to our website, the Lifecycle Trade. There's a link, of course, to the TraderLion IPO Masterclass on there, which you can also just get on TraderLion. But all the different interviews that we've done with different groups and that are out there on YouTube are all consolidated on the website, and people can see which one they might be interested in. Check it out.
Yeah, fantastic. Well, thank you guys all again. Appreciate it. To everybody watching, I hope you guys enjoyed quite a bit. I think this is very timely with all the amazing IPO moves that we've had recently. And the best part is by studying those, studying the precedents that we all talked about today, you can catch future ones and hopefully have some fantastic trades. So thank you guys all again, and we'll be right back. Take care.
Thanks, Richard.
Okay, welcome everybody. Kathy and I thought we'd do a quick follow-up to show how basically CoreWeave and maybe a few other names have progressed since we first started talking about it back when we recorded the full prior segment. So focus will be, first of all, on CoreWeave. It's great to see that something's actually happened. We've got some movement here. So we'll discuss, a little bit of risk management and position management as well. So Kathy, first of all, thanks for coming back on. And be really interested to hear, your thoughts on CoreWeave now and how you guys would interpret it based on the lifecycle trade, sell rules, and methodologies.
Yeah, great. Thanks, Richard. Thanks for having me back on. It's just me today, everybody. You don't have the rest of my team here, Eve, Eric, and Kurt, who you've probably just heard from, but we wanted to do like a pop-in just because you know how trading is. Things can happen really fast and quickly. And so as of yesterday, we started seeing some action in CoreWeave. So we wanted to kind of follow up on what we're doing or what we're doing, and did we follow what we said we were going to do when we talked to you previously on the pre-recorded portion of this. So CoreWeave, as you all can see, I've got a daily chart on the far right, and then I have pasted the weekly chart on top, so you can just kind of see. And this is literally just as a few minutes ago. This is Friday, July 11th. Richard probably already said it when it's about 11 o'clock Mountain Time. So I don't know how it's going to close at the end of the day, but we are approaching the 10-week moving average, as you can see on the weekly chart right here. And then we're getting closer to the 50-day moving average as well. So Eve and I had both disclosed, and Eric, that, what were we doing? And in the previous recording, we said that we had sold our additional add-on shares if we had any, and we were only holding our cores into an MCP 50, which for Eve and myself really correlates to about where this 50-day moving average is. So you could say we have a little bit of space if it breaks the 10-week moving average, just because of the way the calculations are made from a weekly and a daily chart perspective, but we are close to being stopped out. And if you recall, the MCP 50 is just what we talk about in our book, The Lifecycle Trade. It's a mental capital preservation stop, where when we have gains of 100% or more, which in this case, even I do have that, because as we discussed, we were buying it down here in this space right here when it was kind of consolidating. So we want to retain at least 50% of those gains, because we know mentally we can live with that. And also, if you look at the chart of an MCP and gains and how they're retained, when you have a gain of 100% or more, you really have a lot of room you can give the stock and still retain 50% of gains. Like you can take off like 30% off the top and still be in that 50% retention of gains. So that's where we're at. We are both approaching those stops, but as of today or yesterday, when I talked to my team, we were all still holding, because again, it hasn't touched that MCP 50. We hope that it'll bounce, but we don't know what's going to happen. The other thing we talked about was the precedent we were watching. So here now I'm showing you the eBay precedent, and on the right hand side is the daily chart, and on the left is the weekly. It's just pasted again on top. This is not the same time frame, this weekly chart versus this daily. And the reason why is because I wanted to show how eBay actually went up more than CoreWeave. You can see they both started their base around 50. If you just count from the left side of where it started trading to the right side, they're both around 50. And CoreWeave only went to about $160, where eBay went to 234 approximately and change. And it did bounce off its 10-week moving, 21 exponential moving average. And you see here on the weekly chart that 234, you know what? this is my bad. eBay did a 3-for-1 split. So these numbers are actually not going to be exactly 1-for-1. But my point was being here is just that eBay bounced before on the 21 EMA where CoreWeave is not. So from that standpoint, the precedent is not completely holding. And this 10-week moving average where it's touching is actually different also than CoreWeave, because eBay corrected almost like 30, 40, 50%. If you do that math for 234 to 150, that's like over 30, that's like a 30% correction or something like that. I did the math today. Is that right? Okay. So we have room there too, in that when you think about the differences of what we're looking at. So I would say for myself, I am looking now at the precedent for the weekly chart of eBay versus the daily chart, because it's already broken the precedent for the daily chart, but it can still go sideways here, maybe still create a flag. Everyone's always looking for that high tight flag and bounce. But again, we don't know that. So from that standpoint, that's how I'm looking at it. But at the end of the day, I still have my stop set. But if it does hold the 10-week moving average and maybe bases there, then I would look to get back in and from a high tight flag perspective.
Excellent. And could you switch back to CoreWeave for just a minute? Sorry.
Yes.
I know a lot of people are watching it versus the 21 EMA. It was forming sort of a high tight flag set up there, but we broke below, and from that contraction can come expansion either way, and this time it broke lower. Any additional thoughts on kind of that price action, how you were handling it mentally there? I guess you guys had your stops in place and were willing to give back that profits, but I know probably a lot of people who had positions, it is a sizable drawdown this past week as it approaches the 10-week moving average.
Yeah, exactly. I mean, really, you want to take gains on the way up, especially on these high flyers, especially in this IPO advance phase. Like we talk about in the book, this initial run from the IPO base is always fast and always quick, and you have to have fast rules. I was taking profits on the way up. So was Eve, so was Eric. They like to use the Everest rule, which is another rule that we talk in the book. So they were probably taking profits around 155. And I think we talked about that more in detail in the previous recording. So I'm not going to go into that, but I believe it was around 155. And I wasn't using the Everest rule, but I was using precedents also from Palantir and other high flyers where they went up maybe 400% from the bottom. So I was looking for that 160, which had hit, and then that's where I was taking some profits as well. We do talk about the Ascender rule in our book, which is one of the rules that's really good for these type of stocks, in addition to the Everest. And you would have been selling half of your position yesterday because it broke the 21 EMA more than 3%. And you would have, booked those profits, but then you would still be holding the remaining for either another break of the 50-day moving average, which it may or may not do, and then the last quarter on a full return or 500% or more, because that's how much room you kind of have to give sometimes some of these stocks. And that rule, the Ascender rule, was modeled off the Google IPO, and that's the one Eve created based on that, and that's one of the ones that we had the book, and that's where that rule comes from. So you would have been taking off gains, but you probably also would have been good to maybe do a combination, which Eve likes to do, a combination of Everest and Ascender, because then you can take gains on the way up, and then when you're coming back, you're taking a little bit more. So you're taking a little bit more gains than waiting for it just to completely break the 21 EMA.
Gotcha. Yeah, awesome. I think there was a little bit more that you wanted to go through, I believe.
Well, we wanted to look at, we were going to look at CoreWeave Circle real quick. So sure. I'll just pull that up. A lot of people had asked us about this one, and I think we talked about it briefly in the recording where, this isn't a log scale. This is a market search chart. We were buying it from this consolidation here, and then it peaked, and I was selling it at MCP 50, which got me out before this consolidation. And now, there's been a lot of talk as it reached back above the 10-day moving average. And Eve, I believe, shared, or we were going to share, even if we didn't previously, that she did try it again because it was coming back up here, but she has already since been stopped out. So that's how quick she moves. She goes in, doesn't work, the setup doesn't work, she's got a tight stop and she's out. So all these little losses, don't hurt her as long as they're really small. So we see here we've got the 21 exponential moving average now forming. Maybe it'll hold that. Maybe we'll still get a flag. We don't know yet, but that initial intent of it going above and taking more action forward did not happen. So we're out quickly. And I did the same thing. And like I said, I'm actually not out yet because I like to wait till the end of the day. So I'm going to be taking a little bit bigger loss, but then this is, again, a small position. We don't like to use full size positions on these IPO advanced phases because they're so volatile and you have to give them room and you need to be able to, hold it overnight and things of that nature. So.
And this one is even more volatile than CoreWeave, and it's amazing how fast it's moved. Anything from the weekly chart here that you wanted to touch on?
Yeah, I just wanted to bring it back really quickly because I like to always look at both because I think it's just so important to see the difference and understanding. Because when I look at model book stocks, I'm always looking at the weekly charts. And so that's really where my study comes from. So, we could still end up with a flag here at some point. It's hard to say. We're in a nice little range. I do think it looks worse on the daily than it does the weekly, right? But I don't want to use the weekly for my stops because, again, this is so volatile and so moving so fast. So we can't really do it in that way, or at least I don't want to. But it's good to have that perspective that, it might still be in play in another 3 to 5 weeks.
Excellent. And I think there are maybe a few other names that you wanted to cover in addition to Circle, maybe Hood and Dash. Yeah. Dash.
Yeah, we wanted to highlight just a couple things of what to look for moving forward. We're 55 plus days in this market rally from the end of April when we had our follow through day, or what I like to call go to green. Everyone's got their variation of how they're monitoring where the rally started. And I usually use Market Smith, which is the follow through day, which was the end of April. So we're long in the tooth. Doesn't mean we can't keep going, but we can't deny we're in the territory of we need a correction soon. Hood has been one of those great stocks. It's finally above its turbulence zone. It's had a great run up into there, but we're at $100. And I'm trying to, if you guys watch Ali Quorum on IBD Live, she's so good with making these little chart updates. So I'm trying to do the same here. I would not be surprised if it bases here and then we correct at some point, right? So if that happens, this is going to be one on my watch list because now we're not going to have any more overhead resistance on Hood. And so that's great news, right? So if we get a good base, we've got open sky, no overhead to keep us down. Another one, Dash. Also, you look at its IPO, we're nearing the all-time highs here too. And this has been a steady grower for a long time. So this could be one to put on our watch list. And again, this is something we talked about in the book. This is the turbulence zone. It's the prior high when the stock first came out. Now this one, it's been 5+ years, but still you could say, oh, it doesn't matter anymore. But I think psychologically it does still matter. And that's been my experience. So that's one to watch. A more recent one that I think is interesting is Life 360. It had a nice little run up and really not that long of an institutional due diligence phase. And it's already making in that all-time high territory. This is what we would call the institutional advance phase. It is basing. It could maybe still ride the 10-week moving average for a while, but this could also be one to put on your watch list. So those are just a few. We wanted to leave you with some watch list names for the future, and then also just follow up on what we talked about the IPO advance phase. And I wish everybody the best of luck. Enjoy this wonderful TraderLion conference that everybody's here and sharing. I love adding new things in my toolbox, and so I'm looking forward to watching more.
What did you want to cover coin as well, really quick? Sorry, Kathy.
Coin.
Yeah,
sure thing.
I think it's
okay.
definitely worth talking about. It's in play recently. Yep.
Yeah, coin. It also, just like Dash, hasn't made all-time new highs yet, but it's very close. this has been a rough move, on it. This has been hard to trade. This was the best low risk opportunity right here, kind of made this low handle, what I like to call somewhat of a non-traditional buy point when you think of the different buy points that Ken Slim and Bill O'Neill in his book, How to Make Money in Stocks, created. And we have, 4 weeks up in a row, maybe 5 weeks. So similar to those other ones, we could base here depending on what the market does. And then we've got clear skies for coin as well. So that's another great one. Thanks, Richard, for reminding me to also keep on your watch list.
Excellent. And I think a good thing to point out is like you said about Hood and Coin, a base here would be normal and natural and would set up the next low risk buy point that hopefully progresses further into all-time highs. So that would be excellent. Kathy, thank you so much for this quick catch up. Any last words about IPOs or advice for people watching today?
Yeah, I think we've seen a lot more IPOs come out in the very recent, we have eToro and Hinge and all these new. Keep in mind, not all of those are going to be like a CoreWeave or a Circle. A CoreWeave and a Circle, those are in that small percentage. And then you've got all the other ones that are going to just be all over the place. So, but just keep your eye on them. Keep your eye on that institutional due diligence phase. Look for where that 40-week line starts to pop up on your chart, which is around 6 months, and look for those first mature bases. That'll be hopefully your best lowest risk entry if it didn't go down too far. And if this rally continues, which we hope that it does, and that's actually why I think we're getting more IPOs, is there's more confidence in this market than there has been in the past years. So we definitely want to keep our eyes on those new names and implement those IPO rules so we're risk managed well and hopefully have a successful year and into the next year.
Excellent. Well, Kathy, thanks again for popping in again. To everybody watching, I hope you guys enjoyed. Leave a like if you did, and we'll be right back. Stay tuned. All right. Well, that concludes day 2 of the TraderLion conference. Again, it's sad that day 2 is over and the first weekend is over, but we've got 2 additional weekends and many other fantastic speakers yet to come. So don't be too sad. Hopefully you guys enjoyed it. Let us know your favorite takeaway and presenter from today in the chat below. And again, we've got fantastic speakers yet to present and really looking forward to all the future presentations. And I hope you guys are as well. Here is just a quick reminder that to access the slides or other additional resources from the conference, the best way to do that is to get your free VIP pass. You can scan here or use the link that's in the description. It also should be pinned in the chat above right now. And this gives you access to all the presentations and slides from today. We'll also be producing notes and additional resources based on that. You'll get the slides, as I mentioned, and also you'll be entered to win a free giveaway of a TraderLion Masterclass of your choice or an annual membership of Deepvue. Every single day we'll be announcing that through email, so make sure you sign up right here. And it's 100% free, and again gives you access to all these resources, and you get a chance to win some additional fantastic resources and tools. So definitely go ahead and unlock your free VIP pass. With that said, again, a huge thank you to Ninja Trader Live for helping sponsor this conference and make it happen. This is a fantastic resource for futures traders. Highly recommend you check out their YouTube channel and also scan this QR code to learn more. They're basically live 6 days a week with live analysis, setups, risk management principles, and other fantastic learning. So definitely go ahead and check them out. Again, tune to Ninja Trader Live for daily futures trading, real-time market coverage, and actionable strategies. And a huge thank you again to Ninja Trader Live for sponsoring this year's conference. Again, a quick reminder to pick up your copy of the Trader's Handbook if you haven't already. We've received so many great feedback and reviews from readers. We've got over 13,000 people have picked it up in just over a month, a fantastic amount there. And also, I'm very proud to say that we're rated 4.9 stars on Amazon. There's not many books out there that are rated 4.9. So thank you to all your amazing feedback. And if you haven't yet picked up your copy, basically each of these chapters go into one single aspect of building a trading system, from sell rules to entry setups to risk management. All of that is covered in this one place, and we made it very accessible, but also shared a lot of nuances that we've learned from our combined over 60 years in the market, as well as, synthesizing the advice and wisdom of all the market wizards and top traders that I've gotten a chance to interview on the podcast as well as basically prior TraderLion conferences. So this is well worth picking up. And as I mentioned before this morning, this also unlocks a free educational course that goes with the book that basically provides an additional webinar that goes with each chapter. It has additional webinars as well, additional model books that help give great examples of setups and position management principles, and is well worth it with bonus articles and bonus educational resources. So definitely go ahead and pick up your Trader's Handbook. And if you've already read it, let us know in the chat what you think, and you can help another trader find this resource. And here's a quick review from Stan Weinstein. The Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library. It's amazing to hear that from Stan, and you can go ahead and follow his guidance there and pick up your copy if you haven't already. All right. Again, I also want to mention that we're offering for the first time ever a free trial of Deepvue. This is our all-in-one platform for screening, chart analysis, fundamental analysis. You can create a custom dashboard full with very unique features like heat maps that are can be any data point. Also, these bubble charts, that's something I came up with. Very cool way to basically visualize market movements, especially at the open, to catch those breakouts a little bit earlier. And all the features that we create are really designed to help facilitate the processes that we use ourselves, because we trade every single day and we want to save ourselves time. And we basically create the tools that save us time and save everybody else time who uses it. We've got risk management calculators and several modules that can really help you become more efficient as a trader and ultimately find those market leaders and top trading ideas that much faster. We've got many preset screens as well, from top traders, from Christian Kwalamagi to Mark Minervini to Stan Weinstein to many of the traders who are presenting at basically this year's conference. So definitely check it out if you haven't already. Again, it's a free 30-day trial, no credit card required, and it does end July 27th. So make sure to unlock your free trial before then. And check us out and let us know what you think. So really emphasize to go ahead and check this out. This is a fantastic tool that we put our heart and soul into developing. We're working hard every single day and every single week to bring new features and just make it a better platform. And it's fantastic what it already is. And we've got many great feature ideas yet to come. So definitely check it out right now and let us know what you think. All right. Here's the next Saturday's schedule, so you can look forward to this. Again, amazing lineup of fantastic speakers. We've got Lance Breitstein discussing why more information isn't the answer. A very timely presentation given all the information that you're receiving during this conference. Basically, it's how to synthesize that and approach learning how to trade the right way. Then at 11 a.m., we've got Lee Tanner discussing a basic growth stock investing system, sharing his immense experience and sharing a lot of his specific rules that he uses to trade. Then at 12:30, we've got Menace Aurora discussing his potential, his specific setup that he uses, the SVRO entry setup, and going through a lot of trace case studies. That should be fantastic. Then at 2 p.m., we've got Don Vandenborg, as well as a few of fantastic young traders, Connor Bates and Ted Zhang, discussing Real Footballs Have Laces. Not quite sure what that title means, but I think we'll figure it out next Saturday. Then at 3:30, we've got Nick Schmidt discussing alternative entry tactics, discussing how he incorporates weekly charts into his trading as well to lessen that noise. And then finally, to wrap things up at 5 p.m., we've got Jared Tendler discussing overcoming overconfidence in the market. Again, it's great to hear so many different diverse perspectives. We've got weekly charts here. We've got classic can slim. We've got momentum trading, and we've got trading psychology as well. So should be fantastic. And let us know in the chat right now, who are you most looking forward to hearing from next Saturday? And I look forward to seeing you guys there as well. And with that said, I hope you guys have a great rest of